Please like, share, and subscribe. Wishing you happiness and good luck every day.
You know, when you think of crude oil trading, you probably picture these high-stakes, billion-dollar deals going down in a split second. But the actual day-to-day world of these traders, it's pretty much a closed book to outsiders. It's secretive, it's super complex, and honestly, it's often completely misunderstood. And you know, the author of the book we're looking at today, Owain Johnson, he puts it perfectly. After decades talking to these folks, he says he's rarely met a boring one. And that's because the people behind the screens are anything but. They are incredibly smart, deeply analytical, and super motivated people navigating what's arguably the most important commodity market on the planet. So, what's the secret sauce? What really separates the good traders from the truly great ones? It's not just about guessing which way prices are going to go. It's about ingenuity, creativity, and yeah, sometimes a really healthy dose of audacity. All right, so to really pull back the curtain, we're going to dive into 3 incredible real-life case studies from Johnson's book. And these stories, they're not just about making a quick buck. They're about the brilliant and often audacious solutions that really define what makes a classic trade. Okay, our first play, this one is just a masterclass in turning a really, really bad situation into an absolute triumph. It's a story of a trader who didn't just play the market, he basically created his own reality. But hang on, before we get to the wild part of this story, we need to get our heads around a super basic trading concept, arbitrage. It's pretty simple, really. It's the risk-free idea of buying something cheap in one place and selling it for more somewhere else at the exact same time. But the trader in our story, Owain Johnson, he took this simple playbook and gave it an unbelievable twist. Okay, so picture this. It's 1998. The world is just swimming in oil and prices have absolutely collapsed. So for a trader like Johnson, whose job is to supply his company's refineries, this is a terrible weak market to be stuck in. So what does he do? He comes up with this just audacious plan. First, he sees a problem. His refinery's port in the UK was too shallow for the biggest oil tankers out there, the VLCCs. So on the quiet, he pays $300,000 to get the waterway dredged. Then, the bluff. He charters one of those massive ships, a VLCC that holds 2 million barrels. The rest of the market sees this and thinks, whoa, millions of barrels are about to be shipped out of Europe, which was already oversupplied. And just like that, prices start to rally. But what was the reality? He simply sailed that giant tanker right next door to his own, now secretly deeper port. He literally created his own price spike and got to ride the wave. I mean, just brilliant. All right, let's switch gears. Our next play isn't about some grand bluff. It's about finding these weird little quirks that are baked right into the system itself. This is less about market psychology and more about hacking the market structure. The whole opportunity here came from this really bizarre setup in the Russian oil market back in the mid-2000s. You basically had 2 completely different worlds operating at the same time. You had a domestic market that was slow, bureaucratic, with prices fixed once a month in rubles. And then you had the international export market, priced in US dollars and changing every single second. And this created some situations that are, well, they're just completely mind-bending. Get this quote from trader Trim Nordhus. He talks about a time where he could sell oil, buy it back 2 days later for more money, and still make a great profit. Wait, what? How on earth is that even possible? Well, the hack, if you want to call it that, was all about being nimble. It was about pure flexibility. His firm was way more agile than the competition, so they could sell oil into that fixed-price domestic market. But if international prices suddenly shot up, they would buy that same oil back, even at a slightly higher ruble price, and just reroute it to the much more profitable export market. By using financial hedges, they were able to lock in the profit that was created by that time lag. They were basically profiting from the fact that one market was stuck in slow motion while the other one was moving in real time. Okay, for our last story, we're moving away from bluffs and system hacks. This one shows that sometimes the most classic trades aren't about exploiting loopholes or outsmarting your competition at all. They're actually about building relationships and creating value for everyone. You know, as one trader, Ralph Dieter Poth, puts it, one of the best feelings in this business is finding a trade that's a genuine win-win for everybody. And this next story is the perfect example of trading as a kind of collaborative problem-solving. So here's how this played out in 1990s Libya. You had these foreign construction companies doing work, right? But here's the problem. They weren't getting paid in cash. They were getting paid in crude oil. And they had no clue what to do with it. So a company called Veba Oil, which was already working there, stepped in. They offered a service. They'd take the oil, pay the construction firms in cash for a small fee, and then just load that extra oil onto their own ships. So the construction firms got paid, which is what they wanted, and Veba Oil, well, they made their own shipping way more efficient and created a whole new profitable business line built completely on trust and local know-how. So we've seen 3 totally different plays, right? A massive bluff, a clever system hack, and a win-win solution built on trust. What do they all have in common? What is it that truly defines a classic trade? Well, it really boils down to a few key things. It's about ingenuity over just raw power, right? Like that VLCC bluff. It's about creative problem solving, like hacking the Russian market. It's about turning a weak hand into a winning one and finding solutions, like that Libyan trade, where everybody comes out ahead. It's this amazing combination of deep market expertise and just a powerful imagination. And I think that's the biggest takeaway here. The absolute best traders, they aren't just reacting to numbers flashing on a screen. At its heart, trading is a creative act. It's about looking at this incredibly complex puzzle of logistics and finance and human relationships and somehow finding these elegant, often hidden solutions. And that, of course, leaves us with a really fascinating question for the future. As the entire world's energy system is going through this massive change, moving towards new fuels and facing all new kinds of challenges, where does all this talent and this kind of creative ingenuity go next?
All right, let's dive into a story that's just wild. It's a tale of high-stakes finance, but forget Wall Street or London. We're talking about a journey from those polished trading floors to a place that, back in the early 90s, was about as far off the map for a banker as you could get. We're going to the frozen tundra of Siberia.
Seriously, just try to wrap your head around that. 40 degrees below zero. This was no vacation spot. I mean, the source material says even National Geographic hadn't really been there yet. This was the raw, brutal reality for a team of investment bankers back in 1992.
Which brings us to the big question, right? Why would a team of 10 people, we're talking bankers, lawyers, engineers, give up their comfortable lives for that? Well, the answer involves an incredibly audacious deal, a huge problem that needed solving, and a golden opportunity to get into a brand new market and, maybe change everything for their company.
So to really understand why they went, we first got to look at how they even got there. And our guide for this whole thing is a guy named Colin Bryce, who was at Morgan Stanley at the time. The whole story kicks off with his trip to one of the most remote, but also one of the most critical industrial spots on the entire planet.
Okay, so where were they headed? A place called Nizhnevartovsk. It's a city with over 200,000 people, but it pretty much exists for one reason and one reason only: to support the gigantic Salmatlor oil field. And look, this isn't just any oil field. We're talking about the biggest one in all of Russia, the absolute crown jewel of the old Soviet energy system. These guys were flying right into the belly of the beast.
And just getting there, oh man, it was a total nightmare. First, you fly to Moscow. Then you have to trek all the way across the city to a different airport. And then you're literally just wandering around the tarmac trying to guess which rickety domestic plane is actually yours. This was a long, long way from the private jet lifestyle, It was a gritty, messy leap into the great unknown.
But here's the thing. This whole Siberian adventure, it didn't actually start in the freezing cold. Nope. It started just like a lot of big deals do, in a stuffy conference room back in London. It all came down to a chance meeting that, kicked off this whole crazy chain of events.
So picture this. A group of Russian business folks are in town, visiting the International Petroleum Exchange. Morgan Stanley gets tapped to give them a presentation. And sitting right there in the audience is this guy, Victor Pallier. He's the powerful director of a company called NNG, one of the biggest oil producers in all of Siberia. And let me tell you, he had a massive problem on his hands.
And this really gives you a sense of just how bad it was. See, after the Soviet Union fell apart, the Russian oil industry was in a total freefall. We're talking a catastrophic 15% drop in production year after year. Wells were just failing. The entire system was literally collapsing.
And here's the central paradox, the crazy thing about this whole situation. On one hand, they were sitting on a literal sea of amazing Urals crude oil, stuff the rest of the world was desperate to buy. But on the other hand, they couldn't get the oil out of the ground. And why not? Because all their supply chains for the most basic stuff, pumps, pipes, drills, had just disappeared when the Soviet Union collapsed.
They used to get it all from places like Azerbaijan. And now? Nothing.
So this is where Morgan Stanley saw its opening. They came up with a plan that was, when you boil it down, a really clever, modern version of bartering, a massive oil-for-equipment swap. It was one of those beautifully simple ideas designed to solve an insanely complicated problem.
Okay, so here's how the whole thing was supposed to work. Step 1, the bank's own engineers fly out to Siberia and figure out exactly what equipment is most urgently needed. Step 2, they go out and find that high-quality gear on the international market. Now, step 3 is the crucial part. Morgan Stanley promises to pay all the suppliers, no matter what. That gave those Western companies the confidence to do the deal. And in return, NNG pays Morgan Stanley back with shipments of crude oil, which the bank's traders then sell to make their money back and hopefully a profit. Simple, right? An elegant loop.
Well, simple in theory, maybe. Because the reality of actually doing this deal in post-Soviet Russia, that was a whole other ballgame. This is where the brilliant idea slammed right into a brick wall of bureaucracy.
I mean, these guys ran head first into just a mountain of red tape. The source material uses the word frightening to describe the level of paperwork. The whole system was still caught up in that old way of thinking, centralized state control. They even had meetings with top government officials. We're talking the prime minister, and even that didn't seem to clear the logjam.
And this number right here, this explains the single biggest roadblock they faced. At the time, Russian oil companies were legally required to sell 80% of their exports through one official state trader. Just think about that. It meant NNG only really controlled 20% of its own oil, which put a major cap on how big this deal could ever be.
And yet, for a little while, it actually worked. The idea itself was solid. By running these international tenders, Morgan Stanley was saving the Russian company anywhere from 15 to 40% on essential gear. The plan was a good one, but the ground was shifting under their feet. This was the era when the powerful oligarchs were starting to move in and take over the industry.
So, after a full year of fighting bureaucracy and watching the landscape get more and more complicated, the team had to make a really tough call. They decided to pull the plug. They'd made almost no money, and the risks to the bank's reputation were just getting too high. But hold on, because this is where the story gets really interesting.
So you're probably thinking, okay, so it was a failure, right? Well, take a look at this. The direct profit, the actual cash they made from this trade, pretty much zero, de minimis. But the strategic value, it was immense. The real win wasn't about the money they made on this one deal.
So what does immense value actually mean? Well, think about it. Because they were there, on the ground, they got a massive head start on everyone else. They set up a Moscow office way before their competitors even thought about it. They started building real relationships with the people who would go on to run Russia. And all that groundwork, it led to huge deals down the line, like advising the state oil giant Rosneft. But maybe the most valuable thing of all was what they learned. Priceless, hard-won lessons about risk that saved them from losing a ton of money when some of their rivals got burned later on.
And it all comes down to this really powerful question, doesn't it? That night flight to Siberia, it didn't make anyone rich overnight. But by showing up, by proving they were serious, by building those key relationships, and by learning how the country really worked, it paid off again and again for years. It really makes you think, what's the true measure of a successful deal? All right, today we are diving deep into the absolute Wild West that was 1990s Russia, a time of total chaos but also immense opportunity. We're going to break down one of the most brilliant and audacious trades of that entire era. It's a deal that used Cuban sugar to finance a massive Russian oil empire, and it was all engineered by one man with a truly revolutionary idea. And believe it or not, it all starts with a very, very strange flight.
Just to paint a picture of how wild things were, listen to this story from the architect of this whole deal, Philippe Curie. He'd paid 25 grand for a private flight, right? But after takeoff, he discovers the crew had secretly sold 170 extra seats to locals. I mean, that perfectly captures the unpredictable, anything-goes environment he was walking into. The rules were blurry, and for anyone willing to look, opportunities were absolutely everywhere.
And this is where our story really kicks off. It's 1993, and the French oil giant Elf Trading sends Philippe Curie to Moscow. What's his mission? Simple. Figure out a way to do business in the massive but completely mysterious oil market of the former Soviet Union.
Now look, Curie was no rookie. He was a seasoned oil trader who'd been climbing the ladder at Elf in Geneva. But Russia in '93, That was a whole different ballgame. In fact, he was the third person they asked to take the job. The first two said it was just too dangerous. But Corey, he saw the challenge as a once-in-a-lifetime opportunity.
So when he gets there, he doesn't just jump in and start making deals. No. He spent 6 entire months just going back to school, as he put it. He meticulously mapped out how Russia's oil system actually worked. Who owned the pipelines? When does the ownership of the oil actually transfer? Who's financing what? He was basically drawing a map of a system that, to the rest of the world, was a complete mystery. And in this deep dive, he uncovers this huge fundamental flaw right at the heart of Russia's oil business, a problem that was basically a high-stakes game of ruble roulette. So here's the breakdown. It's super simple, but it reveals this massive inefficiency. On one side, you have the final exporter, maybe a Western company, who gets paid immediately in stable, reliable US dollars. But on the other side, you've got the Russian company that actually pumped the oil out of the ground. They had to wait 90 days, sometimes longer, to get paid in rubles that were just hemorrhaging value due to inflation.
As Khoury himself said, the producers were shouldering all the risk. I mean, can you imagine? You produce millions of dollars worth of oil, and you have literally no idea what your payment will actually be worth in 3 months? It was a crippling problem. And right there, that's where Khoury saw his opening. He came up with a solution that was breathtakingly simple. But, and this is a big but, it required a massive leap of faith from his bosses back in Geneva. He was about to make a $10 million bet.
And let's be crystal clear, $10 million in the early 90s was a huge amount of money. It was like asking for $100 million today. He needed all that capital just to prove his theory, to run one single trial deal that he thought could change everything.
Okay, so here's the elegant logic. Instead of making the producer wait and worry, ELF would just prepay them, up front, in stable US dollars. This completely takes all the risk off the table for the producer. And in exchange for solving that massive headache, ELF gets the oil at a nice discount. The producer gets guaranteed money, ELF gets cheaper oil. It's a classic win-win.
The Russian producer was just stunned. They were so used to waiting around for their devalued rubles that getting paid in dollars up front just seemed impossible. The test was a huge success. Not only did they deliver the oil as promised, they were so thrilled they immediately offered ELF 3 more cargoes. Khoury had just proved his model worked.
But that $10 million success, that was just the warm-up. Khoury was already thinking bigger. Now that he had a working financial model, he aimed it at a much larger and, frankly, much weirder inefficiency in the post-Soviet economy.
This was the question he started asking. He'd found this bizarre barter system, a holdover from the communist era. Russia was physically sending tankers of oil all the way to the Caribbean, and Cuba was sending ships of sugar back. From a modern finance and logistics point of view, it made zero sense.
So Khoury decided to completely re-engineer the whole trade. Let's walk through this because it's a thing of beauty. First, instead of that oil going to Cuba, ELF buys it right there at the Russian port, paying the producer immediately in dollars with a short-term bank loan. Win number 1. Then, ELF just turns around and sells that same oil to a nearby European refinery for a quick profit and pays back that first loan. Simple. Now for the sugar. With the oil deal done, ELF uses a totally separate financing deal to prepay Cuban sugar producers. That sugar gets shipped, processed, and sold in Russia, where there was a huge demand for it, and the money from those sugar sales pays back the second loan. He basically replaced a silly physical barter with 2 separate, super efficient financial transactions.
So how did ELF actually make money on this whole thing? The secret ingredient is something called financial arbitrage. Think of it this way. For a Russian company back then to get a loan, their interest rate, their cost of capital, was a painful 10%. But a huge Western company like ELF, they could borrow from banks at just 4%. That 6% difference, that was pure opportunity. ELF could borrow cheap money, use it to make the trade happen, and just capture that margin as profit, all by being the trusted financial bridge between these 2 different worlds.
Of course, Khoury was smart enough to know ELF couldn't do this alone. I mean, they were oil guys, not sugar brokers. So what did he do? He built a coalition. He brought in giant agricultural trading firms to handle the sugar part of the deal. And he put together a whole syndicate of Western banks to provide the financing. It was their expertise and their top-tier credit ratings that made the whole complex machine run.
And the end result of all this financial engineering was, well, it was staggering. It completely changed how ELF did business in Russia, and it revealed a much deeper truth about what a commodity can be.
The results were just mind-blowing. By the middle of the 1990s, thanks to these prepayment deals, ELF trading was handling 10 to 12% of all Russian crude oil exports. Think about that.
In just a couple of years, they went from having zero presence to being one of the single biggest players in the entire market. What a journey, right? Khoury showed up in 1993 with, as he said, a blank piece of paper. 4 years later, he wasn't begging for money. He had a syndicate of 20 international banks lining up to back his trades. He built an entire empire on a foundation of trust and just really, really smart financial engineering.
And this really brings us to the core takeaway, a powerful idea from Khoury himself. He proved that oil, or really any commodity, doesn't just have to be a physical thing you consume. If you understand finance and you understand partnerships, you can use it as a kind of currency, a tool to unlock value, connect markets, and build something totally new. It really makes you wonder what modern, inefficient systems are just sitting out there today waiting for their own stroke of genius.
Today, we're going to pull back the curtain on the high-stakes world of oil trading. We're going to unpack how fortunes are made, not by trying to guess the future, but by absolutely mastering the present. This is the story of a legendary trade, a master strategist, and a brilliant insight into the very structure of the market itself.
So let's just start with a question that sounds, well, impossible. How could one single trading firm buy up an entire month's supply of a critical North Sea oil? I mean, it sounds like something straight out of a movie, right? But it actually happened. And the answer reveals this hidden world where physical barrels of oil meet financial paper contracts.
And the guy behind this incredible story is Kurt Chapman. This one quote, it's the key to his entire philosophy. See, his strategy wasn't about betting on whether oil prices would go up or down. Nope. It was about finding these profitable little gaps between the real thing, the physical oil, and the promise of the real thing, the paper contract.
To really get what made Chapman's strategy so powerful, you first have to understand his unique background, which put him right in the middle of these two colliding worlds.
What's so fascinating about his career path is the one-two punch of skills he picked up. He starts out on Wall Street at Morgan Stanley, deep in the world of financial derivatives. That's the paper market. But then he pivots. He goes to elf trading and learns the nitty-gritty of physical oil. Scheduling ships, managing storage, dealing with actual barrels. This dual expertise, it became his superpower.
So let's be super clear about this. Chapman wasn't a gambler. He was a master of arbitrage. And arbitrage is just a fancy word for finding tiny price differences between related things and profiting from them. He basically built his career by spotting those moments when the price of physical oil and financial oil fell out of sync, and then he'd place these huge strategic bets that they would eventually have to snap back together.
And in 2006, one of the biggest dislocations he had ever seen started to appear. Now, to understand it, we just need to quickly break down these two interconnected markets. Okay, so think of it this way. The physical market, called dated Brent, is for actual oil you can get your hands on right now, with a specific loading date. The paper market, or forward Brent, is a contract that just guarantees you'll get that oil at some point in the future. They're linked, for sure, but they are not the same thing, and that means their prices can drift apart. And this right here, this is the law of gravity for this entire trade. It's called convergence, and it just means that no matter how far apart the paper and physical prices get, as that delivery date gets closer and closer, they have to become one and the same. A promise of oil for next month eventually just becomes a barrel of oil today. Chapman's entire strategy was built on the absolute certainty of this convergence.
So back in 2006, the market was just swimming in oil, a huge oversupply. And everyone holding physical barrels was desperate to hedge their risk, so they started aggressively selling derivatives tied to dated Brent. This just hammered the price of physical oil, creating this massive gap, over $1 per barrel, between the super cheap physical market and the more expensive forward market. For Chapman and his team, this was the signal they were waiting for.
And what happened next? Well, it was one of the gutsiest trades the North Sea market had ever seen. A massive bet that the law of convergence would hold true.
And this just shows you the elegance of the strategy. It's actually incredibly simple in concept. Step 1, see that physical dated Brent is way too cheap. Step 2, buy it using derivatives. Step 3, sell the thing that's too expensive, in this case the forward Brent contract. And finally, step 4, you just wait for the market to correct itself and pocket the difference when the prices snap back together.
So they started building their position, totally confident in their analysis. They quietly accumulated a position that was equivalent to 20 million barrels of oil. I mean, that's a huge trade by any standard.
But the price gap, it didn't close right away. Still convinced they were right, they just kept buying.
At 30 million barrels, the risk was getting immense, even for a major trading house. The bosses at Mercurius started getting a little nervous, tapping them on the shoulder, suggesting maybe it was time to stop.
But then, the physical market got even cheaper, and they just couldn't resist. They doubled down. Their position swelled to a staggering 35 million barrels. At that moment, even they knew they had taken on enough risk. A huge chunk of the firm's capital was riding on this one single idea.
And then, it happened. The market turned, the prices began to converge, just like they predicted, and the trade became massively profitable. But the story doesn't end there, because this financial play had a very real, very physical consequence.
As part of the whole deal, they actually ended up taking physical delivery of a real cargo of oil. And because prices were so ridiculously low, it was actually profitable to ship this North Sea crude all the way down to their storage tanks in South Africa. A journey so unusual it has only happened a handful of times in history. It was like a physical trophy from a financial victory.
Okay, so that was 2006. Now let's jump forward 6 years to 2012. The market presented them with the complete mirror image of that opportunity. And because they'd already mastered the strategy, they knew exactly what to do.
This time the market was strong, demand was high. Physical dated Brent was now trading for more than the forward market. So what they did do, they just reversed the play. They sold the expensive physical stuff, bought the cheaper forward contracts, and waited for convergence. Simple as that.
The result of this reverse trade was even more stunning. Their strategy was so effective that they ended up taking delivery of nearly every single cargo of 40s crude oil for the entire month of December. They had answered that impossible question from the very beginning of our story. They actually did it.
When other traders asked them how in the world they pulled it off, their answer was just so simple but so profound, the market told us to do it. See, they weren't forcing their opinion onto the market, they were just listening to the structural signals it was sending them.
So, what's the big takeaway here? What can we learn from all this? Well, it wasn't magic, it was a methodology. It was a set of tools, really, built over a long and very experienced career. Chapman's entire strategy, the one that netted billions over his career, really just boils down to constantly asking these 3 questions. He was always monitoring the relationship between the physical and the paper worlds, always asking, how are these two related right now? Why are they drifting apart? And most importantly, when and how will they inevitably snap back into alignment? And that's the real lesson here, isn't it? Extraordinary success in these complex systems doesn't come from some crystal ball that predicts the future. It comes from deeply understanding the rules of the present, spotting when those rules are being bent, and then having the conviction to act on it.
So it kind of leaves us with a final thought. This principle doesn't just apply to oil. Every market, every system has a physical reality and then a world of expectations built on top of it. So the question is, where are the hidden gaps in your world, and what is the market telling you to do?
Okay, I want to tell you about a trade that was so clever, so completely out of the box, that it absolutely stunned the entire oil market. And this isn't just a story about making a quick buck. No, this is about seeing an opportunity that literally nobody else could, and then having the guts to pull it off.
So just try to imagine you're an oil trader back in 1998. The market is a total disaster, everybody is losing their shirt, and then suddenly, one company starts making these moves that make absolutely zero sense to anyone. This quote from someone who was right there in the thick of it just perfectly captures the confusion and honestly the chaos that this one small team managed to kick up.
Yeah, that is the billion-dollar question, isn't it? And to figure that out, we've got to rewind the clock, back to a time when the entire oil industry was, well, on its knees.
Right, so the stage for this whole incredible story is set during one of the worst oil markets in recent memory. And you really have to understand just how bad things were to appreciate the genius of what they did next.
I mean, the world was literally drowning in oil. Demand had totally collapsed, there was a massive oversupply everywhere you looked, and prices were just in a complete freefall. In an environment like that, just breaking even felt like a huge win. Actually turning a profit? That seemed impossible. And this timeline, it really shows you just how fast everything fell apart. First, the Asian financial crisis hits, and poof, demand just evaporates. Then, even OPEC tries to step in, but they can't stop the bleeding. By June, prices are at rock bottom, the lowest they'd been in a decade. This is the absolute mess our traders are walking into.
And into this chaos steps our guy, Adi Imsarovich,
and his trading team at Texaco. Their job was pretty simple on paper: keep their company's refineries supplied with oil, and somehow, against all the odds, try to make some money in a market where it felt like there was none to be made.
So what do you do when all the normal ways of doing things are guaranteed to lose you money? Well, you have to start thinking differently. You start hunting for an idea that seems, at first glance, completely and utterly impossible.
And this right here is the heart of their wild idea. So, on the left, you've got your standard ship. But on the right, that's a very large crude carrier, a VLCC. It's a floating behemoth, right? It's designed for these huge, long-distance journeys, like from Europe all the way to Asia, to take advantage of economies of scale. Using one for a short trip would be like using a freight train to go pick up a carton of milk. It wasn't done.
But that's exactly what Imservic proposed. He said, hey, why don't we bring one of these giants home, to our own refinery in Pembroke? It would slash their transport costs, but there was one very big, very real problem. The channel leading to the refinery was just too shallow for a fully loaded VLCC to get through.
The solution? They could dredge the waterway. But that came with a pretty hefty price tag, a $300,000 upfront cost. And that cost, that physical barrier, is exactly why nobody had ever even thought about trying this before. It was a line no one was willing to cross, until now. Okay, but paying to dig a deeper channel was only part one of the plan. Part two is where this story goes from just a clever logistics move to an absolute masterclass in messing with the market's head. This is the ultimate head fake.
So to get the head fake, you've got to understand something called a CFD. Just think of it as a way for traders to bet on where the price of oil is going without having to buy the actual gooey stuff. And in the terrible market of '98, everyone was convinced prices would keep falling. So the whole market was short, betting on that happening.
Okay, so check out this 5-step plan. It is brilliant. First, while everyone else is betting against the market, you secretly start buying up CFDs, betting the price is going to go up. Second, you make a very public announcement that you're booking a VLCC. Now, the market sees this and assumes only one thing: a massive amount of oil is about to ship far away, probably to the US or Asia. That creates a panic because it looks like the oversupply in Europe is about to shrink. That panic drives up prices and the value of all those CFDs you secretly bought. And then for the final step, you just sail the ship to your own refinery next door. It's what's known as a false arbitrage, a profit opportunity that looked real to everyone else, but was actually a complete illusion you created.
A plan like this looks great on a whiteboard, but actually pulling it off, with the entire market watching every single move you make, well, that took some serious nerves of steel. Let's see how they did it.
So as the Texaco team started quietly buying up 4 million barrels of these CFDs, the market started to notice, and the reaction was just total disbelief. People were calling them up, basically saying, "You've got to be kidding me. How can anyone be bullish in the worst market in a decade?" The questions just started flying.
So finally, they just told everyone the truth. We're chartering a VLCC. And you know what happened? The entire industry laughed in their faces. They thought it was this pathetic, obvious bluff to try and scare prices higher, because everyone knew it was way too expensive to ship oil out of Europe. This was the general feeling. Yeah, right, it's a bluff, a desperate move. Nobody believed for a second it was real, because they couldn't imagine a world where it made any financial sense. They were sure Texaco was just trying to talk up the market, not actually move a real ship. And then, Texaco confirmed the charter. They made it official, irreversible. The bluff wasn't a bluff. And the news just exploded. Absolute panic set in, as all those traders who were betting against the market had to scramble to cover their positions, which just pushed prices higher and higher and higher. The head fake had worked perfectly.
So the market is in an absolute frenzy, asking one simple question: where on earth is that ship going? The final act of this incredible play revealed an answer that absolutely no one saw coming.
So the ship didn't turn towards Asia, and didn't head for the US. After it successfully squeezed through that newly deepened channel, and I bet the operations team was sweating bullets watching that, it pulled right up to their own dock in Pembroke. The destination was home. The mystery was solved. And this is the absolute beauty of the whole thing. It was a perfect win-win-win. The refinery, it got a huge shipment of super cheap oil at a rock-bottom freight cost. The trading desk, they made a fantastic profit on the CFDs they'd bought before they sent the market into a rally. And the company as a whole, they got to celebrate a trade that added value from every conceivable angle.
Now, look, this wasn't some magic trick they could pull off every other week. It really required that perfect storm of a totally depressed market. You needed cheap oil and cheap shipping to make that initial $300,000 investment pay off. But for one brief, brilliant moment, they completely outsmarted everyone and created a trade route that had never, ever existed before.
It's just a fantastic story of logistics and market psychology, right? But it does leave us with a much bigger question. In any industry, not just oil trading, when are the conditions so tough, the normal path so clearly broken, that a crazy idea isn't just one of your options, it's the only way you can possibly win?
All right, let's get into a really fascinating story from the world of oil trading. We're going back to mid-2000s Russia, where one company found a multi-million-dollar glitch in the market. And it was a strategy so counterintuitive, it actually looked like they were losing money on every single trade. Now, just listen to this quote from the trader who was right in the middle of all of it. He said, they would sell oil for $7,900, buy it back for $8,100, and still make a healthy profit. I mean, that sounds completely impossible, right? It just breaks the #1 rule of business. Buy low, sell high. So that's the central mystery we're going to unravel here. How in the world did this team turn what looks like a clear loss into a massive gain? Well, the answer is pretty wild, and it lies in the strange disconnect within the Russian oil market at the time. Okay, so our story kicks off in Moscow with a company called TNK-BP. It was a joint venture formed back in 2003 that basically blended Russian oil production with a very Western BP style of aggressive trading. And that unique combination is exactly what let them see an opportunity that pretty much everyone else was missing. So here's the key. This whole thing wasn't about a single price for oil. The entire strategy, the whole reason it worked, was built on exploiting this bizarre inefficiency, this gap between two, you could almost say, parallel universes for oil pricing that existed at the exact same time in the same country. To really get how they pulled this off, you first have to understand these two separate worlds. See, on one hand, you had the global oil market, and on the other, you had Russia's own domestic market. And believe me, they played by completely different rules. And this chart really shows you the contrast. The international market was what you'd expect, right? Dynamic, volatile, priced in US dollars. But the Russian domestic market was totally different. It was priced in rubles, and, this is the crucial part, that price would get locked in, totally fixed, for 5 to 7 days at a time. This created this little window where it was completely disconnected from what was happening in the rest of the world. Now, at first, there wasn't much of an opportunity here. Russia just couldn't physically get enough of its oil out of the country. A major lack of pipelines and port infrastructure meant a ton of it was basically stuck, or landlocked. And naturally, that kept the price inside Russia really low. But then a couple of things changed, and they changed very, very quickly. And this is where that window flies wide open. A massive investment in infrastructure, plus a brand new government rule completely flipped the script and created the absolute perfect conditions for this incredible trade. You can see on this timeline just how fast it all happened. Before 2005, the market was kind of sleepy. But then, boom, new pipelines and ports come online, creating this huge export capacity. And right on the heels of that, the government brings in a new way of calculating the export tax. This was the final piece of the puzzle. And this right here, this is the glitch. The export tax, which is a huge part of the cost, wasn't based on today's oil price. It was based on the European price from 2 months ago. This created a massive and, more importantly, predictable lag between the real-time value of oil and the effective price you could get exporting it. TNK-BP realized that, in a way, they could see the future. So, this is where the team at TNK-BP has their big aha moment. They saw they didn't have to choose between the domestic market and the export market. They could actually play them against each other. Because of that tax lag and rising global prices, this really weird situation started happening. The price for oil inside Russia was suddenly way higher than the price they could get by sending it out through a pipeline. And we're not talking a little bit higher. We're talking $20, $30, even $40 per ton more. It was a giant flashing neon sign that the market was fundamentally broken. So they came up with this brilliant 4-step dance. First, they'd use that 2-month lag to basically predict the future export price. Second, they'd pull oil that was supposed to be exported and sell it into that higher-priced domestic market for a quick, easy profit. Third, They'd just sit and watch the global markets during that 5 to 7 day window where the domestic price was frozen solid. And fourth, and this is the genius part, if global prices suddenly shot up, they would buy oil back from the domestic market, even at that higher ruble price, and then flip it back into the export market for an even bigger profit. They had created a situation where they could win no matter which way the market moved. It was amazing. And as you can probably imagine, this kind of radical thinking drove the old-school operations guys completely nuts. I mean, they were used to stable, predictable monthly plans. The traders suddenly telling them to stop exporting oil must have sounded like pure insanity. But it was a very calculated and very profitable insanity. So the big question is, right, if this opportunity was so huge, why didn't every other oil company in Russia jump all over it? Why did this glitch stay open for almost 2 years? Well, it came down to 4 main reasons. First was fear, a big one. Rivals were terrified of losing their precious government export quotas if they didn't constantly use them. Then there was bureaucracy. Their plans were literally set in stone a month in advance. They were also locked into these really rigid long-term contracts for things like rail transport. But honestly, the biggest reason was just mindset. They saw the domestic and export markets as 2 totally separate businesses. They couldn't even imagine flipping oil between them. So, just how profitable was all this? Let's actually look at the numbers, because they are just staggering. On the very first trade they ever did using this strategy, they made around $40 per ton. Now, in a business where people fight tooth and nail over cents on the barrel, that margin is absolutely incredible. And once they scaled it all up, they were consistently making $5 million every single month, all from this one strategy. And this bar chart really puts it all into perspective. At the time, TNK BP's global partner, BP, thought a trade was good if it made about 50 cents a barrel. That's about $3.60 a ton. Meanwhile, at TNK BP, thanks to opportunities like this one, they wouldn't even look at a strategy unless it made a bare minimum of $10 per ton. It was a completely different universe of profit. This success, it drove their competitors insane. One rival actually accused them of being destructive to the market. But really, it's just because they couldn't possibly understand how TNK-BP was operating. They were playing chess while everyone else was still playing checkers. And that really brings us to a final thought. This whole glitch was created by bureaucracy, and it was spotted by clever human traders. It lasted for 2 full years. But it really makes you wonder, in today's world of high-frequency trading and AI, could an opportunity this huge, this obvious, ever survive for more than a few seconds?
Today, we're going to pull back the curtain on the world of oil trading. But this isn't a story about fancy algorithms or high-speed data. Nope. It's about human connection and how one company found a massive advantage where absolutely no one else was even looking.
Oof, that is a sentence that no trader ever wants to say. It actually comes from a group of very smart, quant-type Western traders in Russia. They thought they had the market totally figured out, made these deals they thought were brilliant, only to realize they'd completely missed the point and gotten outplayed by locals who understood the real game.
So what happened? Well, the Westerners were selling oil at what looked like a massive profit. But the market tanked, and the locals knew something the spreadsheets didn't. The state would probably step in and change the tax rules after the fact. So the locals waited. The state did exactly that. And suddenly, those brilliant Western deals looked incredibly foolish. It's the perfect lesson, right? Sometimes the most important information just isn't in the data.
Okay, so keeping that lesson in mind, let's turn to our main story. We're going back to the early 1990s, and we're talking about a German company called Viba Oil. For them, the most important place in the world was Libya.
Now, Viba wasn't just another company drilling for oil in Libya. They were deeply embedded. Sure, they had major production, but their real advantage, their secret sauce, was their incredible local relationships. They spent the time, they made the regular visits, they knew the people, not just the pipelines.
So while Viba is doing great, a bunch of other European companies are having a really tough time. We're talking about big construction firms, German, Swiss, Italian, building highways, hotels, you name it. They were doing fantastic work, but they kept running into this huge brick wall. They couldn't get paid in hard currency. No dollars, no Deutschmarks.
The solution their Libyan partners offered was, let's call it creative. They basically said, look, we can't pay you cash, but we can pay you in crude oil. Now, if you're the Libyan government, that makes sense. But if you're a Swiss company that builds luxury hotels, what on earth are you supposed to do with a few thousand barrels of crude? This payment was actually a massive headache.
But here's the thing. Where those construction companies saw a total nightmare, VEBA saw a golden opportunity. They were in the perfect spot to solve everyone's problem and create a whole new line of business for themselves in the process. The plan they came up with was just beautiful in its simplicity. So the construction firm gets paid in oil they don't want. VEBA steps in and says, we'll take that oil off your hands. Since VEBA was already shipping huge tankers of their own oil, they just added these smaller amounts to their existing shipments. Then VEBA paid the construction firm in the hard cash they wanted all along, minus a small service fee. It was a perfect win-win-win.
And this wasn't just a one-off deal. It became a whole new business for VEBA, a super reliable, profitable sideline. They literally turned a widespread industry problem into a steady stream of revenue, all because they saw a connection that everyone else was missing.
But wait, it gets even better, because this is where the strategy goes from smart to truly brilliant. That service fee, that was just the most obvious part. VEBA was actually tapping into several hidden layers of profit that made this business way more valuable than it looked on the surface. All right, let's look at the numbers. On a normal shipment, VEBA was lifting about 500,000 barrels of its own oil from Libya. Now that's a lot of oil, but it doesn't always fill a giant supertanker up to the brim. But now, by collecting all those little parcels from the construction guys, they could add another 100,000 barrels, sometimes more, to their shipment. And that extra volume, well, that was the key that unlocked everything else. Think about it. It costs a ton of money to charter a massive oil tanker. And the crazy thing is, it costs pretty much the same whether that ship is 80% full or 100% full. By topping off their tankers with that extra oil, VEBA slashed their shipping cost for every single barrel on that ship. So the profitability of their main business got a huge boost too.
And there was another cherry on top. See, VEBA got the oil from the construction firms based on Libya's official selling price. But when VEBA turned around and sold that same oil on the global market, they could often get a better price, a premium above that official price. So on top of the fee, on top of the shipping savings, they were often making a nice little trading profit on the oil itself.
So as you can imagine, VEBA absolutely loved this business. It was low risk, super profitable, and played right into their strengths. So the natural next question was, where else can we do this? They tried to copy and paste the model in other countries, but they quickly learned it wasn't some magic formula that worked everywhere.
And the difference couldn't be clearer. The model worked beautifully in Libya and later in Iraq, places where VEBA already had strong, established relationships and a high level of trust. But when they tried it in Egypt and West Africa, it was a total failure. They just didn't have those deep roots. As one trader said, it was just too complicated and too many people were trying to cheat us. The secret ingredient wasn't the deal structure, it was trust. That business in Iraq was successful for a time, but it was also incredibly dangerous. This quote comes from one of the VEBA traders, and it really gives you a chilling sense of the environment they were in, especially as the political situation was about to explode. And the end came incredibly fast. The business was humming along in 1990, but then Iraq invaded Kuwait, and everything changed overnight. The first Gulf War started, and the region became a war zone. One of the traders tells this insane story of a 1,000-kilometer taxi ride out through the desert, where a soldier with a machine gun just jumps in their car and starts firing out the window. It was chaos. After the war, sanctions came down, and VEBA's Iraq business was just gone. So after following this wild story of success, failure, and war, what's the real lesson here? In a world of trading giants, what was VEBA's actual lasting advantage? What did they know that nobody else did?
Well, it wasn't just one thing. It was this perfect mix of very human factors. They had a rock-solid reputation for being fair, they had those deep relationships on the ground, other international companies trusted them, and just as important, they were willing to get their hands dirty with these complex, niche problems that the bigger players just couldn't be bothered with. And this is so interesting, because it just completely flies in the face of the modern trend, right? The whole trading world is consolidating into these few massive companies that are all about scale, scale, scale. Then Bistori is this powerful reminder that there's still incredible value in a different path, in embracing complexity and solving messy, human-sized problems. Which really leaves us with this one last thought. VEBA's best, most creative trade wasn't based on some brilliant market forecast. It was based on solving a problem for people they knew, people they had a relationship with. And it just makes you wonder, in our own world, a world that's obsessed with big data,
How much value are we leaving on the table because we've forgotten the simple, powerful value of a handshake?
All right, let's get into it. Today we're diving into a really fascinating financial detective story from the high-stakes world of physical oil trading. It's an incredible masterclass in how just questioning the obvious can unlock millions of dollars in hidden value. This right here, this is the core philosophy of our story's protagonist, a trader named Manash Saha. It's this deep belief in analytics that turns what could have been just a routine sale into a real work of art. It's all about letting the data spark your imagination. So this whole trade we're about to dissect, it is built on this one powerful principle, arbitrage. Really, it's just the hunt for profit in those tiny little pricing gaps that exist all across a global market. It's not just about selling oil, it's about selling it in the absolute smartest way possible. Okay, let's dive into the mindset here. To really get this trade, you first have to understand the way these traders think. And it all starts with a simple but really powerful commitment. You have to question everything, even the trades you do over and over and over again. This right here, this is a crucial distinction. See, a marketer, they might find a good buyer and just stick with them. And hey, that's efficient, makes sense. But a proprietary trader's job, it's completely different. They get paid to constantly ask, is this really the best we can possibly do? They just refuse to get comfortable. So this brings us to the initial puzzle. The trading team had two separate cargoes of Brazilian crude oil that they needed to sell. And on the surface, it looked like two totally distinct and pretty straightforward deals. Let's break down this first plan. Okay, so cargo number 1 is 1 million barrels of Sepinhoa. It fits perfectly on a Suezmax tanker. That's a big, standard ship, and it's heading to China. Solid trade, right? But cargo number 2, that one's a bit trickier. It's 600,000 barrels of Albacora Leste. It has to go on a smaller, much less efficient tanker called an Aframax, which makes a long journey really uncompetitive. So the best bet seemed to be the closest big buyer, the U.S. Gulf Coast. Now, you might be thinking, why not just combine them? And they did think about that. But 1.6 million barrels is a really awkward size. It's what traders call no man's land. It's way too big for a Suezmax, which tops out around 1 million barrels. But it's too small for a very large crude carrier, or a VLCC. Using a VLCC would mean the massive ship would be sailing nearly a quarter empty, which is just horribly inefficient. So for the time being, they were two separate problems. But then, the market did what it always does. It changed. And this shift created the first little crack in that initial plan. And it forced the team to rethink their assumptions, especially about that second cargo. So what exactly happened? Well, demand for heavy crudes, like their Albacora Leste, suddenly surged all over the world. As prices in Asia started climbing, that long, expensive trip on that small Aframax ship started to look, well, almost viable. And this is the key thought process, right? If Asia is suddenly an option, then Europe, which is so much closer, has got to be an even better option. And that, right there, led to the first revision. Instead of selling the Albacora Leste to the US, they'd send it to their own refineries over in Europe. Now, this was a smart move, a great example of what we call a local optimal, making one piece of the puzzle as profitable as it can be. Honestly, most teams would have stopped right here, totally happy with the improvement. But this team, they weren't satisfied. They kept looking at the two trades, and they just had this feeling that a better solution was hiding just out of sight. They just couldn't shake the feeling that they were missing something bigger. And that's when they asked the game-changing question. Instead of just trying to optimize the pieces they already had, they thought, what if we could add a new piece to the board? Could a third trade somehow unlock even more value from the first two? This is that shift from just fixing a problem to completely redesigning the entire system. So their search led them to this, the Polvo cargo. And on paper, this thing looked terrible. I mean, it was a smelly, difficult grade of crude with very few buyers. And even worse, it was this tiny little parcel, just 350,000 barrels, which meant it would be incredibly expensive to ship anywhere on its own. This didn't look like a solution at all. It looked like just another problem. But this is where the magic happens. Because when the team saw this problem cargo not as a standalone deal, but as the missing puzzle piece, that is when they had their aha moment. The idea was brilliantly unconventional. They thought, what if we intentionally buy this difficult Polvo cargo and then we combine it with our other two, the Sabinois, the Albacora Leste, and the polvo, all loaded onto one single massive VLCC and then sent all the way to Asia. And this number right here is the linchpin. Just by shifting that 1 million barrel Sapania cargo from a Suezmax to the more efficient VLCC, they saved 75 cents on every single barrel. Now, that alone is a massive win, and it was the key that made this whole complex trade even worth thinking about. This slide just sums up the entire journey so perfectly. They started with two separate, pretty simple deals. They improved one of them for a better, but still separate plan. But that final step, that was a true leap in complexity and vision, combining 3 different cargoes into one single, unified, globally optimized trade. And here's where it all just clicked into place so beautifully. Add it all up. 1 million barrels of Sapanua, plus 600,000 of Albacora Leste, plus the 350,000 of that problem polvo. And what's the total? 2 million barrels. The absolute perfect, most efficient size for a VLCC. It was a mix of brilliant thinking and, as the traders themselves admitted, a little bit of luck that the loading schedules for all 3 just happened to line up. So what's the big lesson to take away from this incredible story? Well, it all comes down to the difference between 2 ways of thinking, striving for a local optimal versus finding the global optimal. This comparison really gets to the heart of it all. See, the initial plans were all about local optimization, making each individual trade as good as it could possibly be. But the final solution? That was all about global optimization. It recognized that a slightly less profitable trade on that one polvo cargo could unlock massive savings and profits on the other 2, creating a result that was so much greater than the sum of its parts. This quote from Manoj Saha himself really says it all. The team had found the best price for each cargo individually. Every single trade was, on its own, seemingly optimized. But when they asked if the combination was the best it could be, they realized they could do much, much better. So the lessons here are just so powerful, and they apply to so much more than just trading. It's about challenging the way we've always done it. It's about realizing that sometimes the key to everything is that problem piece, like the polvo cargo, the one that nobody else wants. And ultimately, none of this happens without incredible global teamwork to pull all those pieces together. And that leaves us with a final thought, really a question for you. It's so easy to optimize the individual pieces of our work or our lives, but this story challenges us to step back and ask a bigger, more important question. Are all those good little pieces really adding up to the best possible whole? It's a powerful question to ask, and the answer, well, it might just surprise you.
All right, let's dive into an incredible story. It's all about how one analyst, armed with just cold, hard data, saw a massive market crash coming when literally everyone else was looking in the complete opposite direction. So to really get it, you have to picture early 2014. Oil prices are just coasting above $100 a barrel. And this wasn't some temporary spike, This felt like the new normal. The entire industry was built on the idea that high prices were here to stay.
And this quote right here from Citigroup's Eric Rubenstein just says it all, doesn't it? The market's signal to oil producers was simple: drill more, pump more, forever. That was the consensus. There was just no end in sight.
But that's the billion-dollar question, isn't it? While the entire planet was betting on prices staying sky high, this one guy, Rubenstein, was looking at his spreadsheets and seeing a totally different picture. He saw that forever was actually right around the corner.
So the big question is, how did he do it? Was it some crystal ball, a lucky guess? Nope. It was a disciplined, 3-part framework that focused on what was actually physically happening in the oil market, not on the noise and the hype.
The whole thing was built on this one core philosophy: counting barrels. The idea is actually pretty simple, but it's so powerful. At the end of the day, oil isn't just a number on a screen, it's a physical thing. Someone has to deliver a real barrel of oil to a real buyer. And he believed that that physical reality is what ultimately drives the price, more than anything else. And here's his whole approach, laid out perfectly. Step 1, you count the physical barrels. That gives you your real supply and demand picture. Step 2, you have to factor in geopolitics, especially what OPEC is thinking. And step 3, you follow the money. Where are investors, the hedge funds, placing their bets? Well, by the second quarter of 2014, all 3 of these signals started flashing bright red. Okay, so the framework is set. Now let's get to the moment of truth, the prediction itself.
This is where the data started telling a story that almost nobody wanted to hear.
And here were the two smoking guns. First, Rubenstein wasn't looking at outdated government forecasts. He was looking at real-time data on industrial production. And it was showing that the global economy was hitting the brakes hard. At the exact same time, oil production, spurred on by those $100 prices, was still surging. Way more supply, way less demand. I mean, that's a classic recipe for a price crash, right?
And this just shows you how massive the gap was between the herd and what he was seeing. On one hand, you had the consensus view, demand is great, we need high prices to get more oil, and don't worry, OPEC will always step in to support the price. But his data was screaming the exact opposite. The economy is slowing, prices actually need to fall to stop the flood of oil, and OPEC? They secretly want prices to crash to squeeze out their new competitors in the US.
And then came the moment, August 2014. He's in a meeting with the client, and he just lays it out there. He told them oil was going to get cut in half, from over $100 all the way down to $50. Not just to slow things down, but to make it so painful to produce that companies would be forced to shut their wells. I mean, can you imagine hearing that back then? It was an absolutely insane thing to say.
Okay, so you've made this huge, contrarian call. You're completely alone on an island. Now what? Well, now comes the really hard part. You actually have to convince people that you're not crazy.
So his first stop was the fast money, the hedge funds. They love big, volatile moves. They were definitely intrigued, for sure. But a call this big, especially from the only bearish voice in the entire market, you better believe they went right back to their own desks to frantically run the numbers themselves.
Next up, he took this warning straight to the source, the oil producers. And this is where you see this incredible split. For some of them, this warning was a lifeline. They listened, they locked in their prices by hedging all their production, and they were able to ride out the storm that followed. Some even got stronger.
But then you had the other firms, the ones who didn't listen. They were overconfident, thinking, nah, we're strong enough to survive anything. A price drop will just knock out our weaker competitors. They were wrong. Dead wrong. The crash was so brutal, it smashed right through everybody's cost levels, and many of those same companies were forced to slash and burn just to stay alive.
So the call has been made, the warnings are out there. Let's take a look at how this whole thing actually unraveled.
And look, the path down was not a straight line. It never is. Right on cue, in November, OPEC confirmed his thesis, no production cuts. But all of 2015 was what he called choppy waters. You had these vicious rallies that would trick people into thinking the worst was over. Imagine trying to hold on to a short position through that. It would have been absolutely brutal.
And here's the kicker, the craziest part of the whole story. Rubenstein's call for $50 oil, the one that sounded so outrageous, well, it turned out to be too conservative. The market didn't actually find a bottom until it crashed all the way down to around $25 a barrel.
So why on earth did it fall so much further than even he expected? Well, a couple of things happened. First off, the U.S. shale industry was being rewarded by Wall Street for growth, not for profits, so they just kept pumping no matter the price. And on top of that, everyone got way more efficient. Production costs fell faster than anyone dreamed was possible. The market just had to keep pushing lower and lower and lower to find a price painful enough to finally turn off the spigots.
But at the end of the day, it all circles back to this. Rubenstein says the collapse was entirely predictable. It wasn't magic, it wasn't some lucky guess. He's basically saying, look, I'm not some guru. I just did the homework. It was the logical conclusion for anyone who was willing to do the rigorous work of counting the barrels.
And that really leaves us with one final big question. I mean, sure, this is a story about oil, but the lesson here is universal, right? In a world that runs on narratives, momentum, and hype, what is the actual value of just sitting down, tuning out the noise, and counting what's real?
You know, sometimes the worst thing that could happen to you turns out to be the very thing that saves you. Today, we're diving into the incredible story of a trader whose humiliating demotion, well, it became his secret weapon for surviving one of the biggest financial crises in history.
So, let's kick things off with a question that really gets to the heart of it all. Think about it. When the world is falling apart, when everyone is losing their shirt, how do you win?
All right, let's set the scene. Picture it. The year is 2008. The entire global financial system is in absolute meltdown. I mean, giants of the industry, names you thought were invincible like Lehman Brothers, are just collapsing. It was pure chaos. And you could really see this chaos, this craziness reflected in the price of oil. I mean, just look at this chart.
The volatility is just staggering. In July of 2008, crude oil hits this insane all-time high of over $147 a barrel. And then, just a few months later, it completely crashes down to around 30 bucks. This wasn't just a price swing, you guys. This was a financial earthquake. It absolutely wiped out fortunes. And yet, in the middle of all this wreckage, this financial carnage, one of China's biggest trading firms, Unipec, somehow managed to not just survive, but stay profitable. So you got to ask, how on earth did they do it? Well, the answer, believe it or not, comes down to the story of one man.
So let's talk about that man. His name is Cui Zhenqiu. And to really get how he pulled off this miracle in 2008, we've got to go back in time, back almost a decade, to a moment that nearly destroyed his entire career.
You know, Cui's early career was pretty much a textbook success story. He joins this trading firm, Unipec, and just climbs the ladder like crazy during China's big economic boom. His rise was fast, and he lands this really prestigious role as secretary to the president. He even called it his middle summit. He was comfortable, he was successful, he probably felt like he had it made.
And then, just like that, the bottom fell out.
So, what happened? In 1999, the president of Unipec gets fired, out of the blue. And Cui, just by being associated with him, gets this huge black mark on his record. He's demoted. And not just demoted. I mean, he goes from the president's office all the way down to the most basic job you can imagine, a record keeper. His new job was literally to sit and watch prices tick on a screen, and he had to write a report every single time the market moved by more than 20 cents, day or night.
I mean, this wasn't just a step down the career ladder. This was a public humiliation. But here's the crazy part. What started as a punishment, well, it turned into the most valuable education he would ever receive.
And Cui himself admitted it. He said this job was incredibly dull, that it was basically a punishment. His co-workers felt the company was just being nice by even giving him a job, just so he could feed his family. It was just a massive blow to his pride, to everything he'd built.
But, and this is the crucial twist in the story, by being forced to just sit there and watch the markets tick, day in and day out, he started to develop something you could never learn in a classroom. He got this deep, intuitive feel for the market's rhythms. He learned how to spot the subtle traps where other traders lose a ton of money. He developed this profound sense of volatility and risk. He was, in a way, learning in the shadows.
So after years of paying his dues, working in less glamorous roles like shipping, Cui starts to climb back. And this time he's armed with this completely unique, hard-won knowledge.
And then comes this absolutely shocking move. It's October 2007, and Cui gets nominated to be the head of crude oil trading. We're talking the most powerful, most prestigious trading job in the entire company. And get this, his very first day ever as a crude oil trader was as the boss of the whole department. Can you imagine? His new team was, of course, full of senior traders who were not happy about this at all, and they immediately started trying to test him.
But Cui, he was completely unshaken. He basically told his skeptical team, look, you guys solve your own problems for now. Give me 6 months, and I promise you I'll be able to give you even better solutions. Now, where does that kind of confidence come from? Well, he said it himself. His bad times, those years he spent in the basement watching the screen, they had built a kind of confidence in him that was just unbreakable. So now we're on the eve of the 2008 crisis. Cui is in charge, armed with this unique experience and this rock-solid confidence, and he immediately implements a strategy born directly from the lessons he learned during his fall from grace.
He laid down 2 rules, simple but absolutely ironclad. Rule number 1, no speculation, period. His team was not allowed to speculate on the outright price of crude oil. They couldn't just make these massive bets on whether the price was going to go up or down. Rule number 2, and this one was non-negotiable, never sell options. His traders were forbidden from writing or selling options, ever.
Okay, so why was he so against selling options? Well, think of it like this. When you sell an option, you get a small payment, a premium, right up front. That's your reward, and it's limited. But your risk is potentially unlimited. If the market makes a huge move against you, your losses can be absolutely catastrophic. It's a really bad bet.
And Cui had this amazing, kind of brutal way of explaining it. He said, selling an option gets you a finger, but maybe tomorrow you will lose your body. Wow. I mean, for him, the risk just wasn't worth the reward. It was completely out of balance. And that's a lesson he learned from watching trader after trader get totally wiped out. So, these two rules were simple, but they were incredibly effective. And they weren't just random restrictions he came up with. No, they were the practical results of a much deeper philosophy that Cui brought to the job.
And this right here is the ultimate secret. It's the ancient Greek wisdom, know thyself. Cui's core belief was that the most important starting point for any trader, for anyone in business really, is to clearly understand the true nature of the company where they work. Because a strategy that's genius for one company could be an absolute disaster for another. So what was Unipec's true nature? Well, it wasn't some hotshot hedge fund built to take on massive risks. It was the trading arm for a giant industrial refiner, Sinopec. Its main job, its whole reason for existing, was to source crude oil to keep those refineries running. The value it provided just by doing that was way, way bigger than any profit they could hope to make from some risky speculative trade. So, taking huge bets on price was fundamentally at odds with their entire mission.
And that really brings us full circle. Cui Zhenchu's story is this incredible lesson in how you can turn the worst moments of your life into profound wisdom. But his core principle, know thyself, that goes so far beyond the trading floor. It leaves us with a really simple but deep question for all of us. No matter what you do, whether you're a trader, an artist, an engineer, do you really understand the true nature of your work? And is your strategy, are your day-to-day actions actually aligned with that purpose?
Today, we're diving into a really high-stakes story from the world of physical oil trading. It's a world where a single deal can get rocked by global events, and where success, as you'll see, often comes down to a lot more than just the numbers. And this quote from veteran crude oil trader Ann Devlin, wow, it just perfectly sets the stage. This is a story about a crisis where literally everything that could go wrong did. It's a classic case of Murphy's Law just slamming into the oil markets. So, where does our story begin? Well, it starts with a deal that should have been completely routine. I mean, on the surface, this looked like a textbook trade. Here's the setup. Ann's team sold a standard cargo of Iraqi Kirkuk. It was loading from a port in Turkey and going to a Greek refiner. This was business as usual, you know? The buyer was only a few days away by sea, so the economics of it were simple and made perfect sense for everyone involved. But of course, the market, well, it often has other plans, doesn't it? A perfect storm was brewing, and this very routine trade was about to sail right into the middle of it. And here's the first domino to fall. Tensions between the Kurdish regional government and the central government in Baghdad just boil over, and they shut down the Kirkuk export pipeline. And just like that, boom, the oil supply is cut off. The cargo is stranded. And this is where the financial pressure starts to build fast. The ship they chartered is now just stuck, waiting, and it's racking up a daily late fee, it's called demurrage, of a staggering $60,000 per day. You can just feel the clock ticking, right? That bill is getting bigger by the minute. Now, as if that wasn't enough, at the exact same time, a second crisis erupts. The Greek debt crisis hits its absolute peak. The government shuts down the banks and imposes capital controls. So all of a sudden, Ann's own credit department is getting extremely nervous, asking one simple question: can our Greek customer even pay us? I mean, this is the trader's nightmare scenario. It's the classic double whammy. You've got a supply crisis on one hand where you can't even get the oil, and a financial crisis on the other where you're not sure your customer can pay for it anyway. The whole situation looks, well, it looks almost impossible. So, with pressure mounting from literally all sides, the Iraqi State Oil Company makes a legal declaration that completely changes the game. They declare force majeure. Now, this is a really crucial concept in contract law. What it means is that because of some unforeseeable and uncontrollable event, like this political shutdown, their obligation to deliver the oil is paused. It's not canceled, mind you, just suspended. And this right here perfectly illustrates the trader's dilemma. Legally, on paper, the force majeure offers some protection. Nobody's technically in breach of contract, but the commercial reality? It's a total disaster. The client's refinery is about to run out of crude, and that $60,000 a day shipping bill is still ticking upwards. So you're trapped between this legal stalemate and a full-blown commercial catastrophe. And then a solution appears from a completely unexpected direction. You know, sometimes you just get lucky. Anne gets a call from another department within her own company. Turns out a rare cargo of Egyptian crude, a type of oil that almost never gets exported, has suddenly become available, and it's ready to load just a couple of days sailing time from Greece. But hold on, this wasn't some simple, easy fix. Yes, it was perfectly located and available immediately, which was great, but it came with a perceived quality risk. And maybe even more crucially, it would mean doubling their credit exposure to that Greek buyer right in the middle of a national banking crisis. This was a super high-risk, high-reward move. So look, crack the door open. But saving this deal was going to take a whole lot more than that. This is where deep trust and some serious negotiation skills have to come into play. The solution wasn't just one single action. It was like this complex dance happening on multiple fronts all at once. First, Anne had to use her internal credibility to convince her own, understandably nervous, credit department to approve this new risk. Then, she's negotiating with the Iraqis to try and manage that absolutely massive shipping bill. And maybe most importantly, she collaborated with her Greek client, relying on a relationship that had been built over years of trust. And after some pretty vigorous negotiation on the price of the new Egyptian oil, the deal went ahead. They found a commercial solution where, let's be honest, a legal bottle would have helped absolutely no one. The client got their oil, the refinery stayed online, and a potential multi-million-dollar loss was totally averted. So what does this one single chaotic trade reveal about the entire industry? Well, it points to a really fundamental truth about how the world of physical commodities actually works. This quote really distills the core lesson of the entire crisis. In Anne Devlin's own words, trading physical commodities isn't just about spreadsheets and price screens. At the end of the day, it's about people. It's about building a network of trust that you can actually rely on when everything goes wrong. And this story leaves us with a fascinating question, doesn't it? In a world that's increasingly driven by algorithms and high-speed data, this crisis shows that when contracts get suspended and markets are in total chaos, the final, most valuable backstop might just be the trust you've built with the person on the other end of the phone. So when you think of an oil trader, what do you see? I bet it's someone glued to a wall of screens, surrounded by charts, just drowning in data, right? Well, today, we're going to pull back the curtain on the super high-stakes world of physical crude oil trading. And you're going to see why, in this age of so-called big data, the real winning edge might be something a lot more human. Right off the bat, this quote gets to the heart of it. We're not talking about clicking a button to buy some stock. No, this is about real, physical barrels of oil on gigantic ships sailing across the ocean. When a deal that huge can go wrong in a million different ways, you're not just betting on the numbers, you're betting on the person on the other end of that deal. That trust, it is absolutely everything. Okay, so to really get this new edge, we've got to understand the old one first. We are talking about a physical business. This means buying and selling actual cargoes of crude oil that have to get from point A to point B. And the scale of these deals, well, it's just mind-boggling. Yeah, you're seeing that right. We're talking anywhere from 600,000 to 2 million barrels of oil in one single transaction. This is not like clicking buy on some app on your phone. It is a massive, complicated, logistical puzzle. And for decades, the best traders all used the same playbook to try and solve it. And that classic playbook is called fundamental trading. The best way to think about it is like being a weather forecaster, but for the global economy. You're not looking at today's temperature. No, you're analyzing these huge global systems of supply and demand to predict if a hurricane is coming 6 months from now. The whole game is to place your bet on that long-range forecast. But here's the twist. That traditional big picture approach, it's starting to break down. See, traders today are facing a totally new kind of problem. They're not starving for information anymore, they're drowning in it. I mean, just look at the difference here. A veteran trader like Sylvia Lowe talks about how she started her career by literally translating Chinese websites by hand, hoping for just one tiny clue. And now traders have real-time satellite data showing every single ship on the ocean. But here's the catch. For every satellite photo that suggests demand is going up, there's a pipeline report that suggests it's going down. More data hasn't given us more clarity. It's just created more noise and this constant tug of war between conflicting signals. And that leads to some pretty serious problems. With all these data points, you can always find some that are bullish, pointing to higher prices, and others that are bearish, pointing to lower prices. So how do you build enough conviction to risk millions of dollars? It's incredibly hard. Plus, the market just moves way too fast to process it all. You end up with a classic case of analysis paralysis. You're just frozen. And this quote from Sylvia Lowe just nails it. It's the perfect way to sum up the problem. You know, if data is your master, you're always chasing it, reacting to every little blip. But if data is your servant, you're the one in control. You get to decide what information actually matters. And this forces a huge shift in strategy. It's about stopping, taking a breath, and instead of trying to see the entire forest, you start looking very, very closely at individual trees. And that brings us to this new approach, going micro. Instead of getting lost in that giant forest of global supply and demand, the sharpest traders today are focusing on the individual trees, those small, often overlooked details that can actually tell a much bigger story. So what does going micro really mean? Well, it's about shifting your focus. Instead of asking why prices should move based on the big picture, you start asking how prices are actually moving right here, right now. You become a detective. You're on the hunt for those tiny, out-of-place clues, the little anomalies that signal a big shift is coming before anyone else has a clue. So let me walk you through how this actually works. A trader spots something weird, an anomaly, a tiny blip on the radar. Let's say a certain Asian refiner buys a type of crude oil they never buy. That's your first clue. So now, the detective work starts. You get on the phone, you start asking questions. Why did they do that? You're looking for what they call an inflection point, that first domino in a chain reaction. And if you find it, you don't hesitate. You make the trade before the rest of the market even realizes that first domino has tipped over. And this is it. This is the million-dollar question you have to answer in that exact moment. You saw the signal. The price ticked up just a tiny bit, maybe 5 cents. So, is that it? Did you miss it? Or are you standing at the very beginning of a huge 20-cent rally? Making that call, that's where the real skill is. Now, this doesn't mean that traders just throw the big picture out the window. Not at all. The really smart ones, they don't choose between macro and micro. They bring them together. Let's look at how these two pieces of the puzzle fit. Think of it like this. The big picture macro analysis, that's your map. It gives you the context, the general direction of where you should be heading. It's the why. But that micro clue, that's your GPS. It tells you the exact moment to make a turn. It's the when. You need both. Your map is pretty useless without knowing exactly when to turn, and your GPS is useless if you don't even know where you're trying to go. So why is this shift to micro-trading happening right now? Why is it so important? Well, it's because that traditional space where traders used to make their money, it's shrinking, fast. The market as a whole has just gotten a lot smarter. Just think about it. It used to be that oil producers would give traders some wiggle room on things, like loading dates. This gave a clever trader some valuable flexibility, what they call a free option, that they could turn into a profit. But those days, they're gone. The producers are now playing the game just as shrewdly as the traders. They've built their own storage, they can reroute ships in the middle of a voyage, they've closed all those profitable little loopholes. The easy money has dried up. So this is really the key takeaway. If all the old advantages are disappearing, what's the new one? Sylvia Lowe says it perfectly. Before you trade oil, you need to trade information. That, right there, is the core of a modern trader's job.
And let's be clear, trading information isn't about having the fastest computer or the biggest data set. No, it's about building relationships. It's about picking up the phone and talking to other people in the market to see if your theory holds water. It's about understanding what they need so you can find a deal that's a win for everybody. It's a deeply, deeply human process.
And that brings us right back to where we started, doesn't it? In a world that is just saturated with data, where algorithms are tracking every single move, maybe the ultimate competitive advantage isn't a faster computer chip. Maybe it's a stronger network. In the high-stakes, high-tech game of oil trading, it turns out the most valuable asset of all might just be a simple human connection.
Welcome to The Explainer. Today, we're going to dive into a pretty wild story, how oil trading went from this risky free-for-all to a game that's really only played by the giants. And we're getting this from the inside scoop of a 40-year industry vet.
So, to really get a handle on today's oil market, which is super consolidated, we've got to go back, way back to the 1980s. And this quote, it just perfectly captures the vibe of the era. I mean, we're talking high-stakes gambling, insane displays of wealth, and fortunes that could literally disappear overnight.
Yeah, the 80s, that was the golden age for the small, nimble, independent oil trader. It was just an explosion of activity, a real Wild West. And you know who made it all possible? The banks. They were handing out what felt like almost limitless financing.
Okay, just look at the difference here. It's night and day, right? On the left, that's the 1980s, a total chaotic mess where a single tanker of oil could change hands, get this, up to 40 times before it even got where it was going. And now look at today on the right. It's this clean, straight line with just a few big players. The market basically went from a crowded, bustling party to a very exclusive, members-only club.
So, what was the secret sauce? Well, the key thing to understand is that the banks weren't really betting on the traders themselves. Nope. They were betting on the deals. If a trade looked good on paper, boom, the money flowed. And that's exactly how, a few people in a tiny little office could suddenly be managing credit lines worth billions of dollars. It's kind of nuts when you think about it.
But what happens when that paperwork doesn't quite match up with reality? Well, the banks were about to get a very rude awakening. They were exposed to risks they hadn't even thought of. So let's look at one deal in particular that really shows just how shaky this whole system was.
Okay, try to imagine the sheer panic setting in at the bank, right? They think they financed a simple, straightforward shipment, North Sea to the Mediterranean. Easy. But here's the thing. Back then, there was no GPS tracking for ships like we have today. They were basically flying blind. And then, all of a sudden, they get word that their collateral, the oil, isn't even in Europe anymore. It's been rerouted to a refinery in Sudan, and there's absolutely no clear way for them to get their money back.
So the big question is, how did the bank ever get paid? Well, the solution was, let's just say it was creative and very risky. The trader actually bartered the oil for Sudanese cotton. Then they had to wait for the harvest, export the cotton, and then they could finally repay the bank with the money they made. Just think about that for a second. The bank's loan went from being secured by oil to being secured by the success of a cotton harvest in a pretty unstable part of the world. That's the kind of crazy hidden risk that was just baked into the system.
Now that Sudanese cotton deal was a really close call, but it was just one little crack in the dam. By the late 80s, those cracks were starting to spread, and spread fast. A whole wave of fraud and just spectacular failures was about to come crashing down on the industry, and it threatened the very foundation of how global trade was financed.
And then, the bombshell dropped. In 1991, a trading firm called Gulf International completely collapsed, and it took over $1 billion with it. The loss was so massive, so catastrophic, that it single-handedly took down its main lender, the Bank of Credit and Commerce International. You might know it as BCCI. It became one of the biggest banking scandals of the time.
And BCCI was not an isolated incident, not at all. It was more like the first big domino to fall. A whole series of collapses just rippled through the industry. Big-name players went bankrupt, banks lost hundreds of millions of dollars, and some executives even ended up in jail for fraud. The whole financial world basically got the memo. The Wild West days were officially over.
I mean, the financial carnage was just too huge to ignore. We're talking billions lost, reputations totally destroyed, so banks and regulators had to scramble to get control of the situation. That whole era of easy money and, frankly, blind trust in oil trading, it was about to be slammed shut. For good.
The reaction didn't happen overnight, but when it came, it was decisive. First, the banks started tightening up their own lending rules. Then, they closed this really big loophole where traders could get different lines of credit from different branches of the same bank. But the real nail in the coffin for the old way of doing things? That came from a whole new set of global banking regulations.
Yeah, these things called the Basel Accords, they totally rewrote the rulebook for the banks. All of a sudden, to finance an oil trade, a bank had to keep way more of its own money in reserve. So what used to be a really profitable, pretty low-risk business for them, well, it became super expensive and capital-intensive. And just like that, the incentive for banks to finance those small, independent traders, it pretty much vanished.
And what happened next? Well, as a result, a lot of the original pioneers of this business, they just walked away. We're talking giants like Paribas, Chase Manhattan, Bank of America. They were the big dogs, and they just retreated from the market, leaving this huge vacuum behind.
Now, this massive retreat by the banks, it didn't stop oil from flowing around the world, of course, but what it did do was fundamentally and permanently change who was even allowed to play the game anymore. So today's market, it's basically a walled garden. It's completely dominated by a very, very small group of players. You've got the huge asset-rich companies, the oil majors, the trading giants that can get these massive corporate credit lines. Or a lot of the time, they just fund the trades themselves with their own cash. And you see that tiny little sliver on the chart for the smaller guys, yeah, that's pretty much all that's left. It's almost nothing.
This table really lays it all out, doesn't it?
The revolution in a nutshell. The price of admission to the oil trading game isn't a clever deal on paper anymore. No, it's a billion-dollar balance sheet. That old system of financing one cargo at a time, it's gone. It's been replaced by these enormous corporate credit lines that are only for a tiny select group. And that's changed everything, not just who gets to trade, but how the whole market works.
So, think about it from the perspective of a small or mid-sized trader today. Let's say you've got, I don't know, $50 million in equity. Trying to get financing for a single cargo of crude oil, it's pretty much impossible. Not unless you have a huge private equity firm backing you. The few banks that are still in this business, they're laser-focused on servicing their biggest, most important clients. That's it. So after this whole 40-year journey, there's no doubt the system is more stable. It's definitely a lot less risky for the banks. But it does leave us with one final big question to think about. By building these fortress walls to keep all the risk out, have we also ended up locking out the very competition and energy that made the market so dynamic in the first place? It's something to chew on. Thanks for joining me for this explainer.
You know, in the high-stakes world of oil trading, fortunes are made and lost on razor-thin margins and split-second decisions. But what really separates a good trader from a truly great one? Well, today, we're going to dive into the mindset of a master trader and see how one simple question can unlock million-dollar deals.
And this, right here, this single sentence is the entire philosophy of Alessandro Liberati, a veteran trader who basically built his career on turning really complex problems into profitable opportunities. It's a mindset that just refuses to accept the status quo. It actively looks for a way to say yes when pretty much everyone else is screaming no.
So, what does this why not philosophy actually look like when the rubber hits the road? Well, it's really the core difference between the slow, careful, bureaucratic machinery of a corporate giant and the fast, agile, results-obsessed approach of an independent trading house.
To get the philosophy, you really have to get the man. Alessandro Liberati spent a whopping 25 years at the Italian oil major Eni. Then he moved over to an independent trading house, BB Energy. This gave him this incredible perspective from both sides of the fence. See, he doesn't see trading as just buying and selling. For him, it's a service, a one-stop shop for solving literally any problem a client might throw at him.
This really just captures the two different worlds Liberati lived in perfectly. At a big company, a new idea often just hits a brick wall of no's from all these different departments. But for an independent trader, the whole conversation is flipped on its head. The question isn't, hey, can we do this? It's, okay, give me one good reason why we shouldn't do this. It's a subtle shift, but wow, it is powerful.
Okay, so let's see this philosophy in action with a real-world example, and this is one of the most creative trades of Liberati's entire career. The setting? Libya, right after a period of major disruption.
The year is 2012, and Libya was a market that most of the big players were avoiding. I mean, it was just seen as way too risky, too unstable. But where everybody else saw risk, Liberati saw an opening. He knew that the best opportunities are often in the places that aren't so crowded, so he decided to take a chance on a spot cargo of Libyan crude.
But, of course, there was a huge problem. Because Libya had been out of the market for a while, its official selling price, the OSP, was completely disconnected from reality. I don't know if it was national pride or just misreading the market, but they set the price way too high. That made the oil almost impossible to sell without taking a pretty big loss.
And how big are we talking? Well, Liberati was staring down the barrel of a loss of about $1 for every single barrel in that cargo. On a standard tanker, that adds up to a massive financial hit. So yeah, the pressure was on to find a buyer and find one fast.
He talks about this feeling of nervousness just creeping in. The market wasn't biting, and that potential loss was starting to feel very real. And then, just when things looked their bleakest, a lifeline appeared, an offer from a Mediterranean refiner. And it was a good offer too, one that would actually turn a small profit.
But, you know, in trading, nothing is ever that simple. The solution very quickly turned into a brand new, even more complicated problem. And just like that, the deal was on the brink of totally collapsing. It turned out the buyer, this Mediterranean refiner, was having some serious financial problems of its own. So while they were willing to pay the high price for the oil, their shaky finances introduced this huge new risk. It wasn't about the price anymore, it was about whether the buyer could even pay at all. Okay, so here's the crucial point. Liberati's own bank, the one financing his operations, took one look at the refiner's books and said, absolutely not, no way. They refused to provide any credit to the buyer. And without that financing, the oil couldn't be sold. The deal was about to fall apart, and that $1 per barrel loss was suddenly right back on the table.
So here's the question, right? The bank says no, the buyer's in financial trouble. Is there any way to save this deal? For most traders, the answer would be a simple no. You just cancel the deal, you take the loss, and you move on.
But this is where that why not philosophy really kicks in. Instead of just giving up, Liberati started thinking way outside the box, looking for some kind of truly unorthodox solution that could make everybody happy.
And the solution he came up with was just sheer elegance. Let me walk you through it. Okay, step one. Liberati signed an agreement to rent storage tank space at the buyer's refinery at no cost to him. Step two, he discharges his oil into that tank, but, and this is the absolute key, he kept full legal ownership. Step three, the refiner would pay him in full for the oil 1 day before the ownership was set to transfer. And only then, step four, after the money was safely in his account, would the formal title be transferred.
This structure was genius. It was a total win-win. Liberati was protected because he got paid before giving up ownership of his oil, so his bank was happy. And the refiner was happy because they basically got the oil delivered right to their doorstep days before they had to pay, which really helped their cash flow problems.
This incredible story isn't just about one clever deal, though. It's a perfect case study for the fundamental differences in culture, risk, and of course, finance between the independent trading houses and those giant oil majors.
So apparently some of Liberati's colleagues were complaining about all the extra paperwork this complex deal was creating. And his CEO's response was just simple and powerful. This quote right here, it just shows you that supportive, can-do attitude that empowers traders at independent firms. It's a world away from the chorus of no's he probably would have gotten at a major.
But there's another side to this coin. Independent traders, they live and die by their access to finance. Unlike the oil majors, who are just swimming in cash from their production and refining operations, independents rely almost entirely on banks to fund their trades. This makes managing finance their absolute #1 priority.
And the scale of that finance is it's staggering. Let me put it in perspective for you. Pre-financing a single large cargo of 2 million barrels, let's say at a modest price of $50 a barrel, that requires an initial layout of $100 million. That's a Super Bowl ad budget just to get one ship loaded with oil.
Now let's scale that up. Let's say you want to secure a steady supply. Lending a producer $500 million in a pre-financing deal, that gets you just 5 cargoes. That's it. $500 million gone after just 5 shipments.
So the barrier to entry is immense. As Liberati points out, in the crude oil market, producers won't even waste their time talking to you unless you can bring at least $500 million in financing to the table. It is a high-stakes game played with absolutely enormous sums of money.
So what's the ultimate takeaway from Liberati's incredible story? It's this powerful piece of advice right here. Luck isn't just something that happens to you. It's something you create. By being in the market, by solving problems, by being creative and willing to help, you put yourself in a position where opportunities and luck can find you.
And that leaves us with a final thought. Liberati's story is from the world of crude oil, sure, but his philosophy is timeless. As the world transitions to totally new forms of energy, the landscape is full of new challenges and uncertainties. So the question for the next generation of traders and innovators is, what new markets are being ignored right now, and what creative solutions are just sitting there, waiting for someone to ask, why not?
Okay, picture this. It's London, sometime in the early 1980s. A big corporate Christmas party is going strong. But back at the office, one single oil trader is stuck, all alone, staring down a multi-million-dollar problem. Now, this isn't just a story about a really, really bad night at work. Oh no. This is the story of a trade so high stakes, it basically signaled the end of an entire era for the global oil market. And this is her. Meet Liz Bosley, a young crude oil trader for the British National Oil Corporation. You'll hear me call it BNOC. So while all her coworkers are clinking glasses and celebrating, she's about to face the single biggest challenge of her career. And the scale of what she was up against, well, it was just staggering. 6. She had to sell 6 entire cargoes of North Sea crude oil, and she had to do it in one night, into a market that was already weak. So you have to ask, how in the world did she end up in such an impossible situation? Well, to get that, we need to take a step back and understand the wild world she was operating in. So, yeah, it all starts with her employer, the British National Oil Corporation. Now, in the early 80s, BNOC wasn't just another oil company. It was this uniquely powerful and, as it turns out, uniquely troubled arm of the British government itself. You see, BNOC had some serious muscle. It was in charge of marketing the government's entire share of North Sea oil, collecting royalties directly. But here's the thing. It also had the right to buy up even more oil from private producers. This was called participation oil. And this was the key. Because in a national crisis, BNOC could literally divert all that oil for the UK's own use, making them the absolute gatekeeper of the country's energy security. But as you can imagine, all that power came with a very hidden and very, very expensive problem. And that problem, it was all about the price. You see, BNOC was totally stuck between what was politically convenient and what the market was actually doing. And that conflict is exactly what came to a head on the night of that Christmas party. BNOC set something called the BNO negotiated price. Now, for some pretty sensitive political reasons, they couldn't just come out and call it an official selling price, or OSP. But let's be real, that's exactly what it was. And here's the real kicker. This official price was only set once every 3 months. In the oil market, 90 days is an eternity. Anything can happen.
And this is where it all gets tricky. You see, BNOC was supposed to sell its oil using these long-term term deals, locked in at that fixed quarterly price. But the real market, the fast market, was moving towards spot deals. These are flexible one-off trades where the price is set right there on the spot. So whenever that official price and the spot price drifted too far apart, yeah, BNOC had a huge problem.
And that is exactly what happened. The government, sometimes because it didn't want to undercut OPEC, would keep that official price artificially high. So by the end of this particular quarter, BNO's negotiated price was just way, way too expensive. Nobody was buying. They were suddenly sitting on this massive surplus of oil that absolutely had to be sold before the quarter officially ended. And this is the giant mess that landed right on Liz Bosley's desk. Right, so how do you even begin to solve a problem like this? How do you sell 6 entire cargoes of oil in just a few hours? Back in the 1980s. I mean, forget about algorithms and Bloomberg terminals. This was a world of telephones, Rolodexes, and just pure raw hustle. The whole process was just a masterclass in old-school trading. First, secrecy was everything. If the market got a whiff that BNOOXC was desperate to sell, the price would just collapse. So Liz had to work the phones super discreetly, calling up refiners, trading houses, anyone who might buy. She used brokers to help find homes for the oil, and every single deal was a fixed price, a final, completely unhedged bet. And get this, once a deal was struck, it wasn't confirmed with an email. It was confirmed by sending a physical message on a telex machine. It was just frantic, nerve-wracking, high-stakes stuff. And while she's doing all of this, her colleagues are at the Christmas party with a very specific job. Act like everything is totally fine. They had to give the impression that all their oil was sold and the market was in great shape. Liz actually volunteered for the job. But as she puts it, she felt a little bit like Cinderella. You know, left behind to do the impossible while everyone else was off at the ball. So against all odds, Liz's marathon trading session actually worked. But the story doesn't end there. Not even close. The most revealing part of the whole night was still to come, long after the deals were done. She did it. She actually moved all 6 cargoes. And crucially, she sold them at prices that, okay, were below the official government rate, but they were a true reflection of what the actual market was willing to pay. It was an incredible win for BNOC, pulled off in total secret. Or so she thought. When Liz finally made it to the party, she was completely shocked. Everyone already knew. They knew she'd sold 6 cargoes, and some of them even knew the details of the individual deals. You see, every trade confirmation she'd sent was marked P&C for private and confidential, but in the leaky rumor mill world of 1980s oil trading, P&C had an ironic little nickname, Publish and Circulate. This one crazy night wasn't just some dramatic story. It was a huge signal of a fundamental shift in how the entire global oil market was about to work. It basically put a giant spotlight on the tension between this old, rigid system and a new, flexible one that was just about to take over. I mean, the world Liz was working in is almost unrecognizable today. Deals confirmed by a clunky telex machine are now instant and digital. Her risky, unhedged fixed-price bets have been totally replaced by complex formulas where you can manage your risk with futures contracts. That secret and leaky flow of information has given way to a world of supposed transparency. And the key market itself has evolved from a simple 15-day Brent market to the massive BFOTET futures market, which stands for Brent, Forties, Oseberg, Ekofisk, and Troll, the main oil fields that now define the global benchmark. And those same pressures that forced Liz into that all-night trading session, they're the same pressures that would ultimately destroy her company. By 1985, BNOC was still being forced to buy oil at an artificially high price, but it couldn't sell it for that much. The company was just hemorrhaging cash, and so Prime Minister Margaret Thatcher's government simply shut it down. And here's the stat that really puts it all into perspective. When Liz was making those frantic spot deals, they only accounted for about 10% of the entire global market. The vast majority, 90%, was still sold on those rigid, long-term contracts. So her secret, crazy night of trading wasn't just her solving a problem. It was literally a glimpse into the future of how all oil would one day be traded. It really leaves you with a fascinating question, though. Liz's private and confidential deals spread like wildfire through whispers at a Christmas party. Today, sure, we have encrypted messages and secure networks, but we also have social media and instant global communication. In our hyper-connected world, is a secret really any safer, or would it just get published and circulated faster than ever before?
Today, we're diving deep into a story about how one person's vision just completely rewrote the rulebook for trading oil inside Russia. This is a fantastic story about challenging the way things have always been done, not just with a new idea, but with a whole new structure.
And that's the voice of our central figure, Elena Lobodina. And that quote right there, it's the key to this whole thing. See, it wasn't about just being smarter or outworking everyone. It was about tearing down the old system and rebuilding it from the ground up. This is a story about two things, mentality and structure.
So our story kicks off in 2005 at the Russian oil giant TNK BP. And their biggest problem, it wasn't a competitor, it wasn't the market, it was themselves. The problem was coming from inside the house. Okay, so picture this. You've got two groups of traders, the domestic team and the international team. And they're sitting literally right next to each other. But they might as well have been on different planets. They barely spoke. Now, part of it was a language barrier. Sure, the domestic team spoke Russian, the international team spoke English. But the real divide, it was much, much deeper than that.
And here you can see the problem in black and white. The two teams had completely different report cards, totally different goals. The domestic team, their whole job, their bonus, was based on beating the local Russian price. The international team, though, was measured against global prices, like Brent crude. They weren't working together, they were actively competing for the very same barrels of oil for completely different reasons.
The situation got, and this is in Lobodina's own words, quite ridiculous. So you could have a domestic trader fighting tooth and nail for some oil because they could flip it for $5 over their local benchmark. For them, personally, that was a huge win. Ding, 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 bonus time.
But here's the crazy part, the paradox. While that trader is getting high fives for their $5 win, the international team might have had to say no to a deal at a much higher price just because it was a tiny bit below their global benchmark. So the individual trader wins, but the company, TNK BP as a whole, actually loses. The whole structure was just broken.
Which leads you to this really fundamental question, right? When your incentives are all tangled up like this, who are you really working for? Are you trying to make your own bonus bigger, or are you trying to maximize the company's profit? Well, at TNK-BP back in 2005, the answer was pretty clear, and it was a massive problem that had to be fixed.
So how do you fix a culture that's so fundamentally broken? You don't just give a speech about teamwork. You have to re-engineer the whole machine. And that's what this next phase was all about, uniting the teams and, even more importantly, changing how everyone in the company thought about their job.
So they had a plan, a deliberate three-step plan. First, smash the two warring teams together into one unified group. Easy enough. Second, and this is the absolute key, they created a single bonus structure. All of a sudden, everyone was playing the same game, measured by the same ruler, all aiming for one goal: make the most money possible for TNK-BP. And third, they had to go out and sell this new trading mindset to the entire organization.
And let me tell you,
This was not an easy sell. This quote from the head of refining, it just says it all, doesn't it? The trading team was now going to other departments and asking them to do things that seemed completely backward, all because the traders were now seeing the business as one big interconnected system of profit and loss. I mean, just imagine having these conversations. Imagine going to your head of refining, a guy whose entire career is about, well, refining oil, and telling him, hey, I need you to actually stop refining today because we can make more money just selling the raw crude oil. Or telling the retail guys to ship all their stored gasoline overseas instead of selling it at their pumps. It took a ton of time just explaining the why to get everyone on board, but man, was it worth it. Okay, so with its own house finally in order, TNK-BP was ready for its biggest move yet. They weren't just going to change themselves anymore, they were going to change the entire Russian oil market. They were about to introduce an idea that was totally normal everywhere else in the world, but in Russia, it was unheard of.
This big idea was the floating price contract. Now, before this, every single oil deal in Russia was done on a fixed price basis. You'd agree on a price in rubles per ton, shake hands, and that was it. A floating price, though, is totally different. It links the price of your deal to a global benchmark. So as the world market goes up or down, your price moves right along with it.
Now, a fixed price, it feels safe, right? It feels predictable. But in a crazy, volatile market, it is a massive gamble. You could lock in a price today that makes you look like a genius or a fool tomorrow. A floating price, on the other hand, embraces that volatility. It helps both the buyer and the seller manage the risk, because everyone's playing by the same rules, the market's rules. And get this, check out how fast this whole thing took off. In 2005, the market was 100% fixed price. Just 2 years after TNK-BP introduced this new idea, it was already becoming the new standard. This shows it wasn't just a good idea, it was the perfect idea for that exact moment. The market was starving for this, even if it didn't know it yet.
And that perfect moment was about to be put through the ultimate stress test, because looming just around the corner was one of the biggest economic earthquakes in modern history, the 2008 global financial crisis.
I mean, just look at this. The market went absolutely bananas. In 2007, prices started to climb. And by 2008, they peaked at over $140 a barrel before completely falling off a cliff. In an environment like this, selling your oil at a fixed price wasn't a business strategy. It was like playing roulette with your entire company. So, when things get this crazy, what's the smart move? It's called hedging. You use financial tools to lock in a price and protect yourself from those wild swings. But there was a huge problem. In Russia, the system just wasn't set up for it.
There were two massive roadblocks. First, the law literally considered hedging to be gambling. Not a legitimate business tool, but gambling. Can you believe that? And second, the tax code was a total nightmare. So if you made a profit on your physical oil, but lost money on your financial hedge, you couldn't use that loss to offset your profit. You'd still get taxed on the full gain, even if you actually lost money overall.
So what did TNK-BP do? They went straight to the government. They lobbied to modernize the law, to explain that this wasn't gambling, it was smart risk management. And incredibly, they succeeded. They got the authorities on their side, the laws were changed, and they built a sophisticated hedging program just as the world economy was about to implode. The timing was unbelievable.
Which brings us to our final section, and maybe the most important question of all. Why? Why would TNK-BP, a company that was making good money in the old, broken system, why would they choose to blow it all up and create a new one? It all boiled down to this one simple calculation. They knew that in the old fixed price world, sometimes they could hit a home run and make a massive profit, but it was unpredictable, and it was incredibly risky. They made a strategic choice to trade those giant, risky paydays for smaller but much, much more reliable and manageable profits. And they made a brilliant bet that their customers, the refiners, would happily pay a little extra for that stability. And this quote right here, it says everything you need to know about their mindset. They saw the writing on the wall. They knew this change to a more modern system was going to happen eventually. Some competitor would do it, or the market would just force their hand. So they figured, hey, it's always better to be the one driving the bus than the one getting run over by it. And that leaves us with a really fascinating question that goes way beyond oil trading. It's the classic innovator's dilemma. When do you make that incredibly hard choice to disrupt your own successful business, to cannibalize your own profits, because you know that if you don't, it's just a matter of time before someone else does it for you? Something to think about. So how does a giant, state-owned oil company, one that's kind of set in its ways, completely reinvent itself to compete with the world's sharpest traders? Today, we're going to dive into the incredible story of Colombia's national oil company, Ecopetrol, and how they pulled off this massive revolution. It's a story that changed not just how they sell oil, but how they see themselves on the global stage.
And every revolution needs a spark. For Ecopetrol, that spark was Juan Carlos Vinegra. This one quote really frames his mission, right? This wasn't just a job for him. He was brought in to be an agent of change, to be the catalyst for a radical new vision for the entire company.
So let's start with this agent of change. We're going to look at who Fonagrea is and the absolutely monumental task he was facing, basically reshaping the commercial DNA of a national institution from the inside out.
Now, here's what's so interesting about Fonagrea's background. He's not some lifelong Ecopetrol guy. He's Colombian, sure, but he spent years working abroad for a huge international oil major, BP. That's where he learned the sophisticated, high-stakes game of global energy trading. And in 2018, he brought all that critical outside experience back home.
And this was his mission, which really kicked off back in 2017. The goal? To turn Ecopetrol into an asset-backed trader. So what does that even mean? Well, it means you don't just pump oil out of the ground and sell it to the first person who shows up. No. It means you actively manage your asset, the oil, all the way to the customer, using logistics and risk management to squeeze every last drop of value out of it.
To really get why this mission was so revolutionary, you first have to understand the old way of doing things at Ecopetrol. It was a pretty passive system that, frankly, was leaving a whole lot of money and control in someone else's pockets.
The old system was built around this one concept, free onboard, or FOB sales. Okay, think of it like this. Ecopetrol's only job was to get the oil to the port. The second it was loaded onto the buyer's ship, their work was done. All the really complex and profitable parts, the shipping, the insurance, the risk, that was all someone else's problem. And more importantly, it was someone else's profit. So where was their oil actually going? I mean, sure, 70% went directly to refineries, but a huge 30% was being sold to middlemen. We're talking about the big international trading houses, and these were the very companies that specialized in all that logistics and risk management stuff that Ecopetrol was trying to avoid.
So the bottom line here was pretty simple. By selling a massive chunk of their oil to traders on this simple FOB basis, Ecopetrol was basically outsourcing the most profitable part of the whole journey. The traders were the ones capturing all that extra value by optimizing the supply chain.
Okay, so once they realized they were leaving all this money on the table, Ecopetrol developed a whole new playbook. And the goal was simple: take full control of their product, from the moment it came out of the ground to the moment it entered a foreign refinery.
The strategy really comes down to three main pillars. First, cut out the middleman and go straight to the end user. Second, don't just sell them oil. Offer them the same kind of flexibility a world-class trader would. And third, completely reinvent the sales contract itself to build stronger, more adaptable relationships.
And maximum flexibility wasn't just some corporate buzzword. It meant a total overhaul of their service. They started pricing their oil against different global benchmarks, not just one. They began offering to deliver the oil themselves, handling all the shipping. They even started taking on the price and timing risks, all that complex stuff the traders used to do.
But maybe the most innovative part of this whole thing is the framework contract. Fonagrea has this great analogy where he says a traditional long-term deal is like a full-blown marriage, which can end in a painful divorce if the market changes. But their new framework contract, that's different. It's a long-term relationship, but with monthly negotiations on price. So you get security without the rigid commitment. It's a total win-win.
And the adoption of this new model has just been incredible. We're not talking about some small experiment here. This new flexible approach now covers about 60% of their total sales. I mean, that's a fundamental change to how they do business.
But here's the thing. This massive strategic shift wasn't just about capturing more profit. There was another, equally important reason they did this, and it was all about protecting the Ecopetrol brand itself.
So you have to ask yourself, what's the real danger in letting a trader handle your product? I mean, they're experts at logistics, right? So what's the problem?
Well, the problem, in one word, is control, or rather, a loss of control. A trader might buy a cargo of your high-quality crude, sell it somewhere else, and then blend it with other, maybe lower-quality oils. So when that final blended cargo gets to a refinery in, say, Asia, if it doesn't perform well, whose name gets tarnished? Ecopetrol's. That's a huge reputational risk. So the strategy had this really elegant dual purpose. On the one hand, it was about profit, capturing all that extra value they were leaving on the table, but just as important, it was about brand protection. It was about making absolutely sure that when a refiner buys eco-petrol crude, they get 100% genuine, high-quality eco-petrol crude.
In all of this, the new contracts, the logistics, the brand protection, it all leads to the most profound change of all, a complete shift in mindset. This wasn't just about new business practices. It was about Ecopetrol learning to think and act like a global energy major.
The new cultural goal was crystal clear. They actually compared their own journey to what Norway's Equinor did, another state-owned company that successfully transformed itself into a sophisticated global player. The new benchmark for success wasn't other state companies in the region, it was the global giants like Shell, BP, and Chevron.
And this right here, this is why it all matters so much. Ecopetrol isn't just another company. It is 89% owned by the state of Colombia. Its performance is directly tied to the financial health of the entire nation.
This quote from Fonagra just brings it all home, doesn't it? This isn't just a story about corporate profits. Every single extra dollar they earn from trading smarter and handling their own logistics, that money goes directly back to benefit the nation. That's what makes this transformation a true national project. It's huge.
Ecopetrol's journey proves that even the largest, most entrenched state-run giants can pivot, adopt a commercial mindset, and actually compete on the world stage. And it leaves us with a pretty fascinating final thought. If a national oil company can learn to think and act like a global trader, which other state-owned giants, in energy or even beyond, could be next?
Today, we're going to dive into a really fascinating story from the high-stakes world of crude oil trading. It's all about how one company, just by being nimble and opportunistic, totally flipped its strategy on its head to find a winning edge in a market, a market that's usually dominated by giants.
So to really get the opportunity here, you first have to see just how much the world was changing. This quote is from an executive at Ecopetrol, the Colombian state oil company, and what he's saying is huge. Their focus is shifting, and shifting hard, towards Asia. This isn't just some small tweak. We're talking about a fundamental redrawing of the global energy map, forcing everyone to rethink their old playbooks.
And this just nails the point perfectly. To get closer to that new customer base over in Asia, Ecopetrol's traders were actually encouraged to learn basic Mandarin. Just think about that. It shows it's not just about logistics anymore, it's about culture. And this kind of disruption, well, it creates gaps in the market, little openings for clever players who can adapt way faster than the titans. And that brings us right to the heart of our story.
Okay, so let's zoom in from that big global picture to the individual right at the center of this trading masterclass, Mohammed Mankara. His story is just a great example of how passion and opportunity can come together in some pretty powerful ways.
So Mankara's journey, it doesn't start where you'd expect. He began as a mechanical engineer, a very analytical, structured path. But his move into the heart of trading was incredibly fast. I mean, within just a couple of years of joining Texaco, he goes from engineering to risk management, and then boom, straight into a trader's seat. He really found his true calling in that fast-paced world of commodities.
And his career switch wasn't some calculated corporate ladder climb. The story goes, he was on a stopover in Vienna and decided to visit a friend who happened to be a foreign exchange trader. The second he saw that trading desk, with all the flashing screens and the data just pouring in, he knew, instantly. He said it was love at first sight, a total kid in a candy store moment.
And he just dove right in with this huge energy. He was smart, a really hard worker, and he got things fast. But he was also restless, and maybe didn't have that corporate polish. Luckily for him, his mentors at Texaco saw that raw talent. They channeled what one of them called that smart-ass energy, and they helped turn him into one of their best traders. That training really set the stage for his next big move.
So when Mankara joined Dow Chemical over in Europe, he wasn't just taking another trading job. Nope, he was walking right into a situation where Dow was getting ready to make a really radical bet, one that challenged the very foundation of how refineries get their crude oil.
You see, the industry standard has pretty much always been term contracts. It's the safe, predictable way to do business. You lock in a supply for the long term, you know exactly what you're getting, and you know the pricing formula. For a huge refinery, that security is absolutely everything. You cannot risk running dry.
So here's the crucial trade-off. Term contracts give you that rock-solid security, but you lose flexibility and you might miss out on some sweet market discounts. The spot market, which is just buying one-off cargoes, is the complete opposite. It's risky, it's unpredictable, but it offers incredible flexibility and the chance to snag a real bargain. So Dow decided to ditch security and embrace that risk. The big question is, why?
And here's the answer. Dow spotted a unique local advantage. You see, their refinery in the Netherlands was right next door to this growing flood of Russian Urals crude coming out of the Baltic Sea. They gambled that this constant river of oil was so reliable that they could just dip into it whenever they needed, buying on the spot market without ever putting their operations in jeopardy.
And their timing? It was perfect. Back in 2005 and 2006, the market for this Urals crude just wasn't as developed. There was often a surplus of it floating around Europe, and that just dragged the price down. In fact, the discount was so big that even Vladimir Putin was publicly complaining about it. For an opportunistic buyer like Dow, this was a golden opportunity.
Okay, so Dow made the bet. But, making a bet and actually winning it are two totally different things. Their success came from this really clever, multi-layered strategy that was all about maximizing flexibility at every single turn. Let's break down how they did it.
Their approach basically had 3 key steps. First, they switched their main supply of heavy, high-sulfur, what we call sour, crude from term contracts to spot purchases to grab those Urals discounts. Second, they stayed ready to pounce on lighter, low-sulfur, or sweet crude if a bargain suddenly popped up. And third, and this is brilliant, they had a backup plan to make sure their most profitable refinery unit never, ever stopped running.
And the results from that first step were just staggering. At times, the discount on Urals crude was so deep that Dow was buying it for $7 a barrel less than what their own model said its fair value was. In the oil world, that is a massive, massive number. Combined with their refinery setup, this was a huge source of profit.
Now, that second part of the strategy was all about extreme agility. They were constantly watching the sweet crude market for what they called distressed cargoes, basically a shipment that needed a buyer like right now. These little market disconnects might only last a day or two, but Dow was always ready to pounce, switching their refinery's entire input for just one single cargo to capture a great deal.
Okay, on to that crucial third step. Now, switching to that cheap sweet crude meant they wouldn't produce enough of a substance called vacuum gas oil, or VGO, to feed their hydrocracker unit. And this unit was, as they put it, the jewel in their crown. It was so profitable that Minkara said it was basically printing money. So whenever they bought a sweet cargo, they would simultaneously go out and buy a cargo of VGO on the market just to keep that money machine running at full tilt. Just brilliant.
So this all sounds amazing, right? But it's really important to understand why it worked for Dow and why this isn't a strategy that just anybody can copy. It was a really unique combination of their size, their location, and their whole mindset.
So what was their secret sauce? Well, first, they were a relatively small player. They only needed about 4 or 5 cargoes a month. This allowed them to be incredibly nimble and opportunistic. Second, their location was perfect. Right next to a huge supply of crude. And finally, their entire mindset was built around constant, daily optimization, always hunting for a better deal.
And this comparison just illustrates the difference perfectly. A giant like ExxonMobil, they might need a dozen or more cargoes of just one type of crude every single month. They simply can't rely on the spot market. It would be total chaos. Or, as Minkara put it, the definition of a riot. They have to use term contracts for security and scale. Dow, on the other hand, could trade that security for agility and incredible value.
So the key takeaway here is that your strategy has to fit your specific situation. Dow found a brilliant way to turn its smaller size into a massive advantage. And that really leaves us with a final thought. No matter what industry you're in a world that's so often dominated by giants, where can being the small, nimble player become your greatest strength?
Today, we've got this incredible story from the super high-stakes world of oil trading. And really, it's a masterclass in the power of perception. It shows how just a simple shift in how you look at a problem can turn what seems like a hopeless situation into a massive, multi-million-dollar win.
You know that feeling, right? That cold sweat when the pressure is on. Well, imagine you're a trader and a giant oil refinery, one that you are responsible for, is just days away from running completely dry. It's that gut-wrenching, stomach-turning anxiety that really sets the stage for everything that's about to happen.
All right, so let's jump back in time. The year is 2007, and we're going to meet our main character, Michael Dugdale.
He's an asset trader for a brand new company called Ineos Refining, and to say the pressure is on would be an understatement. His job is to keep one of the biggest refineries in Europe supplied with crude oil, and every single decision he makes has massive financial consequences.
Now, we're not talking about some small-time operation here. This refinery, Grangemouth, was an absolute behemoth. I mean, 210,000 barrels a day. To put that into perspective, that's enough crude oil to fill over 3,000 Olympic-sized swimming pools every single month. And Dugdale was right in the middle of it all.
So what exactly is an asset trader? Well, you can think of him as the brain of the whole supply operation. It was Dugdale's job to figure out the exact blend of crude oil the refinery needed to turn a profit, and then he'd be the one to tell the frontline traders what to go out and buy. He was the critical link in the chain, which, comes with a ton of responsibility.
Okay, so things seem to be going fine, right? Well, not exactly. There was this huge problem hiding in plain sight. See, Ineos was a new player, and they'd inherited a massive vulnerability with this refinery, a vulnerability that was about to blow up into a full-blown crisis.
Here's the deal. As part of the sale, Ineos had a 2-year supply agreement with the company they bought it from, the oil giant BP. But that deal was basically a ticking time bomb. As 2007 started winding down, that agreement was about to expire, and everyone at Ineos was, as Dugdale himself put it, getting increasingly nervous.
And this right here, this shows you exactly why they were panicking. The refinery wasn't just getting a little bit of its oil from BP. Oh no. It was pretty much built to run on one specific type of oil, 40s crude, which came straight from BP through a pipeline. A whopping 60% of its entire supply came from this one single source.
And that dependence, that was BP's leverage, their secret weapon. The team at Ineos was pretty much convinced that BP was about to use this power to jack up prices and basically force them into a terrible new deal. They were completely backed into a corner with no obvious way out.
So what do you do? I mean, seriously, what's the play here? How in the world do you replace a supplier that's providing more than half of your most essential ingredient, especially when your whole operation is basically built around it? This was the question that was keeping the entire team up at night.
Let's be clear, Ineos felt like a hostage. In trader lingo, they were massively short on supply, meaning they had this huge, desperate need they had to fill. And BP? Well, they were sitting pretty, in the driver's seat, holding all the cards. Or so it seemed.
Dugdale was feeling the weight of this more than anyone. I mean, it was his job to fix this. He was starting to lose hope. And then, when he was at his absolute lowest point, a totally random conversation at an industry party changed the entire game. So picture this. He's talking to a much older, much wiser trader from a rival company, Valero, and he just spills his guts, explaining this impossible problem he has, this massive short he has to fill, this corner he's been backed into.
And what this old-timer says next, well, it's a complete bombshell. He just looks at him and says, "Mike, you just said it yourself. You're the biggest short in Europe, and that means you don't need to chase around after people. In fact, every supplier in the region is going to be scrambling to supply you."
And just like that, a light bulb went off. The very thing they saw as their biggest weakness, their massive, desperate need for oil, was actually their single greatest source of power. They weren't just a desperate buyer. They were the single biggest, most attractive customer on the entire market. The perspective had been completely flipped on its head.
So how did they turn this revelation into an actual strategy? Armed with this totally new way of thinking, Dugdale went back to his team with a completely different plan. It was time to stop acting like a hostage and start acting like the prize. The new game plan was brilliant in its simplicity. Step 1, completely reframe the situation. Step 2, go talk to everybody, all of BP's biggest rivals. And step 3, the kicker, lead every single conversation with their newfound strength. Just walk in and say, "Look, we're a huge piece of business that's up for grabs, so impress us."
And what do you think happened? It worked. Like, instantly. The big players, Shell, Total, all of them were falling over themselves to get a piece of the action. All of a sudden, Ineos wasn't chasing suppliers anymore. Suppliers were chasing them. Now they were fully in control, so Ineos officially kicked off a bidding war. And this wasn't for just a little bit of oil. This was for a huge 5-year supply contract. They were making the titans of the industry fight over them. It was a complete 180 from where they started, and you can bet BP was not happy about it. The competition was fierce.
For a hot minute, it looked like the French company Total had it in the bag. But then, right at the last second, Shell swooped in with an even better offer and snatched the deal right out from under them. The competitive process had worked to perfection.
And the result of all this? By flipping the script and turning that weakness into a strength, INEOS saved an estimated $25 million. That's how much more they probably would have paid BP if they'd just rolled over. An absolutely staggering win, all born from one simple change in mindset.
So what's the big takeaway from this incredible story? Well, it all boils down to one simple truth. How you perceive a situation is what defines your power within it. The lessons here are crystal clear. First, what you think is your biggest problem might actually be your trump card. Second, never, ever take a customer for granted. BP just assumed they had INEOS trapped, but in any market, there are always other options. And finally, and maybe most importantly, your power isn't just about your own needs. It's about how valuable you are to other people. INEOS wasn't a problem to be solved. They were a prize to be won.
For Michael Dugdale, the guy at the heart of it all, this moment was career-defining. Years later, he still looks back on it as the single best trading decision he ever made. That just shows you the power of a fresh perspective.
And that really brings us to the final question, one for you to think about. Whether it's in your job, a negotiation, or just your personal life, what's the one thing you see as your biggest weakness? And how could you, just like INEOS, flip the script and maybe, just maybe, see it as your greatest hidden strength?
Okay, so today we're diving into what is basically a masterclass in strategy. It's told through one company's absolutely incredible journey from being the underdog to a total industry titan. And it's really a story about persistence and the power of just seeing things a little bit differently.
It all boils down to this one simple, but, really powerful idea. Sometimes the key to unlocking huge value isn't about changing your situation, but just changing how you look at it.
And in the world of business, that shift in perspective is everything. What might look like a weakness, being the small, unknown player in the room, can actually be flipped into your greatest strength. It forces you to be quicker, more focused, and way more determined than anyone else. It lets you write your own playbook. And that brings us to our story. This quote from Gina Malkani, the COO of Springfield Group, just perfectly sums up the myth of the overnight success. Because what looked like some sudden victory from the outside was actually the result of a grind. A multi-year grind that's honestly hard to even believe.
So let's pull back the curtain on Springfield Group. They're a Ghanaian energy company with a dream that, well, a lot of people thought was pretty much impossible.
Now, Springfield wasn't some startup with just a wild idea. By the late 2000s, they were a really solid, successful business. Founded back in 2006 by Kevin Okier, they saw a need for oil storage in Ghana and built this thriving trading operation from the ground up. And running the show was Gina Malkani, whose background in the, let's say, fiercely competitive car sales world would turn out to be their secret weapon.
But being successful in Ghana? That just wasn't enough. They had their eyes on the biggest prize in West African energy, the ultimate test, breaking into the Nigerian market.
And yeah, superpower is the perfect word for it. For a company like Springfield, trying to get into Nigeria was kind of like a local garage band trying to get a record deal in Los Angeles. It's where all the biggest players were, the competition was absolutely brutal, and you had to prove you even deserved to be there.
And their first attempts really showed them just how hard this was going to be. They started talks with the Nigerian National Petroleum Corporation, the NNPC, back in 2011. The meetings were polite, sure, people were friendly, but that's all it was. Nobody was ready to hand a contract to a pretty much unknown company from Ghana.
Now this is the point where most companies would have just packed it in and gone home. But Springfield, they did the exact opposite. They doubled down. They committed to a strategy of relentless, stubborn, face-to-face persistence.
I mean, just look at this timeline. We're not talking about a few months of trying. This was a 3-year campaign. For 3 whole years, they were pouring time and money into this, flying to Nigeria week after week with absolutely zero guarantee that they'd ever see a return. The scale of that commitment is just staggering. Every single Monday morning at 4:30 a.m., they were on their way to the airport. Their plan wasn't just to make a pitch. It was to build actual relationships, to become a familiar, trusted face. They figured if they couldn't win on size, they were going to win on sheer presence.
So you gotta wonder, right? How did they keep going? Well, it came down to this mindset. After a year, they felt like they were too invested to quit. After 2 years, that feeling was even stronger. Their past investment wasn't a loss to them, it became the fuel for their future. And so in 2014, after 3 years of this exact routine, the breakthrough finally came. They got the contract.
But, like Gina Malkani said, getting the deal was only the beginning. Earning the contract through sheer will was one thing. Keeping it through performance, that was the real test.
So now, suddenly, they're on the same stage as the giants of the industry, the big, established, A-list international traders. And the expectation wasn't just that they would do the job. It was probably that they'd struggle. Springfield was absolutely determined to shatter that expectation.
And they did it by bringing a completely different playbook to the table, one straight from Gina's time in the auto industry. See, standard oil trading often meant clients just came to you. But Springfield treated it like the hyper-competitive world of car sales. They obsessed over customer service, they were personally visiting distributors and retail stations, a level of hands-on attention that was just unheard of.
Here's a perfect example of how they put that obsession into practice. Their contract with the NNPC gave them the industry standard 30 days to pay for each cargo of crude oil they took. Pretty standard stuff.
But Springfield didn't just meet the deadline. They consistently beat it. They made it a point to wire the full payment on day 28, every single time. The NNPC was so surprised that one of their smallest partners was outperforming literally everyone else that they actually called them to ask, "What's your secret?"
This combination of persistence and then performance created this incredible ripple effect. They didn't just keep their first contract, they used it as a launchpad to build an entire empire.
The trust they built just by paying early on that first deal, it was priceless. It led to more partnerships with the NPC in gas oil and LPG. They were even trusted to market a brand new type of condensate. And then came the biggest step of all. In 2016, they moved upstream, winning the right to explore for and produce their own oil. The underdog traders had officially become producers.
And this brings the whole story full circle. Their incredible success wasn't some accident, and it for sure wasn't overnight. It was the direct result of a core philosophy.
This is the question they ask when they hire people. It just shows you that the mindset that drove them to fly to Nigeria every week for 3 years is now baked right into the company's DNA. It's a culture built on the belief that no limit, no barrier is unbreakable.
So in the end, Springfield's story kind of redefines what persistence really means. It wasn't just passively waiting for a break. It was an active, strategic campaign to earn trust. And once they had that trust, they honored it by over-delivering on every single promise they made.
Their journey from a small Ghanaian company to a huge, integrated energy powerhouse all started with a simple decision to not accept the limits that other people saw. And it leaves us with a really powerful question to think about for ourselves. What barriers do we accept as permanent that maybe are just waiting for a little persistence?
All right, welcome to The Explainer. Today, we've got an incredible story for you. It's a true masterclass in negotiation, pulled straight from the high-stakes world of crude oil. It's all about how to create some serious leverage when it really seems like you have none at all. So this quote comes from a guy named John Cruz, a real veteran of the U.S. oil industry. We're talking 40 years in the game. He built his entire career on this idea of fair dealing. But that core belief, it was about to be put to the ultimate test in a situation that was anything but fair. Okay, so let's set the scene here. We're down in South Texas, and John's company, Texaco, is facing a huge logistical nightmare, one that's put them in a really, really vulnerable spot. You gotta understand, the situation was basically a perfect trap. Texaco's pumping out 12,000 barrels of oil every single day. But to get it anywhere, they had only one option, this one single pipeline. And get this, the company that owned the pipeline was also the main company buying their oil. Texaco was, for all intents and purposes, a captive customer. And you know, for a couple of years, everything was fine. They had a fairly negotiated price, the relationship was solid, and business was good. But that all changed the second new management took over the pipeline company. And these new folks, they had a very different idea of what fair really meant. And then, bam, out of nowhere. No phone call, no meeting, not even a heads up. Just a single fax lands on the machine, a fax that would kick off a high-stakes standoff that could cost Texaco millions. So what was on this fax? Well, it was a notice of contract cancellation. The pipeline company was just tearing up the old deal and forcing a renegotiation. But this wasn't really a negotiation. It was a hardball ultimatum, pure and simple. They knew they had a monopoly and they were ready to use it. Now, to really get why this was such a big deal, you have to know what was going on at the time. Oil prices, they were hovering right around $12 a barrel. So yeah, every single penny mattered. And this was their new offer. Not some tiny adjustment. We're talking a massive price drop of over $2 for every single barrel of oil Texaco sold them. Look, a $2 cut on $12 oil isn't just a tweak. That is a nearly 17% hit to their revenue. I mean, this was a power play, an incredibly aggressive move by a company that was absolutely convinced it held all the cards. Or so they thought. So you can imagine, John Crux was absolutely furious. But here's the thing. Instead of just getting mad, he got clever. He spent the next 2 days cooking up a brilliant, kind of audacious, and yeah, a little bit theatrical plan to fight back. He wasn't just going to argue about the price. No. His plan was much bigger. He was going to create the illusion, the appearance that Texaco was about to become their worst nightmare, a direct competitor.
And this quote right here from Cruz, this is the heart of the whole strategy. He's basically saying, hey, I'm not going to tell you we're definitely building a pipeline, but we're sure as heck going to look like we are. It was all about creating powerful leverage from absolutely nothing.
And they put on a real show. It was like a masterclass in managing perceptions. Cruz had his team go out and start planting these survey stakes all along the highway, right where the other company couldn't miss them. Then he had 5 or 6 huge transport trucks parked in really obvious spots. The whole thing was designed to send one loud, clear message. We don't need you anymore. And you know what? It worked, and it worked fast. It took only about a week and a half for this bluff to totally rattle his opponent. And then John Cruz got the exact phone call he had been waiting for. The pipeline manager gets on the phone, and he's direct. You can almost hear the concern in his voice, right? The wooden stakes and the parked trucks were clearly doing their job. Okay, now listen to Cruz's response here because it is an absolute masterpiece. He doesn't lie, but he just pours gasoline on the fire. He's not just confirming their fears, he's suggesting the reality could be even worse for them. We might even build 2. I mean, come on, that's brilliant. So his opponent tries to push back, right? He tries to call the bluff. He's basically saying, oh, come on, John, you're just mad about the price cut, aren't you? He's trying to frame it like an emotional outburst. But Cruz, he is cool as a cucumber. He completely reframes the whole situation. He takes all the emotion out of it and presents it as a cold, logical business decision that they forced him into. And let me tell you, for that pipeline company, a calm, rational competitor is way more terrifying than an angry one. And just like that, with a few wooden stakes and one very clever phone call, the entire power dynamic just flipped on its head. The hunter had officially become the hunted. I mean, look how fast this all went down. In just a few weeks, Chrissy and his team took this huge financial threat and turned it into a profitable new deal. They didn't just fend off the price cut, they actually secured a price increase. And this right here is the absolute genius of the plan. The perceived threat was enormous, right? A full-scale competitor moving into their territory. But the actual cost to Texaco was practically nothing. We're talking about the price of some wooden stakes and the fuel to park a few trucks. Minimal risk, maximum impact. So what's the big takeaway here? It's that leverage in a negotiation isn't just about the cards you're holding. It's about what your opponent thinks you're willing to do. John Krusnefruit proved that if you can create a believable alternative, even a completely fictional one, you can reshape the entire landscape of a negotiation. And that really leaves us with a powerful question to think about, right? In your own negotiations, your own challenges, what's your ghost pipeline? What's that credible alternative you can create to completely change the game and give you leverage you didn't even think you had?
Imagine you're an oil trader back in the early 2010s. For decades, the story of U.S. oil was pretty simple. It was in decline. But then, all of a sudden, everything gets turned on its head. The market is thrown into total chaos, and it creates this once-in-a-generation opportunity. So the question is, do you follow the herd into a full-blown frenzy, or do you make a really high-stakes bet against it? Okay, let's get into it.
So for years and years, U.S. oil production just kind of hovered around 5, maybe 6 million barrels a day. But then, this new technology comes along and unlocks these vast reserves of oil trapped in shale rock. And the result? An absolute explosion. By late 2017, production had skyrocketed past 10 million barrels a day. I mean, that's a level nobody had seen since 1970. This wasn't just some small change. This was a complete rewriting of the global energy map.
And we have the perfect guide for this story, Ann Summers. She's a trader with 30 years on the front lines at huge firms like Morgan Stanley, and her words here really capture the scale of this thing. You know, this wasn't just another market event like a war or some political crisis, which usually have pretty short-lived impacts. Nope. The shale revolution was a fundamental, deep, long-term transformation.
So let's break down just how much of a game changer this was. It didn't just bend the rules. It completely shattered the beliefs that had governed the U.S. oil industry for a whole generation.
Before all this, the consensus view was that U.S. production was just in a permanent, irreversible decline. The country was a huge importer. But the new reality? It was the exact opposite. All of a sudden, North America became way less dependent on foreign oil, and for the first time in decades, the dominance of OPEC was being directly challenged.
Now here's the thing. Whenever you have disruption on this kind of scale, it creates problems, big problems. But for a smart trader, a problem is just another word for a golden opportunity. And believe me, this one was massive.
And here's the critical point. All this oil was gushing out of the ground in places like West Texas, but the infrastructure, the pipelines you need to actually move it to refineries and hubs, it just hadn't kept up. There was a gigantic bottleneck. And this bottleneck created something that traders literally dream about, a massive price dislocation. See, oil right there at the source in West Texas, what they call WTI Midland, suddenly became much cheaper than oil that was already delivered to the major hub in Cushing, Oklahoma. And why? Simple. You just couldn't physically get it from point A to point B.
And the size of this price gap was, in Ann Summers' own words, gigantic and absolutely unprecedented. We are talking about a difference of $15 to $20 per barrel. In the world of oil trading, that is an enormous, flashing neon sign that just screams profit.
Now, the timing here was absolutely everything. Just as all this chaos was starting to unfold, Ann's team had already made a brilliant strategic move. They'd signed a 5-year deal to supply a Midwest refinery. This put them in the perfect position to buy all that cheap, stranded crude oil and sell it on, capturing that huge price difference.
But Ann's team wasn't the only one who spotted that price gap. Oh no, the entire market saw it, and their reaction was swift, it was powerful, and, as we're about to see, maybe a little irrational. This kicked off a full-blown pipeline frenzy.
This quote from Ann just illustrates the mood perfectly. It wasn't just a business decision. She says it became a mania. A speculative fever just gripped the trading community, where having pipeline space was like the ultimate status symbol. It felt, as she says, a lot like the dot-com bubble, where everybody just chases the same thing without really questioning the fundamentals.
So just put yourself on that trading floor for a second. The pressure is immense. Everyone is scrambling. In that kind of environment, what was the macho thing to do?
The answer was obvious to everyone. You had to get pipeline space. And not just for next week. The consensus trade, the thing everyone was doing, was to lock in expensive 5 or even 10-year commitments on brand new pipelines. It was seen as the only way to play the game.
And this is where our story really takes a turn. Because instead of joining that frantic rush, Ann's teams did something incredibly difficult in a trading environment. They stood back, they questioned the consensus, and they bet against the herd.
Their logic was actually remarkably simple and clear. First, yeah, they acknowledged the shortage was real. But second, they saw the insane amount of money pouring in to build new pipelines. So their conclusion, this whole shortage was a short-term problem, which made the final decision pretty easy. Why on earth would you lock into an expensive long-term solution for a short-term problem?
And this quote just perfectly captures their conviction. While all the other traders were proudly announcing their expensive 10-year pipeline deals, Ann and her team just watched and thought to themselves, good luck to them. They were that confident that the market was overreacting.
So, who was right? The frenzied herd or the calm contrarians? Let's take a look at the final outcome and the really crucial lessons from this whole saga.
Well, just as they predicted, the market completely flipped. That pipeline-building mania was so intense that by 2018, the country hadn't just solved the shortage, it had massively overbuilt pipeline capacity. The short-term problem had completely vanished.
And the consequences for those who followed the herd? They were severe. Anne remembers one company that had paid over $5 a barrel for long-term space, and they were now desperately trying to sell it for just 25 cents, just to get some cash flow. They were stuck with this expensive long-term liability in a market that didn't even need it anymore. So, when you boil it all down, it came down to two pivotal calls. The first, saying yes to that refinery deal, which put them in the perfect position to profit from all the initial chaos. And the second call, which was even more important, was saying no to the pipeline frenzy. And both of them paid off big time.
So what's the ultimate lesson here? Well, it wasn't about some lone genius. Success came from a team that understood a basic market principle. A supply boom will always be followed by an infrastructure build-out. By calmly analyzing that timeline, instead of just giving in to the frenzy, they saw that the problem was temporary, and they avoided a very long-term, very costly mistake.
And that leaves us with a final question to really think about. In the markets, or, even in our own lives, when you see everyone rushing in the exact same direction, is that a signal that you should join them? Or is it a critical warning sign that maybe it's time to step back, take a breath, and really think for yourself?
So when you picture the global oil market, what comes to mind? Probably these massive corporations, right? Titans of industry moving billions of dollars around the globe. But what if I told you that some of the most ingenious, high-stakes trades don't happen in the boardroom, but in the margins, run by smaller, savvier players? Today, we're going to dive into the underdog's guide to oil trading. And this quote right here from veteran trader Michael Hacking really gets to the heart of it. It's the whole theme for our explainer today. You can't go toe-to-toe with the giants on muscle, so you have to outthink them. You have to find the weird trades, the little puzzles that everyone else has just ignored. Yeah, that's the billion-dollar question, isn't it? It's one thing to say, oh, I'll find a niche, but it's a completely different thing to actually take a tough, overlooked opportunity and turn it into a real win. So let's find out exactly how it's done. Our guide for this journey is Michael Hacking and his company Mocor. See, as a smaller trading house, they knew from day one they had to be smarter than the giants, not just bigger. They had to learn to play the underdog's game. And this strategy isn't just about finding something obscure. It requires real initiative, deep creative thinking, and a spirit of enterprise. It's all about looking at a problem that everyone else has written off as impossible, and having the guts to ask, okay, but what if? Let's look at a perfect example. So back in 2006, a producer comes to Monaco with a real head-scratcher. They were basically trapped selling their crude for way too little, and they desperately needed a new way to get it to market. This is the story of how Monaco solved the Albanian crude problem. Okay, so look at this number, 9.8 degrees API gravity. Now, if you're not in the oil business, that might not mean much, but let me tell you, that is crazy low-quality, heavy crude. In fact, Hacking said you could literally stand a spade in it. This wasn't just an unloved grade of oil. Most people in the industry had never even seen anything like it. And the awful quality? Well, that was just the start of their problems. The logistics were a complete nightmare. The port had almost no storage, so ships had to get in and out within a tight 2-day window. The harbor was also too shallow for big tankers, meaning they could only load these tiny 20,000-ton parcels. And what did all this mean? It meant the oil was effectively trapped, sold to one single aggressive buyer in Spain who knew they held all the cards. So here's the light bulb moment. Moco realized they couldn't just go find a new customer. Shipping these tiny parcels of sludge anywhere beyond the Mediterranean was just never going to be profitable. The solution wasn't a sales problem, it was an engineering problem. They had to completely reinvent the supply chain. And what they came up with was, frankly, brilliant. They chartered a huge 80,000-ton mothership and parked it in deep water off the coast of Malta. Then they used a smaller daughter vessel to just ferry the crude from Albania out to the mothership, one trip at a time. After 4 trips, the mothership was full, and now it was big enough to make economic sense to sail that Albanian crude anywhere in the world. And just look at the result. By solving that logistical puzzle, they completely shattered the monopoly held by that one Spanish buyer. All of a sudden, Albanian crude was being sold to the US, to India, even all the way to the Far East. They literally created a global market for an oil that was previously trapped. Their client, as you can imagine, was thrilled. Okay, on to our next case study. After the success in Albania, Mocha was feeling confident. So in 2010, they took on a new challenge, the first ever cargo of Kurdish Shaikan crude. But this time, the problem wasn't logistical. Oh no, it was political. Now, as you can see, this Kurdish crude was still heavy, but it was much higher quality than that Albanian sludge. MOCO put in a very aggressive bid, almost $2 a barrel higher than anyone else, figuring they could work their magic again. They won the tender and quickly sold the cargo to a buyer in the US. But they had completely, and I mean completely, underestimated the political risks. And this is where the wheels completely fell off. The US government publicly stated that all Iraqi oil, including from the Kurdistan region, had to be sold through Iraq's national oil company. Now, this wasn't an official sanction, but it might as well have been. It created this chilling effect. Their buyer got nervous. Their banks got nervous. The trade was suddenly radioactive. To get a sense of the pressure they were under, Hacking said it was like having a wart on your nose that everybody is staring at. Just imagine it. Your ship is out on the ocean, steaming towards a U.S. port that will no longer accept your cargo. Everyone in the market knows you're in trouble, and every phone call starts with, "So, how's that Shaikan cargo going?" They had overpaid for the wrong oil in the wrong place at the wrong time. So how in the world do you solve a problem like this? You can't just engineer your way out of a geopolitical crisis. The solution had to shift from logistics and engineering to geopolitics and, more importantly, human relationships. You know, the one critical detail that saved this whole deal was something called a letter of credit. All that really is a guarantee from a bank that a buyer is going to pay the seller no matter what. And this meant Molco's buyer was financially on the hook, whether they took the cargo or not. That single term in the contract changed everything. It gave the buyer a really powerful reason to cooperate instead of just walking away. So instead of becoming enemies and heading to court, they became partners in solving the problem. They found a place to store the oil outside the US for a few months, and then, when it was finally sold, they split the profits. It was a masterclass in turning a total crisis into a collaboration. So let's just compare these two stories really quickly. With Albanian crude, the challenge was physical, right? A logistical puzzle that they solved with smart engineering. With the Kurdish crude, the challenge was geopolitical, a reputational minefield they navigated with human negotiation. It just goes to show you, a successful underdog has to be adaptable. You've got to be ready to manage whatever kind of risk the market throws at you. And that adaptability brings us to our final and maybe most crucial point. Through all these complicated trades, what's the single most valuable asset a smaller trading house has? It's not cash, it's not ships, it's not storage. It is their reputation. And to really get why reputation and risk management are so important, we have to look at this key moment from Monaco's early days. As a tiny startup, they managed to land the contract to manage Saldana Bay. This was this incredible, almost secret underground oil storage facility in South Africa. We're talking 6 gigantic caverns, each holding 7 million barrels. It was a massive obligation for a small company, and how they handled it was critical. But here's the twist. Makoko decided that the risk of managing this huge facility themselves was just too great, so they wisely leased their rights to another firm, Arcadia. Well, a few years later, Arcadia executed one of the most infamous trades in oil history. They cornered the entire North Sea Brent market. And when the whole world was wondering where on earth they were going to put all that oil, the answer was simple. They shipped it all to Saldana Bay. And this is the crucial lesson right here. Hacking reflects that for a little startup like Moco, taking on that massive storage position themselves could have been absolutely disastrous. Their cautious, professional decision to shift that risk was a key moment of survival. The line between a brilliant move and a fatal one can be razor thin. This quote really just sums up the trader's mindset perfectly. You're going to have near misses. You're going to have moments where things could have gone terribly wrong. But if you love the game, you accept that risk is just part of it. You learn from it, and you keep writing. And that's the thought I really want to leave you with. From logistical engineering in Albania to geopolitical negotiations over Kurdish oil to navigating market-moving plays in South Africa, the underdog's game is about so much more than just being smart. It's about survival. It's about adaptation. And as this final question asks, it's about knowing that sometimes the biggest win is just avoiding the crash. All right, let's dive into a really fascinating story from the wild world of oil trading. It's a classic case study, really, about how a huge, frustrating problem, a logistical bottleneck, was flipped on its head and turned into an incredibly powerful and profitable secret weapon. You know, in the world of physical trading, your reputation is everything. It's the whole game. A bad trade? Yeah, it'll cost you money, for sure. But losing your reputation? Well, that can cost you your entire career. Trust is the real currency that makes these billion-dollar deals happen. But here's the thing. While everyone is laser-focused on reputation and trying to guess which way the market's going to go, there's this other kind of hidden source of power. It's the nuts and bolts, the actual plumbing of the whole system. Logistics. And if you can master it, you get an edge that nobody else even sees coming. So, to really get how this works, you have to meet the guy at the center of our story. A man who didn't just see the world for what it was, but for what it could be if it were just a little more optimized. His name is Chris Del Vecchio. Chris wasn't your typical energy trader. He didn't have a fancy Ivy League degree. In fact, he grew up in a farming community and never even went to college. His superpower wasn't on a resume, it was a mindset. He was just hardwired to look at any process and ask, wait, why are we doing this in 10 steps when we could totally do it in 5? He was convinced that the real key to winning in trading wasn't just about predicting prices, it was about mastering the physical movement of the stuff itself. And in the mid-90s, while he was working for BP, Chris found the perfect puzzle to solve. The company was hitting a wall with its oil production down in Colombia. It was a frustrating, costly problem. Basically, the playing field was anything but level. So the product at the center of all this was called Cusiana crude. It's this really high-quality oil that's produced way up in the Andes and then shipped out to the world from a terminal called Coveñas. Now, BP was a partner in this whole operation, along with the Colombian state-owned oil company and a few others. Okay, so here's where the problem starts. The whole system for deciding who got to load their oil onto ships each month, well, let's just say it was biased. The state-owned partner who had the biggest share always got the best, most profitable time slots. And BP, they consistently got the leftovers, the less favorable slots that meant they could never really get the top prices for their oil. The disadvantage was just baked right into the system. So, what do you do when the game is rigged against you? You don't just ask for a better spot in line. You change the rules of the game completely. And Chris came up with this brilliant, kind of crazy idea he called the million-barrel gambit. See, at the time, everyone, and I mean everyone, exported oil from that port in these standard-sized ships carrying about 500,000 barrels. That was just the way it was done. It was the default setting. Chris's idea was both simple and totally radical. What if, instead of shipping the standard 500,000 barrels, BP offered to take double that, 1,000,000 barrels, all in one go? Now, this wasn't just a small tweak. This was a move that would completely change the entire dynamic at the port. Now, the genius here was all in the pitch. Chris didn't frame this as something that would help BP. He framed it as a solution for everyone. He pointed out that the port had a limited number of loading slots, and with production going up, there was a very real risk of a traffic jam that could literally shut everything down. But by taking one giant cargo, BP would free up an entire loading window. See? It increased the port's total capacity for all the partners. And here's the deal they put on the table. BP's ask was simple. Give us first pick on loading dates. And their offer was powerful. In return, we'll take on all the risk and complexity of these massive cargoes, which frees up a precious loading slot for everybody. It was a classic win-win. And after a lot of back and forth, the partners agreed. So, victory, right? Problem solved? Well, not exactly. In fixing one huge problem, they accidentally created a brand new one. It's kind of like the winner's curse. They now had control over when they loaded their oil, which was fantastic. But they were also committed to taking 1,000,000 barrels at a time. So they'd solved their loading problem, but in the process, they had created this massive selling problem. Now what? And this was a logistical nightmare. I mean, think about it. A ship loaded with 1,000,000 barrels of oil is way too big for most U.S. ports to even handle. And dropping off a little bit here and a little bit there, that was just way too expensive. Plus, trying to find one single customer who wanted that much oil all at once was nearly impossible. Their solution had become the new problem. But the team didn't quit. They went right back to the drawing board, and they came up with a second idea that was honestly even more brilliant. A true masterstroke of logistics that they called the Cusiana Cavern. The idea was to just stop thinking about selling the oil directly off the ship. Instead, they decided to bring those huge million-barrel cargoes to a massive underground salt cavern that they leased for storage. It was at the Louisiana Offshore Oil Port, or LOOP. This cavern was about to become their strategic hub. And this is the super slick milk run system they created. A BP-owned ship would go pick up 1 million barrels in Colombia, sail it to the U.S., and dump it in the storage cavern at LOOP. Then, and this is a key part, they used their deep expertise in customs rules to domesticize that foreign crude, which made it way easier to trade. From that cavern, they could then sell it in any size their customers wanted, whenever they wanted it. This new model was a total game changer. It gave customers incredible flexibility. It basically turned this complicated imported oil into a simple, easy-to-trade domestic product. It made perfect use of BP's own ships, and, most importantly, it dramatically boosted the profitability of their Colombian operation. They had turned a huge disadvantage into a massive competitive edge.
So, when you boil it all down, what's the real takeaway from this incredible story? It's all about seeing the hidden power in mastering the physical details. It's the logistics advantage.
Look, coming up with a clever strategy in a conference room is one thing, but what this story really shows is that a great idea on a whiteboard is pretty much worthless if you can't actually make it happen in the messy, complicated physical world. And this quote from Chris Del Vecchio himself just says it all, doesn't it? The real genius, the actual skill, isn't just in the idea, it's in the implementation. And for that, you absolutely have to have a deep, granular understanding of logistics. So, in the end, the success of the Cusiana Cavern wasn't just one thing. It was this perfect combination of deep logistical and customs know-how, the trust they had built with their partners, and a relentless focus on finding solutions that worked for everyone, not just for them. And that kind of leaves us with one final thought. This story is the perfect example of how a frustrating problem can be transformed into a powerful advantage, just through creative thinking and a mastery of the details. So the real question is, where's a bottleneck in your world that's just waiting to become your next secret weapon?
Today, we are diving into a story from the totally wild, high-stakes world of oil trading. But this isn't your typical tale of some brash, risk-loving trader. Nope. This is about a woman who never even wanted the job, trusted her gut, and made one single bet that pulled in over $10 million. And that really brings us to the craziest part of this whole thing. How in the world did a trader who was getting pressured every single day by her bosses to take on more risk end up being so successful by doing the exact opposite? Okay, let's get into it.
So first up, let's meet the person at the center of all this. Her name is Daphne Teo, and her path to a trading desk was, well, anything but ordinary.
And you gotta hear this quote. I mean, most people in this industry would kill to be a crude oil trader, right? But Daphne, she was perfectly happy in operations. The logistics, the nitty-gritty details of moving actual barrels of oil. The only reason she took the trading job was, and I love this, because they offered me quite good money.
And if you look at her career, you can see she spent years and years on the practical side of the business. Accounts, then operations, physically handling how the oil moved. This wasn't just a job for her. It was her entire education, the foundation for everything she was about to do.
And that right there, that was her superpower. While all the other traders were just looking at screens and speculating on prices, Daphne had this deep technical knowledge of the real-world costs and headaches. This operator's mindset, that was her secret weapon.
Okay, so she has this totally unique mindset. How does that turn into a giant payday? Well, it all starts in 2015, when the market does something really specific. It creates this massive opportunity. The market went into what's called a steep contango.
So what the heck is contango? To put it really simply, it's when oil is cheap right now, but everyone in the market is betting it's going to be a lot more expensive down the road. It's like a giant flashing sign that says, buy now, sell later.
So how do you actually make money off this? Well, you use a play called floating storage. It's actually a pretty straightforward 4-step deal. You buy the cheap oil, you rent a giant tanker to just hold onto it, you go to the futures market to lock in that higher sale price for later, and then you just pocket the difference, minus what you paid for the boat. Simple on paper, but trust me, the execution is everything. And this is where Daphne's story really kicks into high gear. While everyone else was just starting to figure things out,
She made a big early move.
See, the key here was timing. Daphne saw the patterns, she saw the contango forming right at the very beginning. She knew you couldn't wait until it was headline news, because by then the cost to rent a tanker would just explode and all your potential profit would vanish.
And man, did she go big. She loaded up a single massive ship, a very large crude carrier, or VLCC, with 2 million barrels of Aussie light crude. She parked it offshore near Singapore, and then she waited.
But here's the thing. Making that first bet, that turned out to be the easy part. The real challenge, the real test, came from inside her own company.
I mean, just imagine being in her shoes. Her competitors, all the big trading houses, they're chartering 4, maybe 5 of these giant tankers each, and so the calls started coming in from headquarters every single day. Why only one ship, Daphne? Why aren't you doing more?
And the pressure just got worse and worse. It stopped being about strategy and started getting personal. They were questioning her judgment, her ability, even her integrity. They were basically asking her, why can everyone else do this, but you can't?
The Daphne, she didn't budge. She held her ground. Because she knew something that her bosses, just staring at spreadsheets, didn't quite get. All those years in operations taught her a lesson that was about to pay off in a huge way.
And this, right here, is where we see the absolute genius of her strategy. See, for her, it wasn't about how much oil you could store. It was about how you were going to sell it. This quote is everything. It's the key to her whole philosophy. For her, the hardest part of any trade isn't getting in. It's getting out with a profit. She knew that the second the contango started to fade, everyone was going to stampede for the exits at the exact same time.
And this just lays it all out so clearly. While everyone else was getting greedy, loading up multiple ships, Daphne was focused on one single, manageable cargo. She knew the market couldn't possibly absorb all that oil at once when it recovered. So the other guys, they'd be stuck, forced to sell at huge discounts, and maybe even lose all their money. Her plan? Sell before that chaos even started.
And what happened? Her discipline paid off. Big time. She timed the exit absolutely perfectly, selling those 2 million barrels just before the market turned. The profit on that one ship was over $10 million. It was total vindication for her decision to just say no.
But the story doesn't just end with a giant check, because behind the glamour of a trade like that, there's a much, much harsher reality.
This was what Daphne's life was actually like. She had to watch futures markets around the clock, which meant her workday didn't end until maybe 4 in the morning. For years, she was barely sleeping. It took a massive toll on our family, and eventually her health just gave out. She ended up with a slip disc that was so bad, she couldn't even walk properly. And this quote from her really says it all. The money was obviously great, but it came at a cost she just wasn't willing to pay anymore. That health crisis completely changed her entire perspective on what success actually means. And shortly after that, in 2016, she walked away and retired.
So as we wrap this up, it really leaves us with a pretty powerful question to think about. Is a successful trade just about that final number on the profit and loss statement, or does it also have to include the human cost it took to get there? Definitely something to chew on.
Let's talk about something hiding in plain sight. What if I told you that countries all over the world are sitting on billions, maybe even trillions of dollars in assets, but they're treating them like old junk they've stashed in the basement? Well, I'm talking about national oil reserves. In this explainer, we're going to dig into how this incredibly expensive insurance policy can be turned into a dynamic, value-generating machine.
This quote right here, it gets straight to the point. For decades, the moment you slap the label strategic on something, it's like it gets a free pass. We stop asking the hard commercial questions. But should we? We're about to find out why that kind of thinking is seriously overdue for a change. Okay, so first things first, let's make sure we're all on the same page. What in the world is a Strategic Petroleum Reserve, or an SPR? Think of it like a country's giant emergency fuel tank. The whole idea is pretty simple. If a major disaster hits, a war, a hurricane, anything that cuts off the oil supply, a country can dip into this stash to keep the lights on, keep trucks moving, and basically prevent total chaos. It's an insurance policy against disaster. And that brings us to our first really big idea, thinking of these reserves as the world's most expensive insurance. And here's the problem. Most governments treat it exactly like that. They buy the policy, which is the oil itself, they pay the annual premiums, for storage and financing, and then they just let it sit there.
But doing that, just letting it sit, comes with these massive hidden costs. So, where does this whole insurance policy idea come from? Well, it comes down to this number, 90 days. This isn't just some random number they pulled out of a hat. The International Energy Agency, the IEA, actually requires its member countries to hold enough oil to cover 90 days of their net imports. It's been the gold standard, the bedrock of energy security, for a really long time. So because of that rule, and let's be honest, because of politics, the default mode for pretty much every government is to do, well, nothing. It's just the safest move for a politician, right? Buy the oil, pump it into a giant underground salt cavern or a tank farm, and just sit on it. But as you're about to see, this do-nothing strategy means leaving an absolutely staggering amount of money on the table. But what if there was a better way? Well, for that, our story has to jump all the way to South Africa, where a totally unique set of crises back in the early 90s basically forced a small, scrappy team to tear up the old rulebook and write a completely new one for managing these strategic assets. You couldn't have written a more dramatic script. It was a total perfect storm. In 1990, right as apartheid was ending, South Africa's Strategic Fuel Fund was under unbelievable pressure. Iraq's invasion of Kuwait sent oil prices through the roof, which suddenly made them realize the huge financial risk they were sitting on. The country's whole game changed. It wasn't just about getting oil anymore. It was about managing the massive cost of that oil. And it was that intense pressure that lit the fuse for a revolution in thinking. And this, right here, was the light bulb moment. This is the key. The team at the SFF, they looked at their 125 million barrels of oil, this enormous reserve they'd built up during sanctions, and they saw something nobody else did. It wasn't just dead weight sitting in a cave. It was a powerful, dynamic financial tool that could actually be put to work. So how on earth did they do it? This is where we get into the really cool financial stuff. Essentially, they figured out how to use the natural ups and downs of the oil market, specifically the difference between today's price and tomorrow's price, to make their oil reserve actually pay for itself. Now, to get what they did, you just need to understand two key ideas, backwardation and contango. It sounds complicated, but it's not, I promise. Backwardation is when the future price of oil is lower than the price today. That's a huge opportunity, right? You can sell your oil high right now and sign a contract to buy it all back later for cheaper. Contango is just the opposite. The future price is higher, which means you could buy oil cheap today and lock in a guaranteed profit by selling it forward.
All right, let's look at a real-world example so you can see this magic in action. There was a European agency that had a bunch of old, low-quality, sour crude oil. What they really wanted was a better quality crude for their refineries. So, step one, they sold all that old oil at the current high market price. Step two, and this is crucial, they immediately hedged. They locked in a price to buy new oil 6 months down the road. Now, because the market was in backwardation, that future price was $6.50 a barrel cheaper. That's pure profit. So, step four, they used that money to buy the better, higher quality crude at that lower future price. And the result? I mean, it's just incredible. They gave their entire oil reserve a full upgrade to a much more useful, higher quality type, and it cost them absolutely nothing. It was free. Just by being clever and using the shape of the market, they turned a huge potential expense into a massive win for the country.
So this all sounds like a no-brainer, doesn't it? It just seems so logical. Which leads to the really obvious question, why in the world isn't every country with a strategic reserve doing this? Well, the answer comes down to something we'll call the bureaucratic wall. This quote just nails the problem perfectly. If you're a government official, think about your personal risk. It's totally lopsided. If you try something new and it goes wrong, even a little bit, you could get fired. But if you try something new and it goes right and you save your country millions of dollars, you don't get a bonus, you don't get stock options, there's zero personal upside. So the incentive is always to play it safe and do nothing. And you can literally see the result of this thinking on a global scale. It's almost always the smaller, more nimble countries, places like South Africa, Israel, Taiwan, that have been willing to try these smarter, more efficient strategies. Meanwhile, the bureaucratic giants, the US, China, Japan, the countries with the biggest reserves on the planet, are often just stuck, tied up in old laws and a culture that punishes any kind of risk-taking. So all of this brings us to a much bigger, more fundamental question. This isn't just about managing oil a little bit better. It's about asking ourselves what energy security even means here in the 21st century. I mean, just think about it. That 90-day rule from the IEA, it was designed for the world of the 1970s and 80s, a world of oil shocks and OPEC. Today's energy world is completely different. We've got renewables, we've got hyperconnected global markets, totally new political pressures. And yet, this core policy hasn't really changed. It's still a clunky, one-size-fits-all solution for a world that needs something much more sophisticated. So what should a modern strategic reserve even look like? Well, for starters, it has to be about way more than just oil. Real energy security today means making sure you have supply chains for rare minerals, for the metals that go into batteries. It means having access to microchips and the stuff you need to build solar panels and wind turbines. It might even include financial tools, like call options, that can protect you from price spikes way more cheaply and flexibly than physical barrels ever could. So here's the bottom line. As the world keeps moving towards renewable energy, our whole idea of what security is has to evolve with it. Just buying up crude oil and hiding it underground is an outdated, wildly expensive, and ultimately a really incomplete strategy for the future. And that leaves us with one final question to really chew on. What's the real price of security? Is it the billions of dollars we spend to buy and store all this oil? Or is the true price all the opportunities we're missing by not managing these assets smartly and not adapting our thinking to the world we actually live in today? Can you imagine a world without oil traders? Seriously, a world where the price of oil wasn't set on some frantic, screaming market floor, but by just a couple of guys on a phone call? It sounds wild, I know, but that world wasn't actually that long ago. Today, we're going to rewind the clock and tell the story of how the oil trader was born. And that quote right there, that's from a man named Richard Johnstone, an industry vet who was right there in the thick of it when it all happened. His career, you see, is the story of how the oil trader came to be, and how a brand new type of oil from the North Sea, called Brent, was about to change everything. So what did it even look like before trading? Well, back in the 60s, if you walked into a big oil company, you wouldn't find a trading department. Nope, you'd find a supply department, and their job wasn't to play the market or speculate. It was just to sell the oil that their company pulled out of the ground. A much, much simpler world. Marketing was pretty straightforward. You make the oil, you find someone to buy it. But every now and then, these companies would do something called an exchange. And this wasn't about making a profit, it was a straight-up swap. Think of it like a bartering system, but for giant corporations with massive oil tankers. Okay, here's a perfect real-world example. One day, BP realizes it has way too much gas oil, which is a kind of diesel fuel. At the same time, another company, Amerada Hess, has a bunch of heavy fuel oil they need to get rid of. So did some hotshot trader jump in to make a deal? No way. The general managers just called each other up and worked out a direct swap. Problem solved. All handled at the very top. But then, as we get into the 1970s, a whole new character starts to appear on the scene, the trading intermediary. Now, these were companies that didn't own a single oil well or refinery. Their only real asset was being smart and moving fast, and they started finding little gaps to slip into between the slow-moving oil giants. And these first true traders, man, they were real pioneers. You had companies like Bulk Oil and Mobinaft who perfected this trick called breaking bulk. Basically, they'd buy one gigantic shipment of oil and then sell it off in smaller, more manageable chunks. And then you had individuals like the legendary Mark Rich who found a totally different angle. He became the middleman for countries and companies that, for political reasons, couldn't or wouldn't do business with each other directly. And if you really want your mind blown by how different this era was, get this. In 1972, our guy Richard Johnstone sold a whole cargo of Iranian crude oil for $1.27 a barrel. I mean, that's less than a cup of coffee today. It's just unbelievable. And the guy who put that deal together, a young broker who would become one of the most powerful traders in history, Mark Rich. And his commission for making it all happen? A single penny, 1 cent per barrel. From that tiny seed, a global industry was about to grow. Okay, now we hit a real turning point, 1978. After years in the business, Richard Johnstone finally gets a business card with the title Oil Trader. He had just joined the new British National Oil Corporation, or BNOC. And this wasn't just a big deal for him. It was a sign that the whole industry was changing. The job was now official. It finally had a name. And Johnston's new gig at BNOC put him right at the epicenter of the next big thing, the UK's massive new oil discoveries in the North Sea. A huge new wave of high-quality oil was about to hit the market, and it was going to need a name. And here's a great little bit of industry folklore for you. The story goes that Shell Esso, the company developing the fields, originally planned to just name them alphabetically. AUK, BUK, CUK, you get the picture. Well, they pretty quickly figured out they were going to have let's call it a marketing problem when they got to the letter F. So, quick pivot. AUK became AUK, named after the seabird, and that set the new pattern. Brent for the Brent goose, cormorant, dunlin, eider, and just like that, a legendary benchmark was born. Then came the big day. November 1978. Up at the brand new Sullom terminal in the Shetland Islands, the very first cargo of what we now know as Brent crude was loaded onto a tanker. And the team that sold it? You guessed it, Richard Johnston's team at BNOC. That first shipment sailed off to a refiner in Germany, and the Brent era had officially begun. But here's the thing. Brent didn't become a global superstar just because it was good oil. No. Its destiny was about to be forged in the fire of a massive geopolitical crisis that erupted at the exact same moment it was born. I mean, the timing is just incredible. In November 1978, the exact same month that first Brent cargo set sail, oil workers in Iran went on strike, and production just collapsed. A few months later, the Shah's overthrown. By the next November, the U.S. bans all Iranian oil. So in the span of just 1 year, the world lost one of its biggest oil suppliers and was absolutely desperate for a replacement. The impact was immediate and, frankly, chaotic. You had a massive global oil shortage that sent shockwaves through the entire world economy. In just 12 months, the price of oil more than doubled. The world was officially in an energy crisis, and those brand new oil fields in the North Sea, well, they suddenly looked like the most valuable real estate on the planet. Now, crisis for some means opportunity for others. With the U.S. freaking out and desperate for oil that wasn't from Iran, BNOC suddenly found itself in the driver's seat. They were in a seller's market, and they decided to use that power to change the rules of the game. So, how'd they change the game? They changed how the oil was actually sold. Okay, so traditionally, sales were what's called free on board, or FOB. That basically means the buyer is responsible for everything, arranging the ship, paying for it, all of it. BNOC's genius idea was to flip that around. They started selling on a delivered basis, where they, the seller, handled all the shipping. It sounds like a small change, but it was huge. It shifted all the power from the buyer to the seller. So Richard Johnstone put together this small commando team, a shipping guy, a lawyer, an oil technician, and they went on a mission to America. They went all over, Houston, Oklahoma, Chicago, New York, pitching this new delivered sales model. And because the American refiners needed the oil so badly, they all said yes. The mission was a massive success, and they basically rewrote the rules for how oil was sold across the Atlantic. Johnstone tells us an amazing story about the culture shock he felt on that trip. He was driving between cities in Oklahoma, and he's seeing these little nodding donkey oil pumps just chugging away in people's backyards, pumping out maybe a few barrels a day. It was a completely different universe from the gigantic, high-tech, state-of-the-art platforms he was used to in the North Sea. It just showed how two totally different oil worlds were colliding. And that road trip, it ended up being so much bigger than just selling a few shipments of oil. It pioneered a trade route across the Atlantic that would go on to define the relationship between the world's two most important oil prices for decades to come. Because after that, North Sea production just went vertical. I mean, from almost nothing in 1975, it shot up to 1.5 million barrels a day by 1980, and then 2.5 million by 1985. This new river of oil was flowing west, and it perfectly filled the huge hole that Iran had left in the market. And this created a really simple but incredibly powerful economic formula. Think about it. For it to make sense to ship Brent all the way to America, the price of American oil, which we call WTI, had to be just high enough to cover the price of Brent plus the cost of shipping. For decades, that simple math was the bedrock of how global oil was priced. And that predictable relationship held up for over 30 years. It was like clockwork. Then, around 2010, the U.S. shale boom happened, and it just blew the whole system up. Suddenly, America was drowning in its own oil. And in a really wild twist of history, that trade route Johnston's team built has now completely reversed. Today, American oil flows east from the US to Europe. And all of this leaves us with a really fascinating question. The same forces that created the Brent benchmark in the first place, geology, politics, technology, they're all shifting again. The one thing this story proves is that in energy markets, nothing stays the same for long. So you have to wonder, what comes next?
So over in Western India, there's this oil refinery, and it is so massive, so unbelievably advanced, it can process pretty much any type of crude oil you can find on the planet. But, its real secret isn't just its size. It's this hidden competitive advantage that has made it a true legend in the industry. Okay, let's dive into this and really uncover the strategy behind the world's most flexible refinery.
First things first, let's just talk about the sheer scale here. The Jamnagar refinery, which is run by Reliance Industries, can process a staggering 1.4 million barrels of crude oil every single day. I mean, that makes it the largest single-site refinery in the entire world. But size alone, well, that doesn't even begin to tell the whole story. This quote from Reliance's own head of physical trading, it just gets right to the heart of everything. Just try to imagine having a team that can confidently look you in the eye and say they will never turn down a type of crude oil. It immediately makes you ask the question, how is that even possible? What is the secret sauce behind this incredible flexibility? Well, the answer really starts with the refinery's DNA, you could say. From the moment it was commissioned way back in 1999, it was built with one single vision in mind: achieve the maximum possible flexibility right from day one. Now, this vision was pretty radical for its time and place. See, the kind of complex design you need for this level of flexibility was common in the US Gulf Coast, sure, but it was almost unheard of in Asia. So by building a US-style refinery in a market that played by a totally different set of rules, Reliance was setting itself up for a massive challenge and an even bigger opportunity. And this brings us to how their flexibility became, well, a superpower. You see, traditional Asian refineries were kind of stuck in this very rigid system, and Reliance saw this rigidity not as a rule they had to follow, but as a weakness they could totally exploit. And wow, this slide just illustrates the difference perfectly. The old way over on the left was all about just securing supply, locking into these long-term contracts, mostly from the Middle East. It made them stable, I guess, but also incredibly slow and really vulnerable to market shifts. But then you have Reliance on the right. They took the exact opposite approach. They prioritized being nimble, being quick on their feet, using fewer long-term contracts so they could adapt to whatever the global market was throwing at them. So here's the crucial point. For Reliance, a refinery isn't just some big machine for processing oil. No. It's a tool for adding value. The real business is intelligently responding to global price shifts, to freight costs, to product demand, by constantly changing what you feed the machine. But, having a flexible refinery is one thing, using it effectively is a whole other story. This requires a pretty unique strategy, one they call their techno-commercial edge. So what does that actually mean? Well, it means they absolutely refuse to separate the technical problems from the commercial ones. At Reliance, there is no wall between the engineers who run the refinery and the traders who go out and buy the oil. They solve problems together as one integrated team. Here's kind of how it works in practice. A trader might spot a really difficult, tough grade of crude oil that's selling at a deep discount. Now, instead of just passing on it, they go directly to the refinery engineers. And together they ask the question, okay, this is going to be technically challenging to process, but is the commercial upside, the money we can make, big enough to make it worth our while? If the answer is yes, they execute as one team. Simple as that. And the result of this whole strategy? Jamnagar has successfully processed over 225 different grades of crude oil. Just think about that number. That's more than almost any other refinery on Earth. It's a direct testament to their absolute willingness to experiment. I just love this quote. It radiates pure confidence, right? It shows that their appetite for new and different types of crude is so voracious that if there's a grade out there they haven't run, it's probably because it just doesn't make financial sense for anyone. And here's the proof in the pudding. They were absolute pioneers, the first to process new grades like Iraq's Basra Heavy, and the first in all of Asia to take on Canadian heavy grades long term. Their process is so dialed in that they can sometimes approve a new crude without ever even seeing a physical sample, taking these calculated risks that others just wouldn't dare to take. Okay, so a brilliant strategy and a super high-tech refinery are great, but they're nothing without the right people. Technology is only half the story here. The other half is the unique human element that powers this entire operation. This is so incredibly clever. Instead of hiring traders and then trying to teach them all the complicated engineering, Reliance does the exact opposite. They hire people with technical engineering backgrounds, people who understand the refinery inside and out, and then they groom them in the commercial side of the business. Their internal training program is so effective, it's become known informally across the industry as Reliance University. They're not just building their own team. They've actually become a globally recognized pipeline, developing top-tier talent that goes on to work across the entire oil trading world. And this human expertise is absolutely critical. Because think about it, they deal with everyone, from these massive state-owned national oil companies to small, nimble trading houses. So they have to adapt their negotiation style constantly. It's a people-centric business, and they've truly mastered the art of relating to just about everyone. So what's next for a refinery that has already mastered flexibility? Well, the story is now evolving to meet the huge challenges of the future of energy. If you look at this timeline, you see this really clear pattern of innovation. From its commissioning to hitting that 200 crude grades milestone, the next major chapter came in 2021, when Jamnagar received the world's first major shipment of so-called carbon-neutral crude oil. So what does that actually mean? Well, Occidental Petroleum supplied them with 2 million barrels of U.S. crude. The key here is in the how, the greenhouse gas emissions that were associated with the entire life cycle of that oil were offset. And this was done by bundling carbon credits with the oil shipment, basically creating a new kind of structured product for a rapidly changing world. And this brings us to our final thought. The story of Jamnagar is really one of mastering change by building in the ability to adapt from the very beginning. It really makes you wonder, as technology, markets, and our entire energy system continue to evolve at lightning speed, is this kind of radical, built-in flexibility the only true key to survival? Let's talk about a moment that didn't just change a country, it redrew the map of global energy. But this isn't really a story about oil. It's about a true pioneer right at the heart of it all. A woman whose name you probably don't know, but whose impact, well, it's still being felt in a huge way today. And this is her Bridie Tobin, in her own words. Pretty humble, right? She chalked her incredible career up to basically luck and good timing. But as you're about to see, it took a whole lot more than just good fortune to survive, let alone thrive in the world she stepped into. So that's really the big question we're digging into here. Was she just lucky, or was she a pioneer who saw an opportunity that the people in charge just couldn't see? You have to wonder, did being an outsider actually give her an edge? Okay, so let's set the scene. The year is 1963. A young Bridie Tobin, fresh out of college with a science degree, gets a job at Shell International. Now, this wasn't just any job. This was like finding a crack in the wall of a fortress built by and for men. So if you look at her early career, you see this steady, impressive climb. From London to The Hague, then jumping over to the faster-paced world of independent trading, and eventually becoming head of supply and trading. For a woman in that era, that career path was, well, it was basically impossible. It just didn't happen. And to really get it, you have to see the world she walked into. I mean, look at this. The numbers are just staggering. In 1963, Shell hired hundreds of male graduates, and just 5 women. 5. Before that, women were only hired as secretaries. So she wasn't just in the minority. She was basically a statistical anomaly. So you can imagine, from day one, she wasn't just doing a job. She was fighting a culture that wasn't just, not used to having women around in professional roles, but was actively, and sometimes openly, hostile to the very idea. This quote, wow, it just says everything, doesn't it? She's in a salary review, a meeting about her professional future, and instead of talking about her potential, her boss makes a bet that she'll be married and gone within a year. It wasn't just a bad joke. It was this deep-seated belief that her ambitions weren't even real. And that resistance went way beyond just some condescending comments. It gets worse. On an early business trip to Shell's huge Pernis refinery in the Netherlands, she got a full-blown masterclass in what it means to be excluded. Okay, let's just walk through what happened here, because it is absolutely wild. As she's touring the facility, workers are just whistling at her nonstop, all because she's a woman wearing a red coat. Then, at lunch, she walks into the senior dining room and the entire place goes dead silent. Turns out no woman had ever eaten in there before. Then, it gets even more direct. The refinery managers actually call her boss in London and demand they send an appropriate person next time. And when that didn't work, they just upgraded the meetings to a level she wasn't allowed to attend. They literally rewrote the rules on the spot, just to kick her out. Unbelievable. But here's the thing. While Britty is fighting these personal one-on-one battles, the ground underneath the entire oil industry is starting to shake. The old, rigid, comfortable way of doing things was cracking, and those cracks were creating opportunities for people who could think on their feet. You really gotta understand this shift. The old way was this cozy club run by a few giants called the Seven Sisters. Everything was predictable, based on handshakes and long-term deals. But then, boom, global crises, wars, embargoes, they shattered all that. The new way, spot trading, was chaotic, fast, and messy. All of a sudden, when there's a shortage, it doesn't matter who you play golf with. All that matters is who can get you the oil. And that chaos, well, that's where the opportunities are. So into this chaotic, changing world, something huge is about to happen. We're heading out to the North Sea, where a country that most people weren't really paying attention to is about to hit the jackpot. An American company, Phillips Petroleum, had been looking for oil in Norwegian waters for 2 solid years, and had found nothing. Absolutely zip. They were done, ready to pack up their rigs and go home. The whole venture was seen as a complete and total failure. And this is where the story gets kind of crazy. The only reason they drilled one last well was because their contract forced them to. It was literally cheaper to drill another hole and find nothing than it was to pay the fine for quitting early. And that final, last ditch, might as well, it struck the Echo Fisk field, one of the largest oil fields in the world. So, guess where Bridie Tobin was when this history-making news broke? Of course she was. She was right there. She's in a meeting in Oslo when her manager gets pulled aside. The news is electric. Phillips has struck oil. At the very moment Norway's entire destiny changed forever, she was in the room. Talk about the right place at the right time. And this is where it all comes together. So you've got this massive discovery, but there's a problem. The Norwegian government, very proudly, insists that its oil has to be refined on Norwegian soil. The catch? Phillips, the company that found it, doesn't have a refinery in Norway. But you know who does? Shell. And who's sitting right there in the middle of it all with the knowledge to connect the dots? Bridie Tobin. She gets the assignment, draft the contract to process the very first barrel of Norwegian oil. Now, that contract, it wasn't just another piece of paper. It was the starting gun for one of the most incredible national transformations modern history has ever seen. So on August 4th, 1971, that's the day it all becomes real. The first Norwegian crude oil arrives. For a country that was, relatively small and not particularly wealthy at the time, this moment was everything. It was the dawn of a new age. And what Norway did next was just genius. They basically built their future on 2 pillars. First, they created their own state oil company, now called Equinor, to make sure they stayed in control of their own resources. And second, they created a massive state investment fund, basically a giant savings account for the entire country to turn oil money into permanent wealth. And the result of that smart thinking? Just look at that number. That fund, which all started with the oil that flowed from deals like the one Bridie Tobin put together, is now worth $1.7 trillion. That's trillion with a T. It is one of the biggest pools of money on the entire planet, and it basically guarantees Norway's prosperity for generations to come. So let's bring it back to Bridie one last time. Through all the dismissals, all the condescension, she looks back on this as a defining moment. The woman who was told her career was just a pit stop on the way to getting married, she helped lay the commercial cornerstone for a $1 trillion legacy. How about that? So it leaves you with this thought, right? How much of history is actually written by the people who are told over and over again, no, you don't belong here? Bridie Tobin's story proves that it wasn't just about being lucky. It was about having the resilience and the brilliance to still be in the room when that moment finally came.
All right, today we're jumping right into the high-stakes world of oil trading.
We're going to unpack this incredible story about a trader's brilliant, totally counterintuitive plan to launch a brand new product. A product that, well, the market just didn't want.
So put yourself in this spot. Imagine this is your challenge. You've got a brand new crude oil. We're talking millions of barrels of the stuff. But every single potential customer, they're skeptical. They're set in their ways. They're not looking to change. So how do you convince them to take a huge chance on something completely unproven?
You know, one of the traders, David Gerbanese, he really sets the stage perfectly with this quote. For him, this wasn't just another deal. No way. This was one of those rare, career-defining challenges that was going to take some serious imagination and, like he said, just a ton of extra work.
Okay, so let's set the scene. The year is 2001. A massive new pipeline, we're talking 1,580 kilometers long, has just started pumping. It's bringing a brand new crude oil called CPC blend all the way from Kazakhstan to the Black Sea. Sounds great, right? Well, there was one tiny problem. Nobody wanted it. See, here's the thing about oil refiners. They are absolute creatures of habit. Their facilities cost billions of dollars, and they are fine-tuned to run on very specific types of crude. So trying a new one, that's a huge, huge risk. It can take months, literally months, to process it and even see if it worked. So unless you're going to offer it at some kind of crazy discount or do some serious convincing, they're just not interested. End of story.
So the trading team over at Chevron knew they couldn't just let this fail. They had to tackle all that skepticism head on. And look, they couldn't just slash the price. That wasn't the goal. Their job was to establish its true value in the market. So they came up with a plan to earn the market's trust.
And their whole plan, it really boiled down to 3 key promises. First, they had to guarantee a steady, consistent supply, no interruptions. Second, they had to assure buyers that the quality of every single barrel would be exactly the same. And third, they had to come with the receipts, the hard data to prove this new oil would perform great in pretty much any refinery.
So to nail down that quality problem, they got really proactive. They didn't just sell whatever came out of the ground. No, they actually engineered a specific blend. They fixed the quality at a really attractive 45 degrees API with low sulfur. What they ended up with was this premium, super consistent product designed from the ground up for their #1 target market, European refiners. And you know what? The strategy worked. It actually worked. Refiners started buying it. But, and there's always a but, right? This early success created a brand new and honestly a much more dangerous problem. They had hit a wall. Hard. The crisis was, at its heart, a simple supply and demand problem. Every single month, they had 5 cargoes of this CPC blend that they needed to sell. Now, they could pretty easily sell 3 of them to their new customers in Europe, no problem. But what about the other 2? Well, those 2 extra cargoes, they had nowhere to go. The European market was totally saturated, and those 2 leftovers were starting to poison the price for all 5 cargoes.
And this right here, this is the moment of truth. The trading team comes up with an idea. Let's sell the extra oil somewhere else, even if it's at a discount. But senior management, they pushed back. From where they were sitting, it just looked like losing money. Their question was pretty simple. Why would we discount it to sell it somewhere else when you just proved you can sell it for a high price right here in Europe?
Right, but here's what the traders knew that management couldn't quite see yet. With 2 extra unsold cargoes just floating around Europe, the next sale wasn't going to be at that high price. No way. The value was about to completely collapse. We're talking maybe by 50 cents or even a full dollar per barrel. They had to get that excess oil out of Europe, and they had to do it fast.
And this critical moment, this is what led to the trader's gambit. It was an audacious, incredibly complex, and, on the surface, a totally unprofitable plan to ship that unwanted oil halfway around the world, all the way to Asia. And the logic here was just brilliant. So yes, they were going to sell those 2 problem cargoes to buyers in Asia for less than what they were getting in Europe. But, and this is the genius part, by physically removing that oil from the European market, they would shrink the supply. That would protect or support the high price they were getting for the other 3 cargoes. It was a classic strategic loss for a much, much bigger win.
And this journey, wow, it was unbelievably complex. This wasn't just, putting oil on a boat and waving goodbye. Oh no. The oil was loaded in the Black Sea. Then it was transferred ship to ship onto a massive supertanker out in the Red Sea. Then it sailed all the way to the South China Sea, where it was offloaded again onto smaller ships that could actually navigate up China's rivers to reach those inland refiners. Just incredible.
Think about that. The entire journey, from the oil field in Kazakhstan to the final customer deep inside China, took 3 whole months. It was just this incredible logistical feat. And the whole thing was designed to solve a supply and demand problem happening thousands of miles away, back in Europe.
But wait, there's one final twist to this whole story, and it's a big one. It turns out, this whole elaborate marketing scheme, it was really just a solution to an even bigger, more fundamental problem, a problem that existed long before CPC blend was even a thing.
Okay, so let's rewind the clock a bit. Before this fancy new pipeline was built, Chevron's oil from Kazakhstan had to travel through Russia's pipeline network. That system was run by a company called Transneft. And well, Transneft had let's call it a peculiar rule about how they valued the oil that went through their pipes.
And this, right here, was the real core of the problem. See, Chevron was producing a really light, high-quality oil. But the second it entered the Russian pipeline, Transneft basically said, we don't care. They treated all oil as if it were their own, lower-quality Urals blend. So what does that mean? It means Chevron's premium product was getting systematically devalued, costing them an absolute fortune on every single barrel.
So when you look at the big picture, the entire CPC project, the billion-dollar pipeline, the creation of this new CPC blend, the crazy complex global marketing plan, all of it, it was one giant ingenious solution to one core problem, figuring out how to get paid the true value for their high-quality oil by completely avoiding that quality loss they were suffering in the Russian system.
And really, it all comes back to this one central idea. The physical market for crude oil, it's like an enormous global jigsaw puzzle. It's not just about buying and selling. It's about seeing all the different pieces, the logistics, the quality specs, the regional demand, even the market psychology, and figuring out how to fit them all together to create a picture that nobody else even sees yet. You know, this incredible 3-month journey of just one product, it really pulls back the curtain on the hidden economic and logistical webs that hold up our entire global economy. And it really makes you wonder, doesn't it? What other invisible journeys, what other brilliant gambits like this one are quietly shaping the world around us every single day?
All right, let's get into it. Today, we've got a story about huge financial stakes, high-risk international diplomacy, and some truly life-or-death decisions. And it all revolves around crude oil. This is the incredible story of how a critical grade of crude oil basically became a quality lottery and how one team managed to turn a completely unsellable product into a global success.
So to really get this story, you've got to understand the world it's happening in. And this quote from Thomas Loven Anderson, who's really our central figure here, just nails it. This isn't a job with quarterly reviews, right? This is a world where your success or failure is tallied up in real time, every single minute of every day. The pressure, both financially and just psychologically, it's enormous.
And right at the heart of our story is this, Basra crude. Now for Iraq, this isn't just another export. It is the literal lifeblood of the entire nation. The money from selling this one thing funds the government, pays for roads and hospitals, and basically keeps the country running. So you can see, any problem with Basra crude isn't just some market issue. It's a full-blown national crisis.
And that national crisis really kicked off back in 2014. A huge new oil field, West Kurna 2, came online. But the oil it produced was different. It was heavier, it had more sulfur. And the critical thing here is that Iraq just didn't have the infrastructure to keep it separate. So what did they do? They just started dumping this new, different crude right into the main, well-established Basra Light stream.
And this slide, man, it just perfectly captures the chaos that caused. Imagine ordering a cappuccino every single day and paying the same price. But some days you get an espresso, some days a latte, and some days you just get a cup of hot mud. That's exactly what was happening to oil refiners. They were buying Basra Light, but they had absolutely no idea what they were actually going to get. It was a quality lottery, and in a business that's built on precision, that is a total disaster.
The market reaction was, as you can imagine, swift and brutal. Buyers were furious. Deals were getting canceled left and right. Some companies just flat out refused to even load the oil onto their ships. The reputation of Iraq's most vital export was literally being destroyed. The risk was just becoming unmanageable, and the whole situation was spiraling out of control.
So, faced with this full-blown crisis, the Iraqi authorities made what seemed like a pretty logical move. In June of 2015, they stopped pretending it was all the same stuff. They officially split the stream.
They kept the original Basra Light and created a brand new grade for that heavier oil, Basra Heavy. Problem solved, right? Well, in solving one problem, they created a completely new one.
Okay, so they solved the quality problem, but now they had a massive marketing problem. All of a sudden, you've got millions of barrels of a completely new, totally unknown and untested crude oil flooding the market every single month. I mean, who is going to buy it? How would they even know what to do with it?
And this quote just says it all. Normally, when you introduce a new grade of oil, it's this careful, slow process that takes like 9 to 12 months. You give little test parcels to refiners, you gather data, you build confidence. Iraq did the exact opposite. They just dumped an ocean of it on the market all at once. For traders, this new Basra Heavy was toxic.
And this table, it just lays out the financial trap perfectly. Iraq's state oil marketer, a group called SOMO, refused to believe that their new grade was worth less. They set the official selling price, the OSP, way too high. So traders like Latasco, which was the trading arm for the producer Lukoil, were legally required to buy the oil from Iraq at this inflated price. But the only way to actually sell it was at a huge discount. They were forced to buy high and sell low on every single barrel. The losses were catastrophic.
I mean, the whole situation was completely unsustainable. So Anderson's team at Litisco came up with this brilliant three-pronged attack to save themselves from financial ruin and, just maybe, create a stable market for this new crude in the process.
So first, they tried reasoning with their own colleagues, the upstream division that was actually pumping the oil out of the ground. But nope, it was a dead end. See, the producers got paid a fixed fee per barrel. Their only incentive was to pump as much as they possibly could, as fast as they could. So the fact that the trading desk was losing millions selling it, well, that wasn't really their problem. A classic case of misaligned incentives.
Okay, so with the internal route totally blocked, they moved on to prong 2, direct persuasion. And this meant flying into what was, at the time, one of the most dangerous cities in the world, Baghdad, to argue, plead, and just try to convince the Iraqi State Oil Company to see reason and lower the price.
And listen, these were not your standard business trips. This slide shows you the reality. While their competitors were all safely holding meetings over video calls, the Litisco team was getting picked up by ex-military guards, traveling in 3-car armored convoys and wearing body armor. They were literally putting their lives on the line for these negotiations.
This experience from Anderson just makes the danger so incredibly real. I mean, can you imagine trying to prepare for a multi-million-dollar negotiation while the building around you is shaking from a nearby explosion? That question they asked themselves, was it really worth being here? That wasn't some abstract thought. The risk was immediate, and it was very, very real.
So the crucial thing to get is that at every single one of these dangerous meetings, they were on completely opposite sides of the table. Litisco needed a lower price just to survive. SOMO's entire reason for existing was to get the absolute highest price possible for their country. But, and this is key, despite that conflict, SOMO really appreciated the fact that the Litisco team showed up in person. That personal commitment built this crucial foundation of trust.
But the high-stakes talks in Baghdad were only one part of the strategy. At the exact same time, Litisco launched this brilliant offensive in the market itself. They realized that telling customers Basra Heavy was okay wasn't going to be enough. They had to prove it. If the market was too scared to do the research and development, fine, Litisco would do it themselves.
And this is where being part of an integrated oil company became their superpower. They basically used their own refineries as a laboratory. They experimented with Basra Heavy, they figured out the best temperatures, the best ways to blend it, all the little tricks to handle it properly. Then, they took all of this valuable proprietary knowledge and they gave it away, for free, to their customers, even to their competitors. They single-handedly de-risked the crude for the entire market.
And guess what? The strategy worked. With their global trading desks in Geneva, Singapore, and Houston, they started finding homes for this supposedly unsellable oil. As you can see, the biggest markets were the super sophisticated refineries in China and India, with a pretty big chunk also heading to the US. They were literally creating a global market out of thin air.
The turnaround was incredibly fast. After taking those massive losses in 2015, their relentless diplomacy in Baghdad finally paid off. By 2016, SOMO had adjusted its pricing and the trade actually became profitable. And just 2 years later, by 2018, the market had evolved so much that these complex, heavy crudes like Basra Heavy were no longer a problem to be solved, but a valuable commodity that was in really high demand.
But the biggest takeaway here isn't really about turning a profit. The real victory was in navigating this absolute minefield of complex human relationships. They had to deal with skeptical customers, uncooperative colleagues, and a foreign government, all while under insane financial and physical pressure. The solution wasn't found in an algorithm, it was found in a handshake.
Anderson himself actually credits their success to this. In the cutthroat world of oil trading, you might think the most aggressive person wins. But in this case, the crucial skills were things like diplomacy, listening, and finding common ground. The ability to seek compromise, a trait he credits to his Danish background. That was the ultimate competitive advantage.
And that kind of leaves us with a final thought, doesn't it? This whole story took place in a world that is driven by live data feeds and minute-by-minute profit and loss. And yet the entire outcome hinged on a willingness to get on a plane, show respect, and build a human connection under the most difficult circumstances imaginable. It really makes you wonder, in our increasingly digital world, what is the real, bottom-line value of looking someone in the eye and shaking their hand?
Okay, so let's get right into it. We're not just talking about day-to-day oil trading here. No, this is a story about a massive structural shift in the entire global energy market. And, more importantly, it's about a trader who saw it coming when pretty much no one else did. This is the anatomy of a once-in-a-decade kind of trade. And this quote? This is the absolute heart of the story. You see, the biggest profits in oil don't come from guessing if the price is going up or down tomorrow. They come from understanding these huge, slow-moving forces that completely redraw the map of how oil flows around the planet. It's about feeling the earthquake before the ground even starts to shake. So to really get this trade, we first have to talk about a fundamental rule of oil pricing. I mean, for decades, this was basically gospel, a rule that was about to get completely shattered. It all boils down to this: sweet crude versus sour crude. Just think of sweet crude, like Brent, as the top shelf stuff. It's got less sulfur, it's way easier for refineries to process, so naturally, it's always been more expensive. Sour crude, on the other hand, is the tricky stuff. More sulfur, harder to refine, and because of that, it's always been cheaper. Simple, right? The premium product costs more. But then, back in 2010, the market just started doing something bizarre. This core principle that sweet crude is always worth more than sour crude, it just started to crack. And for any trader who was actually paying attention, this was a huge signal that something profound was happening way below the surface. Now, the epicenter of all this weirdness wasn't London or New York. Nope, it was Asia. And what was going on over there was creating a massive and very specific problem. You see, for years, Asian refineries had been pouring billions into upgrading their facilities so they could process that cheaper, sour crude. So, as you can see, their demand for it went through the roof. But, and this is the kicker, just as their demand was peaking, OPEC went and cut production of that exact type of oil. So you end up with this insane situation, huge demand chasing an incredibly tiny supply. And the result of that squeeze? It was immediate and it was dramatic. That price difference, that premium that sweet crude always had over sour crude, it just vanished. Poof! The market was so desperate for sour crude that they were willing to pay just about anything to get their hands on it. For traders, the key number to watch is this one, the Brent-Dubai spread. Think of it as the official scoreboard for the price difference between the good stuff and the cheap stuff. And in 2010, this scoreboard started spitting out numbers that made absolutely no sense. I mean, this shows you just how wild things got. The spread didn't just get narrow, it actually inverted sometimes. Can you imagine going to the supermarket and the generic store brand cereal costs more than the fancy name brand box? That's literally what was happening in the Asian oil market. It was a flashing red light that the market was fundamentally broken. So when he's looking at this totally upside-down market, our trader starts hunting for clues. He's not just asking what is happening, he's asking the much more important question, why? And what he found was this perfect storm of events that have been brewing for years. First, you had the Asian refineries upgrading all through the 2000s. Then, bam, the 2008 financial crisis just crushes demand. So what does OPEC do? They cut their output of those sour grades to prop up the price. By 2010, all of these things collided to create this totally artificial, extreme shortage. And here it is, the big red flag that confirmed his whole theory. His firm started buying sour crude way over in Colombia, shipping it all the way across the Pacific to Asia, and making a killing. Now that is not normal. If you can make a ton of money shipping oil from halfway around the world, it means the price in that local market is completely inflated and unsustainable. This was the bubble.
Okay, so knowing the market was in a bubble wasn't enough. The billion-dollar question was, what was going to pop it? Well, the answer, it turns out, was flowing from Russia.
This right here is the game changer, the Eastern Siberia Pacific Ocean Pipeline, or ESPO for short. It was this massive new piece of infrastructure designed to do one thing, and one thing only: deliver huge volumes of Russian medium sour crude, the exact type of oil Asia was starving for, right to their front door. So, this led to the core prediction, the whole thesis of the trade. Once that ESPO pipeline came online in early 2011, that desperate shortage of sour crude would be over. Supply would come flooding in, the price for sour crude would fall back to earth, and the Brent-Dubai spread would violently snap back to normal. The market was going to recalibrate. Look, having an insight like that is one thing, but having the conviction to place a massive, massive bet on it, that's something else entirely. So how do you even structure a trade to catch a multi-year market correction? Well, they use this incredibly clever structure called a box trade. Let's break it down. Think of it in two parts. First, they made a bet that the price difference would stay super narrow through the end of 2010, basically profiting from the last gasps of the bubble. Then, for the main event, they placed a much bigger bet that the price difference would widen out dramatically by the middle of 2011, right after ESPO came online. And the genius of doing it this way was that it actually reduced how much cash they had to put up front, which let them make their overall bet much, much bigger. And that was it. The positions were set, the analysis was done, and now came the absolute hardest part of any big trade. Just sitting there and waiting for the world to catch up to your idea. And believe me, it was stressful. I mean, a million things could have gone wrong. OPEC could have changed its mind, a refinery could have had an outage, but the analysis held. The market started to turn, slowly at first, and then all at once. So here's the first part of the payoff. At the end of 2010, the spread was still crazy tight, sitting around $2. Their short-term bet that the bubble would last just a little bit longer? Winner? But then, as that new ESPO crude started to flood into Asia, the main event happened. By April of 2011, the spread absolutely exploded to between $5 and $6. A massive, massive move. The market had violently corrected itself, exactly as they predicted, turning the trade into a phenomenal success. So what's the big lesson here? What should we take away from this? It's that the really huge profits, they don't come from the day-to-day noise. They come from identifying these massive, multi-year recalibration events. It means you have to zoom out and understand how these giant forces, like a new pipeline or shifting demand or geopolitics, are all going to slam into each other down the road. And in the end, it really all comes down to this. These kinds of tectonic shifts in the market, they're rare. They don't happen every year. But when you spot one and you've done the deep, hard work to really understand it, you have to have the guts to back your analysis all the way. Which, it leaves us with a really fascinating question. The ESPO pipeline totally redrew the energy map for Asia a decade ago. Today, we're seeing these huge shifts with electric vehicles, with LNG, with the green energy transition. The lesson from this trade is crystal clear. The biggest opportunities are probably hiding in plain sight, just waiting for someone to connect the dots. The only question is, what's going to be the next big one? Whenever you hear about the price of oil on the news, it sounds so official, right? So stable. But what if I told you that for decades, that global price has been set by a benchmark that wasn't born in some quiet boardroom? Nope. It was forged in absolute chaos. And the story of how it all went down is just incredible. And this quote, this is the moment we're building towards, a moment of pure, raw panic on the trading floor that would, somehow, against all odds, give birth to a legend. It's a high-stakes story of a market in total collapse. And believe it or not, it all starts with a kid just running errands. So to really get how the world's most important oil contract even came to be, you gotta meet our guide, Thomas McMahon. His journey starts right here, on the crazy, bustling trading floors of New York, way before oil was even a blip on his radar. McMahon literally learned the business from the ground up. I mean, before he could even drive a car, he was running physical delivery documents all over Wall Street. And this wasn't just some summer job, okay? He was learning the real-world plumbing of the markets, the gritty, tough details most traders never, ever see. So by 1978, he had the experience, but he still needed a lucky break to get into the pits himself. That's right.
The man who would end up witnessing the birth of the global oil benchmark, he got his start thanks to orange juice. He was handling the hedges for a group of Florida producers, helping them manage their risk in the futures market. And then, well, nature decided to intervene. So a massive freeze just hammers Florida back in 1978, and orange juice prices go through the roof. McMahon's clients made an absolute fortune. And as a thank you, they gifted him 2 extra contracts they had. He turned around and sold them for $24,000, which was just enough to buy his very own seat on the exchange. Finally, he was off the phones and into the trading pits. Okay, so right around this time, the energy markets were a total mess. After the oil embargoes in the 70s, everybody knew there had to be a better way to hedge risk, to create a single, reliable price for crude oil. The first attempt, though, it was a complete and utter flop. The first crack at an oil contract, this one based in Rotterdam, was just way too big. We're talking 100,000 barrels. Only a major oil company could even think about trading it. So in March of 1983, the New York Mercantile Exchange, or NYMEX, they launched something totally different. West Texas Intermediate, or WTI. It was smaller, based right here in the US, and designed for the exact kind of scrappy traders already on the floor. Well, you'd think so, wouldn't you? They fixed all the problems, they had the perfect audience of traders ready and waiting, but it wasn't that simple. Not even close. The WTI contract struggled badly. The big oil companies, the whole establishment, they wanted nothing to do with it. Trading was painfully slow. I mean, can you imagine an order that would take seconds to fill today, taking 2 weeks? So for 3 years, from 83 to 86, WTI was this humble little niche market, kept alive only by speculators and independent oilmen. It really had yet to prove its worth. And then came April 1986. A massive global glut of oil had been building up. Saudi Arabia had opened the taps wide open, and now the market was about to break. This was it. This was the moment that was going to make or break the WTI contract forever. So the day before the storm hits, oil is sitting at $24 a barrel. Traders go home for the night with their bets placed, some long, some short. But no one, absolutely no one, could have predicted what was waiting for them at the opening bell. The next day, the market didn't just drop. It fell off a cliff. It opened at $11. In an instant, fortunes were just wiped out. McMahon says the scene was manic. More people crammed in the pit than he'd ever seen. The panic was real. And it wasn't even close to being over. Within moments of that chaotic open, the price slammed down to $9, a total, complete collapse. If you had bet on prices going up, you lost everything in the blink of an eye. The selling was just relentless. And then, something happened. The market fell so fast, so hard, that it triggered a mandatory circuit breaker, a 2-minute pause. Everything just stopped. The shouting, the trading, the panic, it was all frozen in time. And in that dead silence, that's when the real terror set in. Just try to imagine that silence. For 2 minutes, nobody knew if the bottom was $9, or $5, or maybe even $1. The entire global oil market was in an absolute freefall, and these traders were standing right at the epicenter, just waiting for the bell to ring again. They were literally staring into the abyss. But what happened after those 2 minutes? That's what forged a legend. When the market reopened, something absolutely incredible happened. Those traders, the so-called whack jobs on Wall Street, they did their job. They stepped in, they started buying, they found the bottom. What this really means is that the WTI pit became the market of last resort for the entire planet. At a moment when literally no one else in the world was willing to buy oil, the traders on the floor of the NYMEX were. Their bids were the only thing that stopped the collapse. So that one single day proved 3 crucial things. 1, the pit could find a price, even in a total, blinding panic. 2, the exchange guaranteed every single trade, so there were no defaults, which was huge. And 3, because of this, WTI gained this immense, immediate credibility. The underdog had just proven itself on the world's biggest stage. And what's so amazing is who these people actually were. McMahon points out they weren't Ivy Leaguers from some big investment bank. No, they were guys from the streets, many from working-class backgrounds, who had clawed their way up. And most importantly, they were trading their own money. They had real skin in the game.
And that's the legacy, right there. In the most critical moment, when the market was completely broken, individuals, real people, stepped up. They took the risk, they provided the liquidity, and in doing so, they built the very price benchmark that the entire global economy still relies on today.
And that just leaves us with a fascinating question for our time, doesn't it? That day in 1986 was saved by people in a pit, making split-second decisions based on instinct and guts. In our modern markets, which are just dominated by algorithms trading in microseconds, could that even happen anymore? It really makes you wonder if we've lost something essential in the move from the pit to the processor.
Welcome to The Explainer. Today, we're diving into the pretty dramatic story of how the raw, loud, chaotic world of the trading floor was totally replaced by the cold, quiet efficiency of a computer screen. And we're going to see this whole revolution through the eyes of someone who actually lived it.
So, here's how we'll break it down. First, we'll get into the roar of the trading pit back in the 90s. Then, we'll see what happened when the screens showed up, how traders tried to rebuild what they'd lost, and how they then had to face this brand new challenge, the rise of the algos. And finally, we'll look at why it truly became a whole new ballgame.
All right, let's kick things off with Chapter 1, The Roar of the Pit. Now, to really get a handle on the huge shift that's coming, you have to try and picture a world that, honestly, doesn't really exist anymore, except maybe in old movies. We're talking about the physical, very human market of the open outcry trading floor.
Yeah, this was not some quiet office with people clicking away at keyboards. This was a pit. It was a physical, human, and unbelievably loud place where fortunes were made and lost with hand signals and shouting. It was a total sensory overload.
And what's so fascinating is that trading back then was this full-body experience. It wasn't about looking at charts. It was about reading people. You could literally hear how fast the market was moving just by the sound, the intensity of the noise. You could see the anxiety or the confidence on a rival's face. You knew what positions people had because you were standing shoulder to shoulder with them every single day. It was this incredibly physical, intuitive way of feeling the market's pulse. But this entire world, this whole ecosystem of human interaction, well, it was about to be completely replaced by something much colder, much quieter, and infinitely faster: the electronic screen. And it really was the end of an era.
And this timeline just shows you how shockingly fast this all went down. You know, the 90s were the glory days of the floor. By the early 2000s, screens start popping up. And then, boom, April 2005, the IPO trading floor in London closes for good. A world that had been around for decades just vanished in a handful of years.
Now, for the traders like Steve Roberts, who actually made that switch, the change was just jarring. Sure, he was still making good money, but the fun was gone. The energy, the camaraderie, that human connection, it all just disappeared. He went from being in the center of the action to just being a guy staring at a screen, all alone in a room.
But, you know, traders are traders. They adapt. They knew they couldn't bring back the pit, but they could try to rebuild the floor in a new way. And this led to a pretty cool solution: the rise of the trading arcade.
And this just lays out the solution perfectly. Instead of everyone being isolated at home, these trading arcades brought a bunch of independent traders together into a single office. Look, it wasn't the open outcry floor, but it did bring back that sense of community, the collaboration, and the supportive environment they were all missing so badly.
But these arcades, they weren't just about recreating the social scene. They were about survival. They basically became these learning hubs. They had to upskill these floor traders, right? They had to teach them a whole new game: how to read an electronic market, how to understand geopolitics from a screen, and how to turn all that new info into profitable strategies.
Okay, so just as traders were getting the hang of the screens, a new challenge appeared. The competition was no longer just other people. Now, it was machines. And with them, speed changed absolutely everything.
This new competitor was high-frequency trading, or HFT, and you can think of it as automated trading on steroids. These firms used incredibly complex algorithms and the fastest fiber optic cables you can imagine to make trades at speeds that a human, clicking a mouse, couldn't even begin to comprehend. And because of this, the pace of the market just became terrifying. So to put it into perspective, a pretty significant price move of, say, 40 cents, something that might have taken a whole hour to play out on the trading floor,
could now happen in 2 seconds. I mean, you blink and you've missed it. You blink and you could be completely wiped out. The game had just fundamentally changed all over again.
This crazy new speed created these vicious cycles. So one automated stop-loss order would get hit, which would cause the price to drop, which would then trigger another stop and then another in this terrifying domino effect. For the regular point-and-click trader, it was like trying to catch falling knives in the dark.
So this brings us to the final and most important question. How did the old guard, the really talented, successful traders from the floor, how did they actually do in this brave new world? Well, the answer, as we're about to see, was not pretty. Fewer than half, comfortably below 50%, of the traders who left the floor actually made the transition to electronic trading work. Now think about that. These were people who had been the masters of their universe, and now the majority of them were failing.
So why? What went so wrong? I mean, it wasn't a lack of talent. The real issue was that they just clung to their old strategies. They kept trying to do the same things that had worked in the pit, but those old tricks were completely useless in a market that was faster, more anonymous, and way more sophisticated.
And this quote right here, it just nails the core lesson of this entire story. Being great at football doesn't mean you're going to be great at rugby. Success in one environment doesn't guarantee you're going to succeed in another when the fundamental rules of the game change. The skills that made you a star on the trading floor were simply not the skills you needed to thrive in the world of electronic trading. It was a whole new ballgame, and most of them just never learned the new rules. Which really makes you wonder, what game are we all mastering today that might be completely obsolete tomorrow?
Have you ever wondered how we went from traders shouting in a chaotic pit to silent algorithms trading in microseconds? Well, today, we're diving into the story of how oil trading was literally dragged, kicking and screaming, from the physical floor to the digital screen. It was a revolution, and it completely rewrote the rules of the entire game.
To really get this shift, you've got to appreciate just how different the traders themselves became. Seriously, the skills that made you a star back then are almost the opposite of what you need today. On the floor, it was all about being likable, having sharp instincts, good banter. You knew the market was moving because you could feel the energy in the room. Now, it's a totally different world. Screen traders are quants. They're processing insane amounts of data across markets that are alling together. These days, a PhD in economics is way more valuable than a loud voice.
But before we get into the nitty-gritty of that transition, we need to talk about a crucial player who works behind the scenes. Most people have never even heard of them, but without this role, modern markets would just stop. I'm talking about the market maker.
So what exactly is a market maker? First, forget any image you have of some high-stakes gambler. That's not it at all. A market maker is really a service provider. Their job isn't to bet on whether oil is going up or down. Nope. Their job is to always be there, offering to both buy and sell at the same time. They're the ones who provide the liquidity that lets everyone else, from your pension fund to a speculator, trade whenever they want to.
And this is so key to understanding them. Market makers live by a really strict code. Rule number 1, avoid speculation. The second they buy something from you, they're already looking to sell something equivalent to get flat. They're not trying to hit a home run. They're trying to make a tiny, tiny profit on the spread, that little difference between the buy and sell price, over and over and over again. An ideal day for a market maker is, in their own words, boring and drama-free.
Okay, so with that in mind, let's meet our hero. This is the story of Milan Kratchka. He was a mathematician who, back in 2003, took on a mission that seemed almost crazy at the time, to be the very first person to quote prices for Brent crude oil electronically. See, the exchange, called ICE, was mainly a place for trading natural gas back then, but they could see the future was electronic, and they really wanted to get into crude oil. So they went to Kratka and basically asked him to pioneer this new digital frontier by being its first ever electronic market maker. But the hurdles he faced were just enormous. I mean, how are you supposed to show investors a 3-year track record when the technology you're using didn't even exist 3 years ago? And the tech itself? Oh man, it was so primitive. We're talking about using Microsoft Excel to plug into the core systems of the exchange. And on top of all that, he needed a boatload of cash just to get started. And this number, it just says it all. It perfectly captures how skeptical everyone was. Kratka and his partner, they went and pitched this idea to around 80 different investors. 80! And you know how many said yes? 1. Just 1. That's how nuts the idea of trading oil on a computer screen seemed back then. And that one investor gave them $1 million.
Now, that sounds like a lot, but as Kraka himself said, it was nowhere near enough to build a real, significant trading operation. He was the underdog right from the get-go. So, armed with a little bit of cash and some pretty basic tech, he went live. And that is when the real fight started. The old-school floor traders in London, they didn't see this new electronic market as some cool innovation. No, they saw it as a threat to their entire way of life. And they fought back hard. The moment his prices started popping up on screens, the nasty messages started pouring in. This quote you see here is a heavily cleaned up version of what he was getting. The traders on the floor were absolutely furious that somebody was making prices transparent for everyone to see, and they definitely let him know it. And it wasn't just angry messages. They actively tried to wreck the electronic market. Kratzka would be showing a better price on the screen. Let's say he was bidding at 11 when the floor was at 8, and the floor traders would just ignore him on purpose. They would rather trade at a worse price with each other than let the electronic system get a foothold. And this happened, he says, hundreds of times. So yeah, not surprisingly, this coordinated resistance, it worked. If nobody trades with you, a market maker can't make any money. The venture was basically starved of business, and eventually it failed. But, and this is the important part, that failure was nowhere near the end of the story. While the business itself went belly up, the experience he gained was absolutely priceless. In a way, this first failed attempt laid the entire foundation for all the success that came later, not just for him, but for the whole electronic oil market. Think about it. Through this trial by fire, Kraka got this incredibly deep, intimate knowledge of the exchange's technology. He was basically their live beta tester, helping them debug everything. And through that, he built this amazing relationship with the exchange. So later, when he joined another firm, all that hard-won knowledge is what allowed them to become one of the biggest, most dominant players once electronic trading finally exploded.
This whole story, from start to finish, perfectly reveals the 3 things you absolutely must have to succeed in modern electronic trading. It's a formula that has pretty much defined the market ever since.
And here they are: speed, cost, and information. These are the 3 pillars of modern market making. You have to be great at all 3. There's no skipping one. So let's quickly break down why each one is so critical. First up, speed. Yeah, you have to be unbelievably fast to process news and react. But speed by itself is not enough. You can have tech that reacts in nanoseconds, but if that reaction is based on bad info or a faulty model, then being the fastest just means you're the first one to lose all your money. Next is cost, and this is so important. For every single trade a customer makes with a market maker, the market maker actually has to do 4 separate transactions to get back to zero. They buy from the customer, they hedge that trade, then they have to sell the hedge, and finally sell the original position. Every single one of those steps has a fee. Your tiny profit margin has to be bigger than all 4 of those fees put together. That's why having the lowest possible costs is a matter of survival. And finally, we get to the most important piece of the puzzle: information. It is the most valuable commodity there is. You have to know your edge. Kraka's firm knew they couldn't compete in the main front-month oil contract. You know, the one for delivery next month? That's all about physical information, knowing about tankers and pipelines. They didn't have that, so they stayed away. Their edge was math, so they applied their mathematical models to the back months, contracts for delivery way out in the future, where their models gave them a totally unique advantage. And that brings us to this perfect final quote from the man himself. It just sums up the new reality of trading. Technology and speed will get you a seat at the table, but to actually win the game, you have to be smart enough to add real value. Electronic trading isn't just a tech race, it's a battle of intelligence. Which leaves us with a final question to chew on. In today's markets that operate at the speed of light, where algorithms are making millions of choices every second, what really matters more in the end? Is it the bleeding-edge tech that gives you that nanosecond advantage, or is it the deep, hard-won wisdom that tells you which way to point all that technology in the first place? It's something to think about.
Today, we're telling the story of a legendary oil trade. We're talking about a high-stakes, billion-barrel bet made by one young trader in a market so complex, so secretive, that most people are warned to just stay away. This is the story of how a perfect financial storm created a once-in-a-generation opportunity. So let's set the scene.
Imagine you're a young trader, Greg Newman, just starting out, and this is the first piece of advice you get from the veterans. Whatever you do, stay away. And look, this wasn't just friendly advice. It was a stark warning. They were trying to keep him out of a market that was notorious for chewing up and spitting out anyone who wasn't part of the old boys club. But Newman didn't listen.
In fact, he was determined to dive right in, to conquer what everyone called the Wild West of oil trading. And you gotta understand, this wasn't just any market. This was the inner sanctum, a place totally dominated by the oil giants and massive trading houses, folks with way more information and power. And he was about to walk right into the middle of it all.
So what is this place? Well, dated Brent is the key benchmark for actual physical barrels of oil from the North Sea. This is not the simple futures contract you see scrolling at the bottom of a news channel. No, this is an over-the-counter market, which is just a fancy way of saying it's opaque, it's secretive, and it really felt like an exclusive club where new players were absolutely not welcome.
And to even think about playing in the sandbox, you have to master a whole different language of trading tools. You've got your CFDs for weekly prices, DFLs to handle the gap between physical and futures, and EFPs to turn those paper trades into actual physical oil. It's a lot. And really, understanding how all these pieces fit together is a massive barrier to entry that keeps most people out.
So for about a year and a half, Newman just kept his head down, trading small, learning the ropes. But then, in 2015, something happened. The entire market was about to be turned completely upside down by two massive converging events. It was a perfect storm, and it was about to create a once-in-a-generation trading opportunity.
Okay, so check this out. On one side, you had this massive oil glut. I mean, there was so much oil being produced that the price for immediate delivery was dirt cheap. This kicked off what's called a cash and carry trade. Companies were buying up all this cheap oil to store it and sell it later. This created a desperate need for them to sell protection on all that oil they were holding. At the exact same time, the exchange announced a huge rule change coming in February 2016. This was a super technical shift, but all you need to know is that it was going to have a huge impact on prices, and it created an equally desperate need for people to buy protection for that specific month.
So you see the problem, right? The entire market was completely fractured. You had this massive group of people desperate to sell protection right now, in November, and you had another massive group desperate to buy protection a few months later in February. Two huge, urgent needs on opposite ends of the calendar with no obvious way to connect them.
This is where Newman saw his opening. He realized that what this chaotic market needed was a middleman, a market maker to step in and bridge this huge gap. So he came up with this brilliant, multi-part arbitrage strategy to connect these two sides and absorb this enormous, chaotic flow of orders. Okay, so here's the game plan, step by step. First, he sold all those February contracts to everyone who was panicking about the rule change. He basically told them, I'll take the other side of your trade. Second, he used other contracts to shuffle all that risk from February into December. Then, third, he moved the entire now consolidated position into the current month, November, where prices were super weak. And here's the masterstroke, the final move. He planned to just wait until the very end of November, when all those cash and carry guys were being forced to sell their hedges, and then he would step in and buy back his entire position at a massive discount. Simple, right?
Of course, the strategy on paper is one thing, but actually executing it in the real world, with billions of dollars on the line, that's something else entirely. The entire life cycle of this massive trade took place over 6 weeks of what Newman himself called total madness. The demand was just off the charts. He wasn't just getting calls from London. Orders were flooding in from Singapore, from the US. I mean, for 2 solid weeks, his phone was just ringing off the hook. He was filling massive orders all day, every day, basically becoming the single point of contact for a global market that was in total chaos. And the scale we're talking about here is it's insane. To put it into perspective for you, a really big trade for a trader like him might be, say, 600,000 barrels. Newman was regularly doing single deals of 1.5 to 2 million barrels. He wasn't just pushing the boundaries, he was completely rewriting the rulebook on what was considered a big trade. By the time he got to the final settlement period, he wasn't just managing a trade anymore. He was sitting on a staggering 24 million barrels of exposure. 24 million. Just let that number sink in. It's an almost unimaginable amount of risk for one person to be holding.
And the pressure behind the scenes was just immense. Because of how the trade was structured, his risk profile would swing wildly. At times, he was triggering alarms saying he was 50 times over his risk limit. He was paying out an absolute fortune in fees, probably half of his gross profits. And all of this required an incredible amount of trust from his bosses, who had to just believe in his strategy while all these red lights were flashing.
Yeah, this was not some sterile, computer-driven algorithm. The price swings from one day to the next were violent, and the personal stress was enormous. As Newman put it himself, the pressure was so intense, he genuinely felt like he was close to having a heart attack on more than one occasion.
So this was it. This was the moment of truth. He had built this massive, incredibly complex position, all based on his theory of how the market should work. But with everything on the line and the market going crazy every single day, would his brilliant strategy actually hold together?
Well, the answer came during that final pricing window in November. And the immense, heart-stopping risk that he had taken on was about to lead to an equally immense reward, one that would transform not just his career, but how people thought about this market.
It was a complete, total success. Every single leg of his complex, multi-part strategy worked exactly as he planned. The theory was right, the execution was flawless, and the payoff, well, it was historic.
And at just 25 years old, this one trade completely made his career. He basically announced himself to the entire North Sea oil market, earning the respect of all those major players. It gave him the confidence to go on and found his own hugely successful firm. And maybe most importantly, it proved that a smaller, nimble trader could provide a vital service, liquidity, in even the most opaque markets in the world.
And this is a really crucial point. This wasn't a zero-sum game where his win was someone else's loss. It was a win-win-win. The big oil companies got the hedges they desperately needed. The brokers had a record year processing all these trades, and his strategy of being the calm center in a chaotic market paid off. It was a perfect example of a trader actually creating value for the entire system.
Ultimately, this story is about more than just a big, flashy trade. It's a testament to seeing a hidden structure inside of chaos, and then having the guts to actually act on it. And it leaves us with this really fascinating question. In all those other complex, guarded, opaque markets out there, how many other perfect storms are just waiting for someone bold enough to navigate them?
All right, let's dive into a really fascinating story from, well, what you could call the Wild West of 1990s oil trading. It's a story about how a financial product that completely failed on paper actually became a legendary success. So let me start by asking you a question, kind of a puzzle. Imagine a top Wall Street bank pours a ton of money and effort into a brand new financial product, and it flops. It completely fails. And yet the people who worked on it look back and say it was one of the best things they ever did. How on earth is that possible? Well, here's a quote from the man right at the center of it all, Gary King. He says his most memorable work, the best trades he ever made, were in a market that vanished and barely made a dent in the company's profits. To really get what he means, we have to rewind the clock back to 1994. So let's meet Gary King. He's a geologist by trade, a guy with oil and gas DNA, as he put it. He joins Morgan Stanley with a mission to expand their business in Asia, and he kind of saw the whole world of financial derivatives as this dark art. See, his background as a real oil guy was this huge advantage. It gave him credibility in a market that was, frankly, packed with both incredible opportunity and a ton of risk. Okay, so what was this big opportunity? To really wrap your head around it, you have to understand just how strange and different the Asian oil market was back in the 90s. The main benchmark price back then was something called the Asian Petroleum Price Index, or APPI. And compared to the markets we have today, which are super efficient, this thing was, well, primitive. It was opaque, meaning you couldn't really see what was going on, and it was super illiquid. Think about it. Today, price spreads might be a single cent. Back then, we're talking 15 to 20 cents. That made trading incredibly risky. And get this, instead of live electronic trading, prices were set by a panel of traders who submitted their numbers by fax. Can you believe it? They'd fax them in, the highest and lowest numbers were thrown out, and an average was published just twice a week. This whole system was so slow and outdated that it created this incredibly volatile price that was basically impossible to hedge against. Now, where everyone else saw a problem, Morgan Stanley saw a massive opportunity. Their customers were constantly telling them they were desperate for a way to manage their risk against this crazy, unpredictable API price.
So in 1995, they did something pretty radical. They started offering these things called API swaps, a brand new derivative designed to hedge that risk. This was a really bold move to basically create a market out of thin air, a service nobody else was willing to touch. But man, this was so risky for the bank. They had to use these imperfect tools, like other types of crude oil, to hedge their own exposure, pretty much just betting that historical price relationships would hold up. Gary King even said they were just crossing their fingers, waiting for that price to come out twice a week. So they put in all this effort, took on all this risk, and despite everything, the API swaps market just never really took off.
In the end, the market just wasn't ready for it. The price spreads that Morgan Stanley had to offer to cover their own risk were so wide that it made the product too expensive for customers. And that lack of liquidity, the very problem they were trying to solve, became the reason it failed commercially.
And here's the core lesson, right? Traders chose the devil they knew. They went back to using their old, imperfect hedges in markets that were actually liquid, rather than try to use a perfect hedge in a market where they could get stuck.
So this brings us right back to our central mystery. Why would a major Wall Street bank take on so much risk for a product that just didn't make any money? What was really going on here?
Well, here's the answer, and it's brilliant. The swaps themselves, they were never the real product. They were the introduction. They were the reason to have a conversation.
Morgan Stanley realized that these API swaps were one of the best calling cards they could possibly have. By offering this incredibly unique, difficult service, they were sending a powerful signal to the entire Asian market that they were serious players. You see, talking about API swaps is what got Gary King in the room with some of the most important people in Asia's oil industry. It showed everyone that Morgan Stanley was an innovator, that they were willing to tackle the tough problems. And once they were in the room, they could listen to their clients and then introduce them to more lucrative services, like financing and advisory work. And Gary King's background was absolutely vital to this. He wasn't seen as just some paper trader from New York. He could talk shop with engineers and geologists. As a credible, real oil guy, he built the kind of trust that was essential for this long-term strategy to actually work. So yeah, while the profit and loss statement for the API swaps business was pretty unremarkable, the impact it had on Morgan Stanley's overall business in Asia was immense. The swaps themselves didn't make money, but the relationships they created, they were absolutely priceless, and they led to countless other deals that really did contribute to the bottom line. It's just a powerful reminder, isn't it, that not all value can be measured in immediate dollars and cents. Sometimes the most valuable thing you can do is just show up, show your commitment, solve a tough problem for someone, and earn your seat at the table. So it leaves me wondering, what's the ultimate calling card in your world? And what doors could it open for you?
What if I told you there's an oil trader working in one of the craziest, most volatile markets on the planet who succeeds by ignoring pretty much everything? No OPEC meetings, no supply reports, no breaking news. Today, we're going to get inside the mind of a trader who does exactly that, and we're going to see how this wild approach helped him nail a massive surge in the oil market.
And that quote, that's from the man himself, veteran commodities trader Kevin McCormick. His whole philosophy just flies in the face of everything you'd think is common sense for trading. I mean, this is a market that lives and dies by headlines, and he just tunes it all out.
So that's the big question, right? If you throw out all the traditional information, what are you left with? What is he seeing that gives him the confidence to pull the trigger? That's the mystery we're going to solve right now.
To really get what McCormick is all about, we're going to jump right into a trade where his strategy paid off, and I mean big time. This is the story of his huge 2021 trade, and it's the perfect case study to see his unique method in action. So he spotted this one moment, went for it, and it was a huge win. The question is, what was this signal? Well, to get that, we've got to look at the very foundation of his whole strategy.
See, it all boils down to his method. He's not trying to guess what the market should do based on the news. Instead, he just reacts to what it is doing, what the price chart itself is telling him.
So, you've basically got two main camps here. On one side, there's fundamental analysis. That's the traditional stuff. You study the news, supply, demand, OPEC, all to figure out what oil is really worth. But then you've got McCormick's world over here, technical analysis, or charting. It ignores all that noise and finds signals purely in the patterns of how the price has moved in the past.
Now, this strategy wasn't dreamed up in some quiet office. It was forged in the absolute chaos of the New York Mercantile Exchange trading pits back in the 80s, a place where traders were literally screaming and shoving to make a buck.
In this quote, it really tells you everything you need to know about his why. He chose charting because it's just math. It's objective. After all that chaos and emotion on the trading floor, he wanted a system that completely stripped the human element out of the game. And that right there, that disciplined, emotionless approach, that's the key to everything. So, let's see how it actually works. We're going back to that huge trade from February 2021, and we're going to break it down step by step.
So check this out. For almost 3 months leading up to his trade, the oil market was just stuck. It wasn't really going anywhere. And then, boom, early February, something shifts. His chart flashes this crystal clear buy signal right before a massive upward explosion.
And this range between $50 and $54 a barrel, it was everything. For months, West Texas Intermediate crude, a major benchmark, was just bouncing around in that little channel. It couldn't break out. You can almost picture the market coiling up like a spring, just waiting.
So McCormick, he's just laser focused on one number, $54. In the world of charting, that's what you call a resistance level. You can think of it like a ceiling. Every time the price got there, sellers would jump in and push it back down. So his theory was simple. If the price could finally, decisively punch through that ceiling, it was a huge signal that something fundamental had changed.
So here's the entire game plan, laid out in 4 steps. 1, he sees the market is stuck. 2, he pinpoints $54 as that key ceiling. 3, he just waits. He's patient. He's waiting for that breakout, for the buyers to finally overpower the sellers. And 4, the second it happens, he buys, and he buys big. Notice, no news, no gut feelings, just a clean, objective signal from the chart.
And the result? Well, the price didn't just nudge up a little, it exploded. All through February, oil just took off on this massive bull run, blowing past $60 a barrel for the first time in over a year. His analysis was spot on. He saw the signal, he acted, and he just rode the wave.
But look, knowing when to get in is only half the game, right? The real genius in what McCormick does isn't just about winning trades. It's about how he manages the ones that could go wrong. It's all about discipline.
And this is so important. Before he even clicked buy on that trade, he knew exactly, down to the penny, where he would sell if things went south. Having an exit plan for when you're wrong is just as important as your plan for when you're right.
And he had a hard line in the sand. $48.40. If the price broke out but then fell back down to that level, that was it. Game over. He would have sold and taken the small loss, no hesitation. As it turned out, in this trade, the price never even got close.
So when you boil it all down, his philosophy is actually pretty simple, but incredibly hard to follow. It's all about taking your ego, your fear, your greed, and just setting it aside. You let the data, the chart, be your guide. You always have your escape route planned before you even start. And maybe most importantly, when that signal is strong and clear, you have the guts to follow it, even if it means buying a market that's already going up.
And that really leaves us with something to think about, doesn't it? Because this isn't just about trading, it's a masterclass in making disciplined decisions. So think about it. What's one big decision in your own life, maybe your career, your finances, anything, where you could do better by just tuning out all the noise, finding that one clear signal, and then acting on it without emotion? It's a really powerful idea.
All right, let's dive into one of the most incredible stories in modern finance. It's a tale about a high-stakes bet made by a government, a bet that had absolutely staggering consequences for an entire nation's economy. And there you have it. That's the punchline, right from the start. It's a quote from Gerardo Rodriguez, a guy who was right there inside Mexico's Ministry of Finance when it all went down. I mean, think about that title for a second. The greatest single oil trade of all time. So how in the world did they earn a title like that? That's really the big question we're going to dig into. This isn't just a story about numbers on a spreadsheet. It's a story of incredible foresight, a whole lot of courage, and a system that was built to withstand a global financial storm. Okay, so to really get the genius of this trade, you first have to understand the massive problem Mexico is facing. See, the very foundation of the country's public finances was resting on something incredibly shaky. It's actually pretty simple when you break it down. The government relies, and I mean heavily relies, on the income from its national oil company, Pemex. When oil prices are flying high, everything's great. The country has plenty of money for schools, hospitals, roads, you name it. But when those prices crash, so does the entire budget. And look, this wasn't just some theoretical problem on a whiteboard. Back in the late 1990s, Mexico learned this lesson the hard way. Sudden, shocking drops in oil prices led directly to these painful, unplanned budget cuts that caused real hardship for people all across the country. They knew they needed a better system. So the government got serious. They decided to stop just reacting to crises and start actually managing the risk proactively. They set up something called the Oil Stabilization Fund, which was basically a formal program designed to be a financial shield against the wild swings in oil prices. The whole idea was to build a disciplined, systematic way to protect the budget year in and year out. So they have this fund, right? But how do you actually use it? I mean, what kind of financial tool could possibly protect an entire country's budget from the craziness of the global oil market? The team landed on using something called crude oil options. Now, the best way to think about these is just like an insurance policy. Mexico would pay an upfront fee that's called a premium to buy the right, but not the obligation, to sell its oil at a guaranteed price down the road. And this is exactly why they chose options over other tools like futures. With an option, you pay a smaller premium upfront. This lets you build a massive position without a giant initial investment. And here's the crucial part. If oil prices suddenly went up, Mexico could just let the option expire and sell its oil at the new higher market price. It was the perfect tool. It protected their downside without giving up any of the potential upside. Now, these guys didn't just buy these options on a whim. No way. They operated like a team of professional traders. They followed this super rigorous 4-step process every time. First, they did their own deep dive analysis of global markets. Then, they figured out the absolute perfect time to strike. Then, they had the central bank go out and get competitive quotes from all the big investment banks. And finally, they pulled the trigger. It was strategic, tactical, and incredibly disciplined. So this system they built, well, it was about to face the ultimate test. The year is 2008, and the entire global financial system is starting to make some very scary noises. It's groaning under immense pressure. I love this quote because it just puts you right in the room with them. You can feel their confusion. The global financial crisis is getting worse by the day, huge banks are failing, and yet oil prices just keep going up. It made zero sense. The market was sending them a completely contradictory signal. And that was the huge dilemma. I mean, put yourself in their shoes for a second. Oil is blowing past $100 a barrel. Every market signal is screaming buy, buy, buy. But your gut and your deep analysis of the whole financial world is telling you that a massive crash isn't just possible, it's inevitable. So what do? This timeline really shows you their almost unbelievable foresight. While pretty much everyone else was getting caught up in the oil price mania of summer 2008, the Mexican team made their move. They executed their entire hedge for the next year, for 2009, between June and August, which was months ahead of their normal schedule. And just as they finished, the oil market completely fell off a cliff. Their timing was, well, perfect. So what was the result of this incredibly brave, totally counterintuitive decision? Okay, let's get to the payoff, because this is the best part. Now, this was not an easy call to make. Not at all. To get this hedge done so early, they had to convince their bosses to spend 20 to 25% more on the insurance premiums than they normally would. They were basically paying a huge extra fee just for certainty in a world that was looking more and more uncertain every day. It was a massive gamble. And here's the result. As oil prices came crashing down, their options, their insurance policy, became unbelievably valuable. At one point, the trade was in the money by an amount that's just, well, it's hard to even wrap your head around. Just look at that number. $16 billion. That profit didn't just patch a hole in the budget. It effectively carried the entire country's finances through the first 2 years of the global financial crisis. This was a time when, as Rodriguez himself said, it really felt like the whole economic system could just completely collapse. But the story doesn't end there. This trade became the stuff of legend, for sure. But it also brings up a much deeper question about why Mexico is one of the only major oil producers in the world that even does this. So why is this whole strategy so unique to Mexico? Well, there are really two sides to this coin. The good reason is that Mexico has this long tradition of having these incredibly competent, skilled teams in its finance ministry who know how to pull this off. It's a real sign of institutional strength. But then there's the bad reason.
Unlike countries like Norway, Mexico has historically lacked the political discipline to just save its oil money in a big fund for a rainy day. Low tax revenues create this immense pressure to spend any windfall immediately, not save it. And that leaves us with this final, really thought-provoking question. The greatest oil trade of all time was without a doubt a massive success. But was it the ultimate sign of sophisticated financial management? Or was it a brilliant solution to a much deeper problem? A problem that other countries solve with something as simple as a savings account? That's definitely something we're thinking about.
Welcome to The Explainer. Today, we're diving into one of the most brilliant trades in the history of the oil market. And the wild part? It wasn't cooked up in some fancy boardroom. Nope. It came from the mind of a mathematician who, really, just wanted to stay in the country.
Okay, let's just sit with that for a second. That one sentence from the man at the center of our story, Dr. Ilya Bolshuev, is basically the starting pistol for a financial revolution that would go on to reshape the entire American energy landscape.
All right, here's how we're going to break it down. We'll follow this wild journey through 6 key parts, from a chance job offer all the way to a market-defining innovation.
So let's start at the very beginning. Our story kicks off not with some oil tycoon, but with a guy who just got his PhD in applied mathematics and had his eyes set on Wall Street.
So you've got this guy, Ilya Bolshuev, super smart, fresh out of his doctorate program, and he's dreaming of a quant job, at a place like Goldman Sachs. But then he gets an introduction to Koch Industries. And here's the thing. Koch had something the big banks couldn't promise. They offered to sponsor his U.S. green card. For an immigrant, that is everything. That one offer was the deal maker. And just like that, this brilliant mathematician with literally zero experience in the energy world finds himself on Koch's options trading desk.
Okay, so he's at Koch. And the first project they hand him? Well, it leads to a discovery that the entire industry had somehow completely missed.
He was asked to figure out the real value of something called storage optionality. Now, what is that? Think of it this way. You have the right, but not the obligation, to use an oil storage tank. This is super valuable, right? Because it means you can buy oil when it's cheap, stash it away, and then sell it later for a higher price. Every trader on the planet knew this was worth something, but nobody, and I mean nobody, could agree on exactly how much.
And this is where Bolshuev has his aha moment. He digs into the numbers and realizes the commercial software everyone in the industry was using had this tiny hidden flaw. It was hard-coded to stop its calculations after only 400 tries. It just gave up too early. Bolshuev, being a mathematician, just let the model run, and what did he find? The real value wasn't 20 cents a barrel. It was way closer to 30 cents. The entire market was getting it wrong by almost 50%.
So what do you do with a secret like that? I mean, you're basically holding a winning lottery ticket. You know the true price of something that everyone else is selling at a massive discount. So he goes straight to his bosses at Koch and says, look, I can go out there and buy this stuff for 20 cents, and I know for a fact it's worth 30.
And this wasn't just some abstract idea on a spreadsheet. This discovery became the bedrock of a strategy that would run for years and be worth billions.
And here's what's so incredible. Koch's management, they didn't just say nice work and file it away. No, they looked at this young scientist and basically said, okay, prove it. They gave him a phone, a risk limit, and their full backing to go out and buy up every single cheap option he could get his hands on.
He called his strategy synthetic storage. And the pitch he made to storage companies was just brilliant in its simplicity. He'd walk in and say, look, I will give you cash, right now, up front. In exchange, you give me the right to use your tanks for the next 1, 3, even 5 years.
Now, this is the key. It wasn't a zero-sum game. This was a massive win for both sides. The storage companies, they got a huge injection of cash to build new tanks and expand their business, plus a guaranteed customer for years to come. And what did Koch get? They got to scoop up enormous amounts of this undervalued optionality for pennies on the dollar.
And this wasn't just numbers moving around on a screen. This strategy had a real physical impact. As Bolshuev himself said, Koch's cash directly funded a huge build-out of America's energy infrastructure, especially in the absolute nerve center of the U.S. oil market, Cushing, Oklahoma.
So for years, this synthetic storage strategy was just a money-printing machine. It was incredible. But by 2007, that wild success had created a whole new problem, a really, really big one.
The trade was a winner every single year, so of course they kept piling in. But then oil prices started going crazy,
shooting up towards $100 a barrel. All of a sudden, the value of their massive portfolio of options just exploded. They were sitting on a mountain of on-paper profit.
Remember those options they bought for around 30 cents? Well, on their books, they were now worth 60 cents a barrel. The profit was insane. But then, management started asking a very simple and frankly, a very terrifying question. This is great, but how do we actually turn this paper into cash?
And the answer was, they couldn't. They were trapped. Their position was so massive that there was literally no one big enough to buy it from them. In fact, they were the market for these things. If they even tried to start selling, the price would just collapse and all those profits would vanish into thin air. They were, for all intents and purposes, stuck.
So, to get out of this too-big-to-exit jam, Bushov and his team had to get creative again. They realized they couldn't just find a buyer, they were going to have to create a whole new universe of them. So they started looking way outside the traditional oil world, and they found a really unlikely customer: pension funds. Now, why them? Well, these huge investors were pouring billions into commodity indexes, but they were getting absolutely crushed by this market condition called Contango. Basically, it's a structural thing where they were forced to lose a little bit of money every single month. And guess what? Coke had the perfect tool to help them hedge that risk.
So their plan was this brilliant two-part attack. First, they went on a roadshow, pitching their options directly to these pension funds, framing it as a kind of insurance policy against their losses. But then came the true masterstroke. They went to the New York Mercantile Exchange, the NYMEX.
They worked with the NYMEX to turn these options into a publicly traded product, listed right on the exchange for anyone to buy. This was absolutely genius. Why? Because the exchange's clearinghouse acts as a middleman, which completely eliminates the risk between buyers and sellers. Suddenly, Cook wasn't limited to a small club of counterparties. They could trade with anyone, anywhere in the world.
And that brings us to the absolutely perfect ending to this whole story. A strategy that somehow, against all odds, ended up being a massive win for every single person who touched it.
I mean, look at this. It was the perfect trade. Cook obviously cashed in on years and years of profit. The storage companies got the money they needed to build out America's critical energy infrastructure. The pension funds got a brand new, powerful tool to protect their investments. And the market as a whole, it got a new, transparent, and efficiently priced product. Everybody won.
The story of synthetic storage is it's so much more than just a clever trade. It's a perfect example of how seeing a market just a little bit differently, connecting dots that no one else sees, doesn't just create profit. It can create an entire new ecosystem where everybody benefits. And it really makes you wonder, right? What other billion-dollar markets are out there just waiting for one person to come along and connect the dots?
So what happens when you drop an aggressive, fast-talking investment banker right into the middle of the super conservative world of a major oil company? Well, you get an incredible story. It's a story about a massive culture clash, a billion-dollar idea, and a strategy that completely, and I mean completely, changed the game. And it all started with one single radical thought. This right here, this quote from a guy named Richard Fullerton, is the key to this whole thing. See, he didn't look at a company like Shell and see just a bunch of oil wells and refineries. Nope. He saw it as a massive collection of opportunities, of choices, or as he called them, options, that were being totally, utterly ignored. All right, so let's set the scene and meet our main character. The year is 2001, and Richard Fullerton, who's an equity derivatives trader from the cutthroat world of banking, walks through the doors of Shell trading for the first time. I mean, his whole job was basically making these complex bets on where stock prices would go. He was an outsider in every single sense of the word. Now, you gotta understand, Shell didn't hire this guy to come in and revolutionize their entire business. Not at all. Their plan was way more modest. They were just partnering with a bank, and they needed to build this small internal team to handle derivatives for that bank's customers. They were essentially trying to build a tiny little hedge fund inside of this giant oil company. You can probably guess what happened next. Yeah, this move immediately created a ton of friction. I mean, the arrival of a whole bunch of bankers with their completely different lingo and, let's be honest, different incentives was not exactly met with a warm welcome from the old school oil traders. The tension was obvious from day one. And it started with the little things. Fullerton's new team, they were getting kitted out from scratch. So they got these brand new, sleek, flat screen monitors. Nobody else on the entire trading floor had them. And the resentment, it was immediate. And you could feel it.
Just try and picture it from the perspective of someone who's been at Shell for years. You see these new guys walk in, you hear they're earning these higher banking-style salaries, they've got better gear than you, and they're sitting over there doing something with derivatives that, frankly, nobody really understands. You can see why the skepticism was so high. But look, this wasn't just about simple jealousy. This quote right here reveals a much, much deeper problem within Shell's culture. The top brass at Shell actively downplayed how successful their own trading division was. They literally didn't even report the results because they didn't want shareholders to know how much money trading was making. This created a culture where taking smart risks was basically punished. The mantra was, do not rock the boat. But, of course, Fullerton was there to do exactly that, rock the boat. He saw this massive, untapped potential that the company's own conservative culture was completely blinding it to. So what was it? What was this revolutionary idea? What was this incredible value that was just hidden in plain sight, that an entire army of brilliant engineers and geologists at Shell just couldn't see? It all came down to this one concept, optionality. To a banker like Fullerton, every single physical thing Shell owned, every well, every pipeline, every ship, it wasn't just a thing, it was a choice. A choice to produce a little more oil or a little less. A choice to refine it into gasoline or maybe diesel. A choice to ship it to Europe or Asia. And every single one of those choices had a value that could be calculated, hedged, and traded, just like a financial option on Wall Street. Think about it like this. It's pretty wild. A company spends $1 billion to build a refinery. What is that really? It's a huge, long-term bet. It's basically a call option on the profit margin between crude oil and the stuff it's turned into. Fullerton's big idea was to find and monetize all of these hidden options across the entire company. Okay, so he had the theory. That's great. But how did he actually put it into practice and, make money? Well, he developed this brilliant strategy that was all about finding moments of maximum stress in the market. See, most of the time, the market is pretty balanced. But every so often, a single massive player, like, say, the entire country of Mexico hedging all of its oil production, would storm into the market. This trade was so enormous that it just overwhelmed the banks, forcing them to take on this insane amount of risk. These moments created these huge imbalances, what Fullerton called pinch points. And Fullerton's strategy, well, it was genius in its simplicity. First, his team would figure out exactly where the banks were most exposed, where they were holding all this risk. Then, they would just wait. They'd wait for a geopolitical shock, a war, a surprise OPEC decision, anything. When prices moved like crazy, the banks would panic, and they'd need to get out of their risky positions fast, basically selling their options at fire sale prices. And that's when Fullerton's team would be waiting to step in and scoop them all up for cheap. And the result of all this? It was absolutely staggering. In a single year, this tiny team of outsiders, the ones who were once looked at with so much suspicion, generated more profit than the entire legendary North Sea physical trading desk. I mean, that wasn't just a success, that was a statement. You just can't argue with numbers like that. Management had no choice but to sit up and take notice. This incredible success was the catalyst. It was the spark that started this slow but profound change deep inside Shell. It was really the beginning of a complete cultural transformation for the whole company. But something this big doesn't happen overnight. It was a really slow burn. What started with a bunch of suspicious glares in 2001 evolved over years into a core business strategy. The whole derivatives approach spread from crude oil into natural gas, carbon credits, even power. By the time Fullerton left in 2014, Shell trading was a world away from what it had been. It was recognized as a true powerhouse, on the same level as the biggest banks. And Fullerton summed up the whole journey perfectly with this metaphor. You can't force change on a massive conservative organization like that from the outside. You just can't. The only way is to prove your value, to deliver results that are so undeniable that they have to invite you onto the bridge. And that is exactly what he did. And that kind of leaves us with a final thought, doesn't it? This isn't just a story about oil trading. It's a story about perspective. And it really makes you wonder, what other huge legacy industries are out there right now, just sitting on billions in untapped value, waiting for the right outsider to come along and show them what they've been missing all along?